For example, from the likes of Volvo Cars, among many, many others. And we're ending the week on a high note, but perhaps that's because the volatility was really baked earlier into the week. The Stoxx 600 opening higher by 0.2%, but the FTSE 100 is flying higher by 0.4%. The IBEX as well, the DAX certainly higher, and the CAC 40. This tells you, the speed of opening tells you, Lizzie, light volume, light liquidity. But I wonder if there's a couple of individual movers driving that FTSE outperformance.
Well, let's go to the ones I flagged. So Burberry's up 5.4%. As I say, they had sales falling less than feared amid this turnaround plan. So outperformance off the bat from the fashion house. Also, Reckitt Benckiser at 1.6% at the open. And Saab, as we say, boosting its organic revenue forecast, and those shares up 5.4%. So when you look at the sectoral breakdown, you've got almost every sector in the green. Energy leading the gains, up more than 1%. Basic resources not far behind. Construction and manufacturing not far behind that as well. Autos and parts, the only one that's in negative territory this morning, but it's only just in the red. Stellantis is what's dragging that down, as it seems at the moment. Not sure what the story is there, but we can have a look at that. But when you look across the continent, as you say, it's a summer Friday, thin volumes, but we are up 0.4% when it comes to Euro Stoxx 50.
Absolutely, it's a fascinating one. When we look at the downside moves, just because you explained the upside ones, you are seeing some of the heavyweights actually pull back a little bit, and perhaps the ones that are catching my eye right off the bat is Novartis and ASML. Remember, Novartis did come in yesterday and actually talk to Bloomberg about some of the tariff impact there as well. The market down about 0.9%, seeing a slight ripple effect when it comes to some of the other healthcare stocks. From an individual basis, that is your key downside mover. ASML also very much a part of that story, down about 0.8%. But remember, ASML had gotten a big boost earlier in the week, given the U-turn when it comes to the CHIPS policy out of the United States. But there are some warnings, some demand warnings that could be feeding into like ASML and some of their international partners and, of course, competitors as well, Lizzie.
Well, let's get at a bit of analysis on what's going on in these markets. We can speak to Chris Watling, CEO and Chief Market Strategist over at Longview Economics, and I'm pleased to say he joins us around the table this morning. Chris, welcome to the programme. You've been writing about summer turbulence, but all I'm seeing this morning is green across my screen. We're expecting a stronger session to end the week stateside as well. Where is this summer turbulence going to come from? Is the cliff edge going to be August the 1st?
Well, I mean, summer's typically a seasonally tough period, but actually markets in the US haven't done that much in July. They're sort of edging to new highs, but they're not. They've lost a lot of their momentum. That momentum we had all the way from April all the way through to really late June into the beginning of this month has stalled out. And yes, they're edging to new highs on the back of some earnings, but not aggressively. And I think they're just a bit tired. They're overbought. They look very overcooked relative to bonds. Bond yields are backing up and squeezing the equity market. And I think they've become almost overowned by quite a lot of people. You know, there's been a lot of movement into those equity markets. So there's plenty of things to worry about, I think.
Well, some people have been talking about this approaching bull market territory. Do you buy the dips here, or how fast could the rally unravel? Could we go from, you're looking around 6,300 right now. How fast could that turn into 6,000, for example?
Well, the market could quickly give back 5, 6, 7% over the course of summer. I don't think that would be difficult. But yes, I do think you want to buy the dips. I do think it's not a retest of the lows. It's not a retest of the April lows. That's not what we're calling for. But there is a need, and there is a need for some consolidation, some give back, a bit of a pause, there's volatility. The US macro, I know we had good retail sales, but the trend is not good in the data. And frankly, it's hard to see how this economy is still delivering retail sales numbers like that. And I think it'll have to stall out a bit. So that you've got those risks when you look at the equity market. But yeah, I would take weakness as an opportunity to buy. We're in a bull run. We cleaned out the system in April properly. Positioning was fully cleaned out at those lows. And so, the bull run's likely to have a year or maybe 18 months in it. So, yeah, buy the dips.
Well, that's on the market basis. Let's talk about the economics specifically as well, because you wear two hats on that front over at Longview. Talk to us a little bit about the tariff read-through here. It's been 3 months. We've started to hear some profit warnings, some margin compression from some of these earnings. But investors are looking through it. How digestible are these tariffs?
Yeah, it's funny, isn't it? Investors always look through these things until they don't. In many ways, they are quite digestible. I don't think they're going to push the US into a recession, but they clearly have an impact. There is a clear fiscal tightening at the moment. We saw last month that sort of tariffs running at about sort of high 20 billions for the month in May, I think it was, wasn't it, that we had reported at the back end of last week. And that's a run rate of 240 billion fiscal tightening per annum in the US. So some of it's swallowed by corporates, some overseas corporates, some by the consumer, but perhaps not as much as people think. But so clearly it's causing problems in the US economy. It's part of that slowing dynamic that we're seeing. But I don't think it's going to push the US over into a recession.
When it comes to that call, though, how much of the currency component plays a role? We just had Netflix earnings in the last 24 hours or so. Massive gains, but a good chunk of that was because of that weak dollar story. How much of the currency is swaying the overall reception?
Well, currency is part of it, but normally you would say if you're going to put tariffs on, the currency would strengthen. Of course, It's been weakening. So, really tariffs are swallowed by overseas companies, domestic companies, currency, or the consumer. And it doesn't look like the currency's absorbing any of it because it's going the other way. So I don't think the currency is really a factor at all. It's companies absorbing it basically in their margin, a little bit of it at the consumer level.
Two things. You mentioned about the tariff rate. What effective tariff rate would trigger a recession in the US?
Well, great question. But we're probably going to end up 15 to 20%, so probably not that. But it's clearly going to deliver part of a slowdown. But try doubling it or making it 50%. I don't know. It's very difficult to know exactly what rate would generate that. But yeah, I think, we seem to be effectively getting by. The economy's clearly slowing, as I say, but we're getting by without the recession at this tariff rate. So, yeah.
And on the dollar story, we're having a down day today because of the Waller comments. I do wonder how long that lasts. And I noted earlier that, this is the best month so far for the dollar in 2025. Are we overplaying the dollar weakness story? And how weak does the dollar have to get before you make US equities attractive to foreign investors again?
Well, it's hilarious, isn't it? The market narrative swings from one thing to the next. In January it was American exceptionalism. Now it's the dollar's going down forever. It just doesn't work like that. Markets don't go in straight lines. We're very oversold on the dollar. Sentiment's very bearish. We've seen that in many measures over the last couple of weeks. And I think we're due a counter-trend rally, and that's what we've been calling for. And quite right too. Markets mess people up. When there's a consensus, they mess them up. And, for example, maybe the lack of a rate cut in the US adds some stability to the dollar. You could argue that the other way around, but clearly there's an argument for that as we push back the rate cut over the last few weeks into September away from July, maybe not even in September. So I think the dollar's got a little bit of underpinning short term from that interest rate support, and it's really a consensus bear. And therefore, I think it's due a bit of a rally, a bit of a counter-trend move. But that doesn't preclude the idea that long-term we are in a dollar bear market.
The dollar is notably diverging from the bond market to the point that a U.S. 10-year has been range-bound for, I want to say, the better part of this year, 420 to 460. We're at 443 right now on the 10-year. We talk a lot about the ripple effect of the currency weakness on the stock market on both sides of the Atlantic. Talk to us about the relationship between bonds and stocks right now.
Yeah, well, like you say, bond market's not doing much, so it's not really driving too much. I mean, what's interesting about the stock market is your sort of typical go-to couple of things you would say with bond yields is, of course, defensives, up or down, and then, of course, yields backing up. You'd argue there's a bit of a pinch point for equity markets, which I think we might be starting to see. They backed up a bit over the last few weeks. But defensives are deeply oversold relative to the rest of the market, which is actually another good reason why equity markets tend to stall out and have a bit of turbulence. So you're getting that signal from that part of the stock market that is linked to bonds. But no, I think bonds are attractive here. I'd be a buyer of bonds. I don't see why yields don't go lower. Really, the U.S. economy's got fiscal tightening at the moment. It's had tight money for a couple of years. There are large parts of the U.S. economy that are really struggling, and therefore you need, with fiscal tightening, you need lower yields to kickstart the private sector side, the housing side, all this kind of part of the U.S. economy. So we're a buyer of bonds. We have been since January this year, and I think that still makes sense.
Sorry, go ahead.
I was going to say there's an argument when it comes to the right time to buy bonds as well. There's an argument that as we approach the X date on the deficit in the United States, there might be a better time to clip the coupon, a better time to hop into the yield.
Well, people worry about this fiscal crisis. I mean, the reality is I think that's wholly mischaracterized. I'm totally with Steve Eisman on this. I mean, we're obsessed. You know, the market knows what's going on in terms of the deficit. And actually, the tariffs are probably going to pay for pretty much the whole thing. So how fiscally poor is it? You know, it's in the price. So I don't expect much higher yields from here. I think lower yields is what you need. And I think we'll get those over the course of the next few months, possibly over the summer if we get this turbulence in the equity market.
But when you've got the president weighing on the Fed chair and funding his fiscal plans as T-bills, does that not, Chris, add up to fiscal dominance?
Yeah, sure, there's a little bit of that, and that's a little bit of a concern, and that maybe adds a bit of a risk premium into the bond market, absolutely. But, you know, there's a lot of people on the Fed committee. It's not just the chair, and he's not going to get rid of all of them. And you know, I know we had all this chat from Kevin Walsh yesterday, which I thought was kind of interesting. But so, yeah, there's an element of that, but I think you can overplay these things, and these will become popular narratives in markets at certain points in time. But the reality is the U.S. economy is softening, and yields therefore need to go lower.
All right. Chris Watling, CEO and Chief Market Strategist over at Longview Economics. We'll see how low those yields go. We thank you so much. A quick check on the Core 6, the heavyweights, of course, that move this market. And right out of the gate, there's only one underperformer in the Core 6, and that, of course, is ASML, down about 1.1%. But one of your biggest weights on the stock 600 this morning. Your outperformers go right to France. LVMH is the biggest mover, higher by 0.9%, right alongside Nestle, up by about the same amount. If I didn't know any better, I'd say it was a defensive trade on our hands, but ASML, not really a part of it. Let's get some check on some of the individual stocks on the move. Chloe Melly is here with more. Chloe.
Good morning, Gretchen. Let's start with luxury this morning. So Burberry sales did fall over the last quarter, but crucially, they fell less than expected. And that's what's driving the stock move this morning. We have shares up 2.2%. It seems like the turnaround is currently working. So Burberry is really trying to refocus on the classics, you know, the trench coat that it is known for. And that seems to be bearing fruit so far. So quite encouraging move from Burberry this morning. Moving on to the defense sector, we've got Saab in Sweden, and Saab raised its organic revenue forecast for the year, and that's pushing shares almost 10% this morning, and probably will have an impact on the rest of the defense sector in Europe as well. That's on the back of really strong defense spending in Europe. Moving on to a little bit of a more negative story in the steel-producing sector. So Salzgitter issued a profit warning, and shares are down 12.6% this morning on the back of that. Analysts are expecting more consensus downgrades across the sector because the near-term outlook doesn't look too good so far. And then finally, Vestas Wind System is up more than 10% this morning. It just got raised to an overweight rating at JP Morgan, who said that wind power installations are going to pick up, and that will be benefiting Vestas. So really up this morning, in the green, definitely.
All right, Chloe Melly from our Equities team, we thank you for that update on some of the stocks that we are watching at the open. We have European equities broadly in the green across the continent, up 0.25% when it comes to Euro Stoxx 50, about the same on Euro Stoxx 600 as well. But Coming up on the programme, we're going to go live to the G20 in South Africa. Finance chiefs gathering under the cloud of the trade war. And we're going to be speaking to the Australian Treasurer next. Jim Chalmers up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. About 17 minutes into today's session. Green on the screen across the board. France, the notable outperformer, higher by 0.5%. Light volume, light liquidity, of course, key aspects of this market. In the meantime, we've got one eye on what's going on in South Africa, where the finance minister says sustainable financing and global imbalances have been key sticking points as heads of the world's largest economies gather for the G20. For more, Bloomberg's Oliver Crook joins us on location. Ollie.
Yeah, that's right, Grady. We're just here outside of Durban for the G20 Finance Ministers and Central Bank meeting that's been going on here for the last couple of days, wrapping up today. Hopeful that there will be a bit of solidarity and a communique coming a little bit later. We're very pleased to be joined by a guest, Jim Chalmers, who is the Treasurer of Australia. Has come a long way for this meeting, so thank you very much for taking the time.
Thanks for the opportunity, Oliver.
Yeah, I think we have to start with the elephant in the room. 2 weeks away from this Trump deadline. What is the status of negotiations between Australia and the United States right now?
Well, Australia has the baseline tariff, the 10%, and some additional areas like steel and aluminium, copper, pharmaceuticals. And so we're engaging with our counterparts in the US, like almost every other country is in the world. We're pretty well placed and we're well prepared to deal with these tariffs. The direct impact is relatively manageable. Our bigger concern is the impact on global demand of all of this uncertainty and volatility and unpredictability. which puts global growth and indeed global inflation at risk. And so in our modelling, the bigger risk comes from the impact on the global economy rather than the direct impact.
Okay, because 10% is basically, as far as we can tell, the lowest possible deal. That's effectively what you will have with the United States. Are you happy with that, and does that warrant retaliation or no?
We've decided to go for resilience in our own economy rather than retaliation. You know, the 10% tariff is the lowest of any countries, but you know, we've made it really clear that we think the appropriate tariff consistent with our trade agreement is zero. We see these tariffs as self-defeating. We see them as an act of economic self-harm. We've made that very clear. Bad for the US economy, bad for the global economy, and therefore not good for Australia.
Do you see any progress possible on steel and aluminum?
Well, it remains to be seen. I mean, we've been engaged more or less constantly for some months now, whether it's steel and aluminium or some of the more recent announcements around copper and pharmaceuticals. Our approach is to engage at every level as much as we can to get a better deal for our workers and our industries, our exporters, our industry and our investors. And that approach will continue to guide us.
And in terms of the negotiations around pharma, we've heard 200% as a possible figure from the United States. Are changes to Australia's pharmaceutical benefits scheme, is that something that's on the table because the Trump administration has been very focused on non-tariff barriers? Is that part of the conversation?
Absolutely zero chance. You know, we couldn't be clearer. Our pharmaceutical benefits scheme is a crucial part of our architecture, our policy architecture. It's something we're very proud of. We've made it really clear that we're not prepared to negotiate or diminish or weaken the PBS in order to get a deal. We've been clear about that from the beginning. We're working through the potential consequences of pharmaceuticals being caught up in these escalating trade tensions. We do have quite a substantial export offering into the US when it comes to pharmaceuticals. But how this potential tariff might work, we're working through with the industry and with the administration.
And I'd like to also get your appraisal of the evolution of the multilateral kind of cooperative system, because obviously it's been dealt quite a shock over the last couple of months. You sit sort of interestingly between the nexus of a lot of different sort of spheres of influence. In terms of the conversations that are happening here, how is the G20 and the sort of larger global framework of cooperation dealing with this U.S. situation, and what does the sort of potentially further cooperation look like?
Well, I've been involved in the G20 in different roles for a big chunk of the last 2 decades, and we've been through 4 economic shocks in that period. The reason this one, the 4th one, is different to the first 3 is that it's primarily induced by policy, by decisions taken around tariffs. And so I think what that means for this type of multilateral engagement is that people recognise here that at a time when there's lots of volatility, uncertainty and unpredictability, the best defence against that, the best antidote to that is more engagement, more resilient economies, more robust supply chains, more reliable markets for our exports. And so I think that's really the colour and the context for these discussions. And from an Australian point of view, Australia is a huge believer in multilateralism. We're a huge beneficiary of free and open markets, and so we come to these discussions in that light.
And so concretely, where do you see kind of the most motion sort of being affected in that, in terms of different relationships with countries, ones that you maybe have not talked to in the same way in the past? How have you seen that sort of changing concretely?
I just think there's a real recognition here that when these tariffs and escalating trade tensions, the uncertainty that comes from that, but also from conflict in the Middle East, conflict in Eastern Europe, a whole range of uncertainty. I think the heartening message from the colleagues here that we've been engaging with is people are not retreating into their own corners. They're working out how to make our own economies resilient. That's a big part of the Australian agenda as well. But we're trying to de-risk these relationships without decoupling. And I think that's a major theme. It's a heartening theme because the alternative would be to pretend that at a time when these trade tensions are escalating and these conflicts in important parts of the world, to pretend that we can just retreat into our own corners. That, again, I think would be self-defeating. It's certainly not the Australian strategy.
And you mentioned defence as one of these sort of issues. There's been a huge amount of pressure from the United States for allies to spend more on defence. You saw that most concretely in NATO a couple of weeks ago, where you had that boost in pledges for 3.5% effectively of defence. Do you think Australia could get to that figure of 3.5%? Do you think that would be appropriate to join sort of allies at that level?
Well, first of all, it is a big part of the conversation here, particularly with European friends, how they'll find the 3.5% of GDP and how they'll account for the other 1.5% of GDP for national security-related spending. For Australia, we're already by our standards, quite dramatically escalating our defence spending. You know, we're taking it from 2% of GDP up to 2.3 at the start of the next decade. That already represents, you know, tens of billions of dollars in extra investment. It's a much higher trajectory than when we came to office 3 years ago. And so we are increasing our defence spending. We make those decisions, trading them off against all kinds of other budget priorities. But we say to American friends and we say to the world more broadly, we are already increasing our defence spending because we think it's important at a time where we are seeing this heightened uncertainty in the world.
Mm-hmm. And given just sort of the global volatility, uncertainty in the outlook, how confident are you of your inflation forecast and your growth forecast? How susceptible do you think those are to downward revision?
Look, there's always an element of uncertainty when it comes to forecasting economic outcomes, but especially when, you know, global markets are extremely volatile right now. But one of the things we're very proud of as Australians is there's only 2 countries here at the G20 that last year had continuous economic growth, inflation with a 2 in front of it, and unemployment in the low 4s. No major advanced economy has been able to, over the last 3 years, maintain that growth and have those inflation and employment outcomes. And so why we're proud of that is we've made very substantial progress on inflation, now sustained progress on inflation. It's given our central bank the confidence to cut rates twice already this year. But we've done that without paying for it with much higher unemployment. Unemployment is now 4.3%, historically low, the lowest average unemployment over the last 3 years for any other government in the last 50 years. We've created 1.1 million jobs. And so our labour market's been a source of strength. Mm-hmm. We had a little tick up yesterday in the unemployment data, but we've got inflation down without paying for it with a big spike in unemployment, and that's something we're very proud of.
Well, Jim Chalmers, thank you so much for your time here on the sidelines of the G20 outside of Durban in South Africa. Thank you very much. So those are the thoughts there from the Australian Treasurer in sort of multilateralism in the age of MAGA and the path forward here at the G20.
All right, Ollie, thank you so much for bringing us that interview. That's Bloomberg's Oliver Crook out of South Africa with the G20. Of course, we've also been hearing from the South African Finance Minister, speaking to Jennifer Sabasaja on the ground there, expecting a communique for the first time in South Africa's holding of the presidency to come today. So that would be a significant achievement for them. Of course, Scott Bessent, the US Treasury Secretary, in his absence has been dominating and the trade agenda dominating as well, although, of course, there are many, many other things that they would like to be focused on at that summit. But Kriti, as we look at the performance of the stock market as we are 26 minutes into the open this morning, Australia, and that conversation reminds me of the miners, and they are one of the best performing sectors this morning. It comes down to partly the performance of iron ore this morning, surging to the highest since early April. It's come off a bit of that high now, but green across the screen for that sector. BHP up 1.4% at the moment. They had a pretty upbeat assessment of their demand in China, and that's spreading across the sector as well.
Absolutely. It's fascinating when the commodity sector has been one that's very exposed to the China story as much as their earnings piece as well. I should mention that Burberry shares, which of course got the trading update at the start of the session, down by 0.6%. Coming up on the program, we switch from public to private markets. Private equity partner firm Apis Partners joining us in just a few minutes. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade. We're 30 minutes into today's session. Green on the screen across the board. The CAC 40 is your outperformer, though, this morning, higher by 0.4%. LVMH certainly helping that market. But again, light volume, light liquidity, which makes it the perfect day for a conversation about the private markets. Joining us now, Udayan Goyal, co-founder and managing partner over at Apis Partners, joins us around the table. Pleasure to have you. Thank you so much for joining us. We've spent about 90 minutes of the show talking about the volatility in these markets, when we're going to see the public markets start to crack. We know we're coming off of a banner couple of years for the private markets as well. How do you digest that? How do you marry the success of private markets in the last couple of years with the volatility we're seeing in the public ones now?
Well, volatility generally creates both issues and opportunities, right? I think the opportunity that volatility has created, particularly for deploying money from the private markets, what we call the dry powder, into the markets has been actually quite interesting, because it creates situations where you can either find interesting asset sales or stress situations or carve-outs where you can actually take interesting assets out during these markets. So at one level, the vol creates an issue. We've come off a pretty tough rates environment. So last 3.5 years, hangover from COVID, tough rate environment. That's made it quite hard for private equity exits over the last few years. We're almost at an all-time low in terms of what we call DPI, which is the exits, which then translates into money back to the limited partners who are the investors for the private equity community. And so now we're coming out of that a little bit as the rate environment improves. And obviously that creates opportunities now to exit and start to improve where we are.
Well, Udayan, the most common exit is a private company grows with some private funding and ultimately makes it out to the IPO. We're in an environment where capital markets aren't yielding that much success in terms of that path. What are the other options when it comes to deal exits?
Yeah, so 100%. The IPO market's been closed. It's been closed for the last 3 or 4 years. We're starting to see a little shimmer of light right now in the IPO market, but it's literally the beginning. We as a firm, we generally prefer not to do IPOs. We've, I think, done one IPO in our history, and then there's one coming up. Those tend to be in very specific markets where the IPO market tends to be, very resilient and largely in India. But the rest of the world, Europe, other places, pretty hard to do IPOs. So we really focus on strategic exits. So our focus is to go after those companies that are looking to fill a particular gap in their offering, where we've built a company that actually fills that gap. One of the things that we do early on is we figure out, we go and map our markets. We only do financial services. We map our markets, figure out which company has a gap where, and then we focus our attention to going and finding companies that we can invest that fills that gap, grow that company up in the 4 or 5 years to the right size, and go back to the same people. And we talk to those people in the beginning.
Yeah.
We have relationships. We actually talk to those people in the beginning. We get that input in. We actually figure out. So if you are a MasterCard or a Visa or somebody like that, you go and talk to the management. You say, so where do you have a gap? Where can we help you as a firm? Where can we work with you? And that's where, and then they come back and they buy it. And that's where you get the good liquidity. Our liquidity on our first 2 funds is top 5 in the world, right? Top 5% in the world. Since inception. So that's a very important thing. People look for that liquidity.
And when you're talking about that fintech focus, we've been talking earlier about the crypto bill passing and Jamie Dimon talking about the threat from fintech to traditional banking. How big of a threat is that when it seems to be going mainstream?
So I think it's a huge threat. I think people absolutely underestimate just how meaningful and just how transformative Web 3.0 and the whole crypto world is going to be. So you've seen the US administration has done a fantastic job around stablecoin, right? So they've come in, they've created the stablecoin legislation, it's gone through. We're now seeing things like Tether and Circle USD. The volumes are massive. In fact, if you combine them, they're more than Visa and MasterCard combined. So this is really becoming a thing. And some of our companies that are in the money transfer space are now starting to replace the way they move money across the world from the traditional rails, which is SWIFT and all the other things, to essentially stablecoin. So stablecoin is actually becoming a really, really important part of the financial infrastructure. Now, let me put it into context because it's quite interesting. I was talking to the treasurer of one of the largest companies in the world a few weeks ago, and we were having a little conversation. I said, so tell me a little bit about your stablecoin strategy. And he was like, expecting him largely to say, we do nothing in stablecoin. And he turns around to me and says, well, it's interesting you asked me the question. We are now experimenting with stablecoin. I said, what do you mean? I said, we have operations in 180 countries around the world. We need to move money all these places, right? So if you're running a big industrial conglomerate, you need to have cash in one particular country or cash in another particular country, and you need to do that pretty. And one of the problems with the regular banking sector is 9 to 5, right, or whatever the banking hours in a particular country.
Right.
So if he needs to move money out of hours, it's very, very difficult. And if he needs to do what's called a cash sweep, where he's picking up all his excess cash and putting it on deposit, he has to do that before the banking hours close. So what he's able to do with stablecoin is run a 24/7 infrastructure. So he's experimenting. Now that's a bit of a problem for Jamie Dimon and other people, right? Because what happens to their cash management? What happens to how they manage cash? It starts to move away from them into this frictionless world.
But nonetheless, for a lot of people, this is a very scary space. It's an absolute minefield.
Yeah.
How do you pick the winners if you're going to choose who to back in fintech?
So I think, look, picking the winners always up. So one thing is we don't generally go too early. So we focus very much on mid-markets, the companies that are actually generating cash flow, that have proven what we call market fit. So particularly the market fit and the product fit is incredibly important. So by the time we come in, we're starting to see this very interesting trajectory that typically fast growth companies, 20-25%, even more growth. And by that point, we've seen that they've sort of figured out where they fit into that market niche. The other thing that we focus on is investing in expanding markets, right? So if you think about these markets that are expanding, one of the things is we want to be on the crest of that wave, right? And as long as we're on the crest of that wave, and as long as we are maintaining market share, we will grow. And then obviously if we can increase market share, we grow even faster than the market. So I think that's part of the, what we're trying to do. If you think about areas within financial services, great growth. We talked about crypto. That's interesting. So Web 3.0, Web 3.0 infrastructure, stablecoin, super interesting. Embedded finance, single biggest area of growth in financial services. Today, the world's top 30 banks are worth $3.5 trillion. In 10 years' time, the embedded finance world will be worth $7 trillion. It's double the size of the market, right?
Yeah.
So, and then deepening of the digital economy. Every economy becomes more digital. As every economy becomes more digital, we need digital transactions. So you have people playing that. And finally, democratization of finance.
A snowballing effect, clearly.
Yeah.
Talk to us, finally, if you can, about kind of regional exposure. When it comes to a lot of the private players, there's a big question of maybe that you need scale to perform in this market, and a lot of the biggest American players are operating and deploying their massive piles of cash right here in Europe, feeding on this idea of U.S. exceptionalism being over, and that's something we see in the public markets as well. There's another angle to this, which is that perhaps if Europe is not the moment, Asia is. How are you thinking about regional exposure?
So we're actually unique because we're global, and we tend not to do a lot in the United States. And actually, Dow Jones, HEC, have a global private equity ranking. They do it for buyout growth and venture we sit in when the venture, there's never been a non-US firm in the growth rankings until a few weeks ago. We came in for the first time as a non-US firm as number 2, and there are 3 firms now in the top 10 that are non-US firms. This is the first time, and that actually plays to what you're just talking about, right? Which is finally we're starting to see a little bit of this activity outside of the United States, which is actually delivering huge results. By the way, in the venture rankings, almost all of them are non-US firms, right? So this is what's starting to happen. Now, to your point, I think the first wave was into Europe. So we're definitely seeing that first wave into Europe. You yourself on Bloomberg talked about Blackstone coming in, and I think the number was 500 billion that they're going to come into Europe for the next 10 years. This is definitely happening. The big firms are coming in. But the big firms play right at the top of the market, right? So they're doing very large ticket sizes, very large deals. People like us are pretty much in the mid-market. We're pretty unique. We're playing in that space. And I think to play in that mid-market, you need to have 2 things. You need to be a sector specialist. And by the way, in that ranking that I talked about earlier, almost every single firm, in fact, I think every firm is a sector specialist. So either healthcare, tech, financial services. So you need to be a sector specialist. That's the first thing. And you need to understand those markets, right? So I think people who have an established infrastructure in Europe and now, as you say, coming to Asia, I think Asia is a little bit more tricky, right? We haven't really seen that transition so far into Asia. You have some of the big firms like TPG and others that have reasonable infrastructure in Asia, but Asia is still there. I think the place that people, interesting enough, are going after, the large guys, is actually Japan, which is actually a huge surprise, right? I never thought that they would come after Japan, but Japan's been super interesting.
Well, we're going to talk Japan later in the program, especially with that election coming up. But Udayan Goyal, it's so great to have you around the table this morning. Thanks for starting your day with us. Udayan Goyal, who is co-founder and managing partner over at Apis Partners. Well, we started off that conversation talking about volatility. Of course, a lot of it comes back to the tariff chaos, and it's absolutely shaking global supply chains, forcing Chinese manufacturers in particular to rethink their strategies. Now, Bloomberg Originals has been exploring whether they're truly eyeing a shift to production in the US.
Navigating high-risk environments when you can't see what's ahead is no mean feat. But it's the kind of uncertainty Donald Trump's trade actions have forced on China's factory workers.
President Trump ramping up trade tensions again.
The word tariff, music to my ears.
So we're in the realm of just endless tit for tat.
This just kind of indicates how much of a moving target this has really become.
At stake is hundreds of billions of dollars in bilateral trade and access to the world's single largest consumer market, backed by American spending power.
This trade war basically leaves no one untouched, whether that's investors, business people, or officials in any country.
It just seems like every manufacturer in China realizes that they need to have strategies in case things get worse.
2 things are becoming clear, though. One, that finding a replacement for the mighty US consumer is as essential as it is difficult. And 2, that despite all the tariff chaos, Chinese manufacturers aren't rushing to shift production into the US.
Americans don't want to make spatulas. They want to eat hamburgers. And I don't mean that in a negative way. I want to eat hamburgers too. But I'm here in China making the spatulas to do it. Americans don't want these jobs. And to think that manufacturing would go back to the United States is a farce.
And of course, subscribers can see the full documentary right here on the terminal or at Bloomberg.com. It'll be available later on Bloomberg Originals' YouTube channel as well. Coming up on the program, high stakes for Japan's prime minister in Sunday's upper house elections. We're going to talk FX with Jane Foley from Rabobank as Tokyo struggles to secure a trade deal with the United States. That discussion next. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Oil on the rise this morning as the European Union approves a fresh sanctions package on Russia over its war against Ukraine. The measures include a revised oil price cap and now banking restrictions after Slovakia lifted its veto. For more, let's bring in Bloomberg's Ben Sills. He joins us out of Madrid and leads some of our European coverage. Ben, can you just walk us through how all of this works? It feels like this is the first time that sanctions include not just Russia, but the other countries helping Russia.
Yeah, so what this is going to involve is the EU's taking the existing oil cap, which was agreed with the rest of the G7, and they're going to lower it to a price which is going to be fixed every probably twice a year based on market rates, but it's likely to be about $15 below the market rate, we understand. And it also includes restrictions on a Russian-owned oil refinery in India, which could potentially hit the supplies of diesel both in India and also back into the EU.
And so significantly, how significant is this going to be, Ben? Not just in terms of the oil price, but in terms of obviously the geopolitical impact that it's meant to create?
Well, I think it's not a silver bullet, but it's not nothing either. We saw the oil price creep up a little bit this morning when the measures were announced. We've seen also diesel prices increase. At the same time, we know that Russia has well-established ways of getting around this cap by using shadow fleets and that sort of thing to ship crude to countries like India and China. The issue really, I think, is when you look a little bit further down the track to Donald Trump's threats of secondary sanctions on countries who are doing business with Russia. The oil cap in that context could become a lot more significant. But of course, that depends on whether Trump is ever really going to get serious about following through on those threats against Putin.
Okay, Bloomberg's Ben Sills, we thank you for the update on that latest on Russia sanctions. And of course, this feeds into the central banking story, the inflation story as well. Fed officials divided over the central bank's rate policy path, and some encouraging further cuts, but others supporting a wait-and-see approach.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs that are not unanchoring inflation expectations, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
So I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
I find it appropriate to hold our policy rate at the current level for some time.
Well, the dollar moved lower on those comments by the federal governor, Christopher Wallace, saying that policymakers should cut rates this month. But how long will that last? Joining us now to discuss is Jane Foley, FX strategy head over at Rabobank. Morning, Jane. Thanks for being with us. Let me ask you that question. Is this dollar weakness story overblown at this point?
Well, if we look this month, I think the dollar is still the best performing G10 currency in the month to date. So we have been having this rotation, back into the dollar this month, just as we had really from last month, this rotation back into US stocks. And I think there may still be a little bit more, catch up for the dollar to take. So a little bit further gains for the dollar. But clearly there is noise out there. And clearly, the comments from Waller, they did impact asset pricing, and they do impact psychology, because we know that Waller, for instance, is one of the candidates that could be out there to replace Powell. So, the market is also thinking, is this a political move by him? After all, yesterday's data, the retail sales, the initial claims were a little bit better. So they don't necessarily support the view of an immediate interest rate cut being needed from the Fed. So there is this concern that already the very dovish tone of Trump is soaking in to that of some of the Fed members' talk.
Well, of course, Trump sparked all this speculation that maybe he was going to oust Chair Powell, and then he flew the kite, he brought it back down again, but we did see a market reaction. How would that market reaction to compare to what would actually happen if he did oust the Fed chair? Because many saying that you ain't seen nothing yet.
Well, this is it. I mean, I think everybody will agree that, the issue of Fed credibility is really important, in terms of just an anchoring of inflation expectation and anchoring of secondary inflation. So, for instance, things like payroll increases, if that's why credibility, that's why inflation expectations are really important. I think everybody agrees on that. But, there are a number of economists out there, very high profile economists who do believe, a bit like Trump, that the Fed, needs to cut interest rates now. And that view, of course, will counter the concern that the Fed could lose its independence. Many think, well, this is a reasonable view, and whoever the president does appoint is likely to be an economist with good credentials anyway. But of course, this is an ongoing, a developing debate. We'll have to see what really does happen, because there is still the big concern by the other side of the debate that the credibility of the Fed, could be compromised.
Jane, the Fed credibility is one aspect to the dollar moves, perhaps, in the interest rate story. The other is not only tariffs, but the deficit story as well. As we approach the X date in late August, early September, whenever it does come, I'm curious if concerns around the deficit, which are largely expected to move yields higher, are dollar positive or dollar negative?
I think that's a really good question, because, if you'd asked me that last year, I think everyone would have said, well, this exceptionalism story of the US dollar means that, generally speaking, the government can borrow at lower interest rates than would be otherwise. It can run a bigger budget deficit than would be otherwise. I mean, bear in mind, of course, the US budget deficit at the end of last year was bigger than France's, and we were all panicking about France's. That, to me, is the dollar's exceptions, the US exceptionalism story. But, of course, roll into the first part of this year, and we were all saying, has that exceptionalism story been stripped away? But, I think probably what we were seeing in the first part of the year was just overinflated expectations, perhaps for the US economy, overinflated expectations for the dollar, and those now have been taken out. The market is now probably short of the dollar, certainly not long, and I think that suggests that the US dollar is now going to be a lot more resilient to bad news, perhaps, in reflection of the way it has been for years, than it was in the first part of this year.
Jane, that, of course, is the dollar story, and we'll see how that all shakes out. The other story, of course, we've got a very close eye on is what's going on in Japan. The upper elections due this weekend. Can you just walk us through your scenario analysis of what kind of impact we might wake up to when it comes to the yen on Monday morning?
Well, of course, we know that the LDP did lose the coalition at the end of did lose the lower house majority at the end of last year, and that was probably a badly timed election call from Ishiba. There is speculation that if he were to lose the upper house majority this year, this summer, well, he could be forced to resign too, and then we could get another leader of the LDP, another prime minister, who could be willing to spend a little bit more money on fiscal policy, which clearly has implications for inflation and for the long end. But, whilst there will be knee-jerk reactions on Monday and through the end of next week and perhaps through to the end of the month, I do think it is still the Bank of Japan that the market is going to be focused on. And we've got to remember at the end of this month, the Bank of Japan could revise higher one of its inflation forecasts. And if the market still believes that the Bank of Japan is still in a cycle of hiking interest rates, albeit perhaps not till the end of this year, beginning of next year, then I think the yen will still slowly come back and win back some ground.
Well, yeah, we saw Japanese inflation still elevated in the overnight data. We've got the Treasury Secretary Scott Bessent in Tokyo today, meeting Prime Minister Ishida. Given how slowly the trade progress is going, Jane, how much of a hawkish message do you think that we will see out of the BOJ?
I think they will, of course, be careful. I mean, the meeting from the Bank of Japan is July the 31st. I think they'll be hoping that there is some positive news on trade after that. The election, the timing of the election has certainly impeded these trade talks with the US because, after all, Japan doesn't want to be seen as losing too much face, giving in to Trump, giving in or making too many concessions. I think Japan went into these trade negotiations thinking it had a strong hand. It is, of course, the largest provider of FDI into the US. It's got, as a base for US troops, for instance. It's been promising to step up its military might to buy more weapons from the US. Some of the car manufacturers have been promising to expand their facilities in the US to make use of the US consumer, if you like. So they thought they had a good hand. They do not want the auto sector to be, to have to take too many concessions. So, but I think once the election is done, I think the risk of getting a deal certainly goes up.
Absolutely. Jane Foley, head of FX strategy at Rabobank, previewing the upper election in Japan this weekend. We thank you so much. Speaking of what's going on this weekend, there's a couple of fun things on the agenda. I hear the Open Championship is coming up, as well as the Tomorrowland Festival, Lollapalooza in Paris. I know there was a French edition, and some boxing, which I hear you have some interest in, Lizzie.
I'm going. It's in Wembley. I have no idea anything about the boxing. I'll be very excited for all the sweat and the blood. Apparently it's a 27-year-old and a 38-year-old, and the Ukrainians unbeaten, and the Londoners going to try and do what no one's done before.
News you can use.
I'll be ringside.
Absolutely. It's a fascinating one. Well, speaking of the weekend, of course, there's plenty to catch up on. The Bloomberg Weekend newsletter bring you a collection of interviews, ideas, and stories that explore the fascinating places where finance, life, and culture meet. But of course, for Bloomberg television purposes, there's one interview you want to watch, and it's with Fed's Christopher Waller this morning, 1 p.m. London time. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Time to cut. Fed Governor Chris Waller calls for a rate cut this month to bolster a job market he describes as on the edge. The global stock rally continues after Wall Street equities notched another record as U.S. retail sales rebound, easing concerns about the health of the U.S. economy. Plus, the EU backs a fresh sanctions package on Russia over its war against Ukraine, including a revised oil price cap and new banking restrictions. Let's get to the market reaction. Oil, of course, front and center on the back of that package after Slovakia gave the green light. We'll see when that gets passed, expected by the end, potentially the end of today. It's the 18th package in terms of sanctions from the EU targeting Russia. The equity story in the upside continues today after the record gains for the S&P and the Nasdaq yesterday. S&P futures now looking to add a further 0.1%. The US 10-year at 4.43, yields down 1 basis point. Money moving into US Treasuries. Chris Waller, the Federal Reserve Governor, saying the Fed should cut, and they should cut this month. Euro-dollar at 1.16. The dollar is down on those comments from the Fed Governor, Chris Waller, and others. Mary Daly over at the Federal Reserve Bank in San Francisco also suggesting that 2 cuts are appropriate this year. $69 a barrel on Brent, up 0.4% on the story around additional sanctions on Russia. Let's flip the board and have a look at how the map is shaking up. UK equities remain close to those record highs that they reached earlier this week, up 0.2% on the FTSE 100. A strong session over in France with the CAC 40 up 0.6%, and the DAX over in Germany also gaining 0.4. Across your sectors, it's energy and basic resources at the top of the list. On the downside, healthcare is a sector that the last time I checked was in negative territory. That is a check across your map in terms of the equity story. Let's get to the story then, and the main news of the day, of course, the pulse starting right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, happy Friday. Welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua this Friday. Now, Federal Reserve Governor Chris Waller, as I mentioned, says policymakers should cut U.S. interest rates this month to support a labor market that he says is showing signs of weakness.
I believe that the Federal Open Market Committee, or FOMC, should reduce our policy rate by 25 basis points at our next meeting. So with inflation near target and upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate.
Has President Trump or anybody from his administration talked to you about potentially taking Powell's role?
Nope.
Okay, let's bring in Bloomberg's Valerie Teitel. Valerie, is this a job audition for Chris Waller, of course, of the Fed, or is this a genuine concern about a labour market where we saw the jobless claims data yesterday suggests there's still a bit of resilience?
Look, you can definitely argue both, but this has been a consistent message since the beginning of the year from Governor Chris Waller. He's erred on the dovish side, saying he's not worried about the temporary one-time price hike from tariffs causing persistent inflation. He is more worried about the downside risks to growth. And definitely in this speech yesterday, Tom, he was setting up his reasoning for perhaps a dissenting vote at the July meeting in 2 weeks' time, saying that he's been looking at the labor market and he is getting a picture of a labor market on edge. He then goes on to say some pretty stark words about the labor market. At the same time, as you mentioned, we did have jobless claims come in better than expected. Even NFP last month came in better than expected. But to his mind, there are still a lot of revisions you have to take into mind. He wanted to revise out the additional public jobs that were added to that number in June. He also was notably talking about the BLS revisions that we've seen, maybe overestimating payrolls this year. So in his mind, the June NFP was actually in contraction, showing that the labor market is starting to show sign of cracks. Now, I do want to mention that he's also talking about the fact that the immigration policy from President Donald Trump is in some way warping this data. And you could argue in some manner it's been warping and distorting the jobless claims figures, which have fallen now for 5 straight weeks, the longest, I guess, winning streak for jobless claims in nearly 2 years. But in Governor Waller's mind, this comes down to distortion around the labor market, around the possible foreign-born workers leaving the labor market, instead of saying anything good about the jobs market in the U.S., and he is backing an urgent rate cut in 2 weeks' time.
Okay, and we'll see if others align with that view. Of course, it's the blackout period at the end of today, so 2 weeks, and then we have that decision, of course, from the Fed. Bloomberg's Valerie Teitel, in terms of how to think about the labour market, at least one view on maybe some fragility there as we look at money moving into the Treasury markets. The benchmark 10-year currently yielding 4.43, yields down 1 basis point. And a reminder, Christopher Waller joins Bloomberg Surveillance at 1 p.m. UK time, so certainly stay tuned for that interview before the blackout period, of course. We'll get more insights in terms of the views of the Fed governor. Now, the US is to impose preliminary anti-dumping levies on imports of graphite from China, saying it has been unfairly subsidized. Graphite is a key material used to make batteries. The 93.5% duty comes after US graphite producers asked for investigations into whether Chinese companies were violating anti-dumping laws. Let's get more from Bloomberg's EMEA News Director, Ros Madsen. Ros, how do you view then this additional duty on graphite within the context of the broader trade relationship?
Well, that is the big question. I mean, this is preliminary, as you were saying, so there'll be a final decision probably around December. So there's a bit of time here, but this is a key product, as you were noting, for in the battery space, in the EV space, and led by these US graphite producers accusing China of essentially subsidizing this product into the US. But you can imagine also for companies in the US, this is quite worrying news. Tesla, for example, will probably not be that happy if this does go through. And it comes at a time when you can see the White House working hard to actually reset the relationship with China. Donald Trump very much seemingly wanting that meeting with Xi Jinping perhaps before the end of the year. You know, there is a real effort to kind of like bring those ties into a better frame. And so would this impact that? Well, potentially. It does seem like it's a very targeted commerce action for now, and it's not final. And so hopefully they can put that in say, this is actually something very targeted. It's not about the broader relationship. But as you know, everything somehow does seep into the relationship. And we've seen things like this, torpedo a positive moment before. I mean, we've seen things like the Chinese surveillance balloon that suddenly was accused of like flying spy balloons over the US, torpedoed the relationship as it was on an uptick previously. So we've seen this happen. Is this the thing that's likely to do that? Not necessarily, but it's going to be interesting to see the reaction from China in particular to this one.
Okay, so we watch for that Chinese reaction potentially to that development. In the meantime, Scott Bessent, the Treasury Secretary, of course, of the US, is on the ground in Japan. Does that signal that we are getting closer, that the US and Japan are getting closer to a deal?
Well, yes, maybe, and no, maybe. It seems quite fraught. I mean, you saw Donald Trump talking yesterday again about Japan. His language is not particularly positive. He's accusing Japan again of sending, you know, all these cars to the US not sending cars to Japan. Again, the protective veneer that Japan puts around its agricultural sector in particular. And so he is there meeting with the Prime Minister. He's also meeting with the chief Japan negotiator this weekend. But we've also got Japanese upper house elections, you know, in a matter of days. And these are looking pretty fraught for Ishiba, the Prime Minister, and a question about whether, you know, he will suffer in those elections. And of course, you know, when you're looking at elections, protecting and supporting key sectors like auto and your farmers become very important. So there are a lot of roadblocks here to getting towards a deal, and certainly to announcing something before the election that may not be so favourable for Japanese automakers and for farmers. So we're possibly, you're not going to see major news this weekend on it.
Okay, domestic roadblocks potentially to any trade deal with the US at this point, given the politics of Japan. Bloomberg's EMEA News Director Ros Matheson with that update. Ros, thank you. Now, finance ministers and central bank governors from the world's biggest economies are meanwhile meeting in South Africa at the G20 summit. The gathering is taking place against the backdrop, of course, of that presidential trade war, President Trump's trade war at least. Let's head across to Ballito near Durban and join our correspondent Oliver Crook, who's on the ground and has a guest with him. Ollie.
Yeah, that's right, Tom. I like that, the presidential trade war. That is sort of casting a shadow over these meetings here at the G20, multilateralism in the age of MAGA, and we'll be very pleased to be joined now by the Dutch Finance Minister, Ilko Heinen, who will join us now for his perspective and insights on the discussions that have been happening here at the G20. I'd like to start, if we may, just on those trade negotiations. We're now less than 2 weeks away from that deadline from the United States. Do you expect that the European Union will get a deal with the United States before August the 1st?
Well, we're working hard on it, and of course we need a deal. I think it's in the best interest of both countries, both nations. But we'll see. We saw it being postponed before, so yeah, we'll see.
Yeah, so in any sort of negotiation, there's always the stick and the carrot side of things. I know that everyone has been playing more on the sort of carrot end of things, not to upset the Trump administration. In this sort of last 2 weeks of these negotiations, does the EU need to take a slightly harder stand to demonstrate the kind of pain that this would cause the United States? For example, the anti-coercion instrument, is that something that the Dutch would favor potentially putting on the table and potentially looking at U.S. services as well?
Well, all the time we're saying we need a deal. We need to de-escalate, and free trade is in the best interest of both. So that's what we're working on, but the European Union cannot sit still. So if we don't have a deal, we are forced to retaliate. I keep expressing it's not what we want, but it's on the table. And I'm not going into specifics right now because we're in the middle of the negotiations. But Europe is a large trade bloc, and once again, we cannot sit still.
And of course, the Dutch sort of sit at the sort of center of global trade in many respects, but also at the center of the world of semiconductors and chips, with ASML, the great champion, being a Dutch company, one of the biggest companies in Europe. What are your concerns around what we're hearing about tariffs potentially in the world of chips? What has your kind of contact been with the United States about potentially looking for carve-outs for chips? And what are you sort of trying to lobby the EU to speak on your behalf on the question of semiconductors?
Well, we're not in direct contact to the Netherlands and the United States administration. Everything goes to Brussels, to the European Commission. So we are united in this, and of course we fight for the interest of the Dutch economy. ASML is a big part of that. It's an important company. It's also an important company for the United States, of course. So that's what we keep expressing.
And so what are you, so in kind of lobbying, because obviously every member state has its input to kind of the message that Brussels brings to the United States, what would you like to be part of that message on the question of semiconductors?
Well, I'm not going to specifics on semiconductors, but what we keep saying is like we need free trade. Free trade is in the best interest. Tariffs don't work. And if you are concerned about your trade deficit, you need fiscal consolidation, and you don't need tariffs. It's just a tax on American consumers. It will increase inflation. It's a bad thing, and that's what we keep expressing.
And one of the concerns that we've had in Europe is with the trade barriers between the United States and China elevating, a lot of that capacity coming over into Europe, which is really the only market that's comparable to the U.S. at absorbing some of that capacity. That, of course, threatens some of the competitiveness, which is one of the great priorities of the European Union at the moment. Do we need higher trade barriers with China in Europe in order to prevent that from happening?
Well, of course, we don't want dumping from Chinese products on the European market, which is going to hurt us again. And the United States is then concerned that the surplus in Europe will go to the United States. So this is an example that trade wars is not in the interest of anybody. So, but the European Commission is monitoring this very closely.
The European Commission has also put out a proposal for a budget that we got a couple of days ago. 2 trillion euros is the figure. We've had displeasure aired from Berlin. We've spoken to the Swedish finance minister here as well, who has had an issue with that figure. Is 2 trillion too high?
It's too high, and this proposal is dead on arrival.
Okay, how high? Too high by how much?
That I'm not going into, but for us, the Netherlands, I keep saying we need a smaller budget, not a bigger project, which means we need to reprioritize within the budget. And I don't think it's we should start with who can we tax, how can we spend more. We need to spend less, and that counts for both sides of the Atlantic.
Yeah, and I'd like to get your view also particularly on the corporate taxes that have been suggested by the EU, particularly in the spirit of this competitiveness that they're also trying to put forward. Your stance on that?
Well, of course, I'm not in favor of that one. But once again, I don't want to start the discussion about who can we tax. The discussion should be about the budget, how can we reprioritize, and how can we spend less. And the starting point can never be to tax, and especially specifically not companies.
And so the sort of volume, the number is one side of it. The other question is also priorities. Are you broadly aligned with the priorities of the EU budget? Where would you like to see the sort of money shifted, not just in terms of its volume, but its concentration within the priorities?
Well, we have new priorities, so security is, of course, a very important one. Innovation is a very important one. So these are the areas money should go to. But we are now at the starting point of negotiations. It will take 2 years, so I don't want to go ahead of things. But I think the position of the Netherlands is quite clear.
And on the question of defense, there's 100 billion euros that has been planned for Ukraine. Are you in favor, at least, of that part of the budget?
Yeah. So we need to keep supporting Ukraine. That goes both military support, budgetary support, and of course keeping pressure on Russia and putting extra sanctions on Russia.
And we heard from Donald Trump a little bit earlier saying that he's willing to sell more weapons to Ukraine if NATO and Europe pays for it. I'd like to get an understanding of what the Dutch's role is going to be in that. How much of that will come from a national budget? Do you see that being potentially done at the EU level? How are you thinking about that?
Well, actually, this is being discussed right now, so I'm talking about this with my colleagues in the European Union. How can we organize this? But I'm very glad to hear from President Trump that he continues his support also for Ukraine. Of course, there's also a monetary point in that. So who's going to pay for that bill? I think it's clear that Europe should pay for it, and how is now part of the discussions we're having among each other.
And I'd like to just get a flavor of some of the meetings that you've had here at the G20 with a lot of different sort of finance ministers, central bank governors, and this idea of multilateralism, this architecture that was really brought in by the United States, which the United States is basically now absent from. Bessent is not here, for example. How is that changing the sort of conversations that you're having in these rooms? How is it reordering in your mind and kind of the arrangement of multilateralism across the world?
Yeah, well, actually, everybody's quite vocal about the importance of free trade. So that's the good side of this discussion, that now everybody speaks out in favor of free trade, that we need less tariffs. So actually, we're quite united in this.
Ilko Heinen, thank you so much. The Dutch finance minister here joining us from the sidelines of the G20 meeting. Again, this question of multilateralism in the age of MAGA and where these sort of trading relationships can now blossom further when the United States is receding from the international trade system.
Bloomberg's Oliver Crook on the ground for us with strong lines coming through, of course, with the Dutch finance minister at the G20, particularly when it comes to that EU budget proposal. €2 trillion EU budget proposal is, quote, dead on arrival, according to the Dutch finance minister. Ollie, thank you very much indeed. Coming up, US stocks hit new records. So is US exceptionalism back in action? I'm going to be joined by an investment strategist who advised clients to stay the course during April's sell-off. That's coming up. This is Bloomberg.
multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. So the S&P 500 hitting another record yesterday after strong retail sales data reassured investors about the health of the U.S. economy. Joining us now is Matthias Deboer, Managing Director in the Investment Strategy Group at Goldman Sachs Private Wealth Management. Matthias, thank you for joining us in the studio this Friday. So we had the retail sales data that came in stronger than expected with an increase of 0.6% on the month. And then the jobless claims falling for a fifth straight week, suggesting that at least on the surface, the labour market of the US remains relatively resilient. Is it your view that that relative resilience continues through the end of this year for the US economy?
That's right. So it is our central case scenario that the U.S. economy will not fall into a recession over the next 12 months. We do think growth will slow sequentially in the second half of this year, but the reality is GDP is going to be a very distorted measure of economic activity because of all the front loading that we saw in Q1 and the payback we'll see in Q2. But as we look at the underlying indicators, they continue to point to a resilient consumer, which drives 70% of U.S. GDP. So as long as the labor market remains okay, which it seems to be the case, we think the consumer will be okay as well.
Chris Waller calling for a cut this month and pointing to the labour market and saying if you strip out some of these indicators, some of the data, it suggests a weaker labour market than maybe some are assessing. Is the Fed governor wrong on that count?
So we are seeing signs of softness in the labor market. So initial jobless claims have trended a bit higher. New job postings have trended a bit lower. Private sector payrolls were soft last month. So there are enough signs that perhaps the Fed should start cutting soon. Our base case is that they will do so starting in September and that they will cut rates 3 times this year. So we think they will wait a little bit longer just to assess the data and look at the impact of tariffs on inflation and then the labor market before making their next move.
And that is against consensus, 3 cuts this year, because the markets, or at least the money markets, are pricing in just shy of 2.
That's correct.
And so just to be clear, the factor that leads to 3 cuts is less an inflation story and more a labour market story for the Fed, in your view?
That's correct. We think the Fed will view tariffs as a one-time adjustment in the level of prices of targeted items and not the start of a broader inflationary cycle, given the backdrop of a slowing economy and a soft labour market.
So transitory inflation, would you go that far?
We do think it will be a one-time increase that will drop out after 12 months. So it could be possible that if the Fed waits too long to respond to the softening in the labor market because of a temporary increase in inflation, it could be that they would be behind the curve.
On the question of tariffs, what assumptions are you and the team making as we lead up to August the 1st as to where, in aggregate, tariffs settle?
I think no one really knows. Our assumption is that tariffs will end up between 15 and 20%. So it's a wide range, but we don't know exactly. Of course, I don't think anyone does. But that is a 7, if you take the midpoint, that's a 15 percentage point increase relative to where we were at the start of the year. So again, it will lead to more inflation. It will lead to slower growth, but we don't think it leads to a recession.
And how are you looking? Where are you looking in terms of the tariff impact when it comes to the earnings story? We've had the banks reporting, very strong, of course. Which parts of the earnings story are you zeroed in on to try and get a sense of that tariff pass-through or not?
Yes. So we will be watching the consumer stocks really and what the companies say. I think guidance will be even more important to see how companies are handling the tariffs. So far, to your point, the Q2 earnings season is off to a very strong start. Only 10% of companies have reported, but almost 90% of them have beaten on EPS. So it's off to a strong start.
In terms of the Fed and the question around independence, as the pressure from President Trump continues on Fed Chair Jay Powell, his term, of course, coming to an end in May of 2026, do we still have an independent Fed in 2026?
So we did see, based on the market reaction that we saw on Wednesday, that the market is worried about that, right? When the news came out, we saw lower equities, a weaker dollar, and a steeper yield curve, which intuitively makes sense and seems to suggest that market participants are indeed worried about it. And in fact, Fed independence has served the U.S. economy extremely well for decades. The reality is no one really knows what is going to happen. We need to watch who the next chair would be. And even then, we have to remember that, A, we think the case for a rate cut is already quite strong starting in September, and B, the FOMC chair is quite influential, and the market participants will pay attention to every single word they say, but at the end of the day, they're just one vote out of 12 when setting interest rates at the FOMC.
Do you want to start advising your clients to position for potentially a firing of Jay Powell before the term ends in May 2026, or you're not going that far yet?
No, we think in this environment when there are just so many uncertainties facing investors, now is really not the time to be making huge portfolio bets. So we think sticking close to your strategic asset allocation and staying the course in equities in particular makes a lot of sense.
Okay, when it comes to the dollar story, given the pressure the greenback has been under at least year to date, how much downside is priced in at this point? Are we starting to find a floor for the greenback?
Yes, our view is that the U.S. dollar will remain broadly range-bound into year-end. We have seen already a sizable move in the U.S. dollar, and it still looks overvalued. But if you look at where that valuation is coming from, it's really because the dollar is expensive against Asian currencies, most notably the yen and the renminbi. The dollar is broadly fairly valued against the euro and actually undervalued relative to the Swiss franc and the British pound. So on the basis of valuations alone, we don't see a compelling argument as to why the dollar would need to weaken significantly from here.
Okay, and we watched the yen after the elections, of course, of Japan this weekend and see what the movements are, given the fiscal spend that is expected from some, at least, from whoever takes the reins of power. In terms of the fixed income space, then, we've seen a bit of stability in terms of treasuries after the blowout of yields post-Liberation Day in April. What is your view in terms of how the curve reacts going forward, and how much is priced in around the fiscal spend and the budgetary impulse of this U.S. government?
So yes, compared with current policy, the tariff revenues and the One Big Beautiful Bill Act will put the U.S. fiscal trajectory on a better path. But it remains uncertain.
It puts it on a better path?
On a better path. But
we're looking at maybe $3 trillion being added to the deficit.
That's right. But it's better than relative to current policy, right? The thing is, that trajectory does remain unsustainable over the very long run. So something will still need to be done. A fiscal adjustment will still need to be made in the future. But as we like to say, Rome wasn't built in a day, so it was just not realistic to assume we would be back to fiscal sustainability in one go.
And given your assumptions around the Fed cutting 3 times this year, do you want to lean into the front end?
So our recommendation is exactly. So we typically tell clients to target a duration of 4 years in their portfolios, and that continues to be the case. We think that 4 years is sort of the sweet spot between getting enough of a hedging benefit if equity markets go down from duration, but not being at the very long end of the yield curve where volatility is just much higher.
Okay, Matthias, thank you very much indeed. Matthias de Boer with some really smart insights in terms of these markets, given the volatility and the uncertainties around tariffs. Managing Director and Investment Strategy Group, Goldman Sachs Private Wealth Management. Coming up, we're going to explore the outlook for oil as the EU agrees to a lower price cap for Russian crude. We're going to be joined by Marcus Garvey, Head of Commodities Strategy at Macquarie. We'll also get his views on gold. That is next. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. Time to cut. Fed Governor Chris Waller calls for a rate cut this month to bolster a job market he describes as on the edge. The global stock rally continues after Wall Street equities notched another record as U.S. retail sales rebound, easing concerns about the health of the U.S. economy. Plus, the EU backs a fresh sanctions package on Russia over its war against Ukraine, including a revised oil price cap and new banking restrictions. More on that story now. Oil gaining then today as the EU agrees to that lower price cap for Russian crude, and data showing the US economy is holding up, of course, despite the fallout from the US-led trade war. We're joined now by Marcus Garvey, Head of Commodities Strategy at Macquarie. Marcus, great to get you on, great to get your views, particularly in light of this news around the EU and this 18th sanctions package targeting Russia. Does it move the dial, do you think, in terms of the oil complex ultimately?
I think as the market's pricing today, it's a pretty modest change in risk premium in terms of initial response, that no one is assuming that we're immediately going to lose barrels. And I think the backdrop to that really is twofold. We've had this extended period with multiple rounds of sanctions changes, and we haven't actually lost any Russian crude supply. So I think an understandable market response. And that also the backdrop to the market is that we have roughly sort of, in our view, about a 2 million barrel a day global surplus. So unless you actually did see this have a really substantial impact on Russian export volumes, you're not likely to tighten up the global crude balance particularly quickly.
How seriously should we be taking then the threat from President Trump of a 50-day deadline? We know these deadlines move, but potentially secondary tariffs on Russia, targeting India and China, the main buyers, of course, of Russian oil. How seriously should we be taking that threat?
I think that's a bigger threat than what we've seen today, in terms of if you get that, or also the package that's going through Congress at the moment, which is talking about 500%. But I mean, when you get to a 500% or 500% tariff, you're either way, you're effectively saying, well, we're going to be stopping trade. So it becomes a little bit academic. If you were to see that come in, then I think it becomes a much bigger debate about, are we actually going to see something that starts to change? And there, I think the thing that becomes complicated is you're going to move beyond just, well, how is this impacting the oil market, to how is this integrating with the broader reciprocal tariff negotiations that you've got as we see into August, and you have things like the Geneva truce deadline coming up for renewal. Also, you still don't have clarity on where you're going to land on reciprocal tariffs with India. So it then becomes part of that bigger puzzle, I think, in terms of whether it's just an oil issue or where you land in terms of that full negotiation, because it's going to be part of that debate.
And you mentioned that 2 was it 2 million barrel a day surplus?
Give or take.
Give or take. 2 million barrel a day surplus for oil. Is that a demand story or is that an output story from OPEC Plus?
It's a really good question. I would say on an underlying trend basis, a lot of that actually is that demand growth is just pretty slow now. If you look at China, for example, we would argue that transport fuel demand in China has peaked really because of the arrival of EVs and the pace at which they've been gaining market share. And then on an underlying basis, also on the supply side, I think shale supply has continued to beat almost everyone's expectations. If you look, not say this year specifically, but we look at, like, say, the past 5 years. And then, to exactly your point, you've now had that faster than expected ramp back up in terms of OPEC plus supply that's put the market into a heavy surplus. A key issue, though, there is that if you look at how the inventories have evolved year to date, it doesn't suggest necessarily that the market is that loose, because so much of that surplus is actually built in China, that China's probably built 1 million or so barrels a day of inventory, and actually that the rest of the world has been comparatively tighter. And so that's actually kept the market, in terms of like the physical market indicators, I'd say, in healthier shape than that kind of headline balance would otherwise suggest you would expect them to be.
Are you seeing any indications that the Chinese demand picture is going to evolve in terms of drawing down those inventories and pulling in more as the economy reaches for that 5% growth target?
I think if you had a bit of a price spike, maybe just on geopolitical risk premium or something did genuinely tighten the market up, then you might see China reduce imports and you see some of that inventory get drawn down. I think in terms of an improvement in end demand, we're not seeing anything that would really suggest that at the moment. That transport fuel picture is relatively structural in its dynamics. And if you think about some of the more cyclically sensitive parts, the thing that could really move it, let's say, for example, construction picked up meaningfully and you saw a pull on diesel because of that, we're not really seeing anything to suggest. And if you look at, say, higher frequency indicators from some of the other commodity markets that are really close to that construction piece, say the amount of construction steel volume that's trading on a daily basis in spot markets in China, it remains very subdued, and we're not seeing anything on the policy sort of push that would suggest to us that's going to change quickly.
Okay, so in terms of some of those structural drivers for China, no huge turnarounds right now in terms of that demand picture. We know the real estate sector, of course, in China remains under pressure. But you talked about the geopolitical risk premium. Has that been completely priced out at this point? As we look at Brent around at $70, just shy of $70 a barrel on Brent, is that geopolitical risk premium all out of the pricing right now?
Maybe hard to say it's all out, but it's very, very low. I think that
is that surprising?
I think it's not surprising in the context of both that point in terms of what we've seen in terms of not losing Russian barrels, and then also we obviously had the Iran-Israel situation recently. The market again discounted it very quickly, and that also comes off the back of a series of Middle Eastern disruptions that also haven't led to any meaningful supply losses. So the market's got itself understandably into a mindset where these things are not actually going to see barrels taken away from the market, partly because I think just on a policy basis, what we've seen the US really show repeatedly, as well as other Western governments, is that they don't want to disrupt supply of oil. Maybe something will change that, but that has been the consistent policy approach. And so it's an understandable reaction from the market. The obvious point, though, is that does leave you in terms of the risk skew with a distribution that actually, where's the big surprise? It is to something that actually finally led to a meaningful loss of supply. The one caveat to that, I'd say, is we still have a reasonable amount of spare capacity. So unless you had something like, say, a Straits of Hormuz closure, where some of that spare capacity couldn't come to market, you're unlikely to see the market get really sustainably tight unless you had a very large supply hit.
On the question of copper, 50% tariffs being threatened. Are the distortions in the copper market, have they been worked through, given that 50% tariff threat? Where are we in terms of the copper market adjustments to that?
Still very much ongoing, and I think still very uncertain because we don't know the full details of what that tariff is going to land on. Not just in terms of that headline number, let's assume that 50% number is what we get, but which forms of copper does it apply to? Are there any restrictions on trade associated with it? Because as much as the US is a net importer of copper metal and also copper products, they export a lot of copper scrap. So broadly speaking, the imposition of this tariff is net bearish for the LME price, and we've seen a bit of a pullback in price because you'll lose this excess US demand as people have front-run tariffs and pulled metal into the US. And so you'd expect LME price to fall a bit. The CME price in the US goes up because it has to reflect that tariff. We've seen that move up to a 25% premium at the moment, so it's not gone to the full 50. But what if you actually got something like a scrap export ban? That's not a base case, but it's a meaningful risk. Suddenly,
you would lose about 500 to 600,000 tons of supply from the US that comes to the rest of the world, and you'd actually tighten up the rest of the world market, and it would become a bullish dynamic. So you've still got quite a few uncertainties to work through. I think where we would expect the market dynamics to land, assuming you get that 50% tariff, is the US premium should probably be between, say, 35 and 40%. But then what happens is, as you work down the excess inventory that has been built in the US ahead of this, you'll get this gradual sort of decay into pricing a near 50% tariff right at the front end of the curve in the US, because then you'll be pulling in marginal import material. But until you've worked down, give or take, a 400,000 ton excess stock that's been accumulated in the US, you don't need to price in the full tariff, and so it's reasonable that the market isn't doing that yet.
Okay, mapping out the scenarios really nicely for us in terms of the questions that still need to be answered for the copper market, and depending on those questions and those answers, that copper market and the pricing adjusts with maybe a 35 to 40% premium in the US market initially, at least. Marcus Garvey, head of commodity strategy at Macquarie, in terms of insights, of course, into the oil markets and copper as well on those tariff threats. Now to the banking space. HSBC is disbanding a team focused on identifying and managing geopolitical risk. Talking of which, Bloomberg understands the move will impact fewer than 10 roles across Asia, Europe and other regions. The London headquartered firm is the world's largest trade bank, of course, and an anchor of commerce between the Asia-Pacific region and the rest of the world. The US Congress has passed the first federal legislation to regulate stablecoins in a watershed moment for the crypto industry. It paves the way for the broader use of stablecoins in everyday finance. The measure is now on track to become law. Bitcoin hit an all-time high earlier this week, partly on optimism about the stablecoin bill's prospects. Netflix lower in pre-market trading. You can see that, down 1.3%. That's despite reporting second quarter results that exceeded analyst expectations in every metric, with revenue topping $11 billion. The world's most popular paid streaming service also raised its forecast for full-year sales and profit margins. For more, let's bring in Bloomberg's Shirley Zhao with the details. Shirley, what are the reasons then for Netflix's better-than-expected results? They beat on pretty much every metric in the second quarter.
Yes, so Netflix's performance for the second quarter did come as a surprise, because the second quarter usually is slower for Netflix because it typically adds subscribers at the beginning and the end of the year. But during this quarter, two of Netflix's most popular shows were released, including the third season of Jen and Georgia and the final season of Squid Game. So these two shows have helped boost Netflix's performance for this quarter. And there is also the currency exchange volatility. The US dollar has become weak, and more than 2/3 of Netflix's viewers are outside of the US, and that means their currencies are becoming stronger against the US dollar.
Okay, so the currency impact is there as well for Netflix. What are the challenges for this streamer in the months and quarters ahead, Shirley?
So Netflix does face quite a few challenges, and first, its share of total TV viewing in the U.S. hasn't increased over the past year, and its average viewer hasn't really watched more TV than before, and it's facing increasing competition in this field, with more competitors joining in, especially in the Asian market, which is one of Netflix's biggest markets in terms of growth potential. We've got these kind of competition, and also there is the valuation of the company. Netflix's share prices have almost doubled over the past year, and it's now trading near a historic high. And that means if Netflix's earnings are anything short of meeting investor expectation, there could be a letdown, and that may reflect on its share prices.
Okay, priced for perfection, maybe. Bloomberg, Shirley Zhao, on those Netflix earnings. Thank you very much indeed. Staying with TV, The Late Show with Stephen Colbert is to air its final episode in May of next year. Colbert, who hosted the program for a decade, announced the program's end during a taping yesterday. Colbert replaced David Letterman, who created and hosted the show for 22 years. CBS, owned by Paramount Global, said the cancellation was purely a financial decision against what they described as a challenging backdrop in late-night TV. And the CFO of TSMC has told Bloomberg the company plans to be cautious with capital expenditure because of the uncertainties around tariffs. The chip giant reported stellar earnings yesterday that beat estimates across all metrics. The CFO, Wendell Huang, has been speaking to us exclusively.
Basically, tariffs will not directly impact us, but it will impact the end markets. So if the end market's demand drops, and ultimately it will affect us. We do have certain assumptions in there, which I think everybody has its own assumptions on how much impact there may be.
Okay, TSMC's CFO speaking to us exclusively. Coming up, G20 finance chiefs confront the impact of President Trump's tariffs as hosts South Africa call for greater cooperation. We'll have more next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back. Well, on his first visit to Britain as German Chancellor, Friedrich Merz has signed a treaty that includes a commitment for the two nations to assist each other in case of armed attack, part of a wider reset of post-Brexit ties between the two countries. London Bureau Chief Ruth David joins us now for more. What are the details then, Ruth, of this treaty signed between Germany and the UK?
Hi, Tom. So, of course, there is the commitment to defend each other, closer cooperation on nuclear arms, because Germany is not a nuclear state, but they are, you know, the third largest exporter of missiles to Ukraine. And one of the clouds hanging over this time has been with the U.S. pulling back. What are Germany and the UK and France doing? It seems very much like the London, Paris, Berlin triangle is back. You know, this comes on the heel of President Macron's visit last week, where there was this agreement. And it also is, you know, so they're talking about defense. They're talking about exporting more together, bilateral treaties there. They already work together on some things like the Eurofighter Typhoons and the Boxer armored vehicles, but they're looking at a long-distance ballistic missile, developing that. But there's also things like, well, okay, it's going to be easier to travel between borders, and that's good for us. It's going to be easier to have more student exchanges. Merz has been quite vocal about how he deplores Brexit, so this seems to be putting back some of the alliances that were in place when the UK was in the EU.
Yeah, and some of those travel easing measures may come into place as soon as this summer, we hear, in terms of e-gate. When it comes to the military component of this, and particularly support for Ukraine, what do we hear about how the two countries, the UK and Germany, may be partnering or at least working together to support Ukraine?
Yes, and so yesterday, Keir Starmer was hinting that, the UK and Germany might be teaming up or might look at teaming up to buy missiles from the US as part of the NATO alliance and then to send it to Ukraine. So we're seeing that happen. I think it's also interesting to keep in mind that this is happening while both leaders are facing a lot of challenges domestically, right? And we are looking at these talks in the light of Merz saying now that he's against the European Commission's budget proposals, which would include Germany spending $500 billion more. So all of these things are happening, and then there's this little bit of a ray of hope where they're signing these agreements, and they're both saying we're committed to these closer ties between us as we look at a new post-US alliance.
And the domestic political challenges are there as well, in the shadows, aren't they, as you say. Ruth David, thank you very much indeed. Our London Bureau Chief, of course, on those meetings between the German Chancellor and his UK correspondent, the Prime Minister, of course, Keir Starmer. Now, President Donald Trump has authorised the Justice Department to seek the release of grand jury testimony from the prosecution of Jeffrey Epstein, bowing to mounting pressure for more transparency about the late disgraced financier. Trump's move came after the Wall Street Journal published a story alleging that he once sent a suggestive birthday letter to Epstein. The president called the letter fake and threatened to sue the paper. Meanwhile, President Trump has been diagnosed with chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says he remains in excellent health with no signs of deep vein thrombosis, heart failure, or systemic illness. Doctors attribute recent hand bruising to aspirin use and frequent handshakes, calling it benign. We had some lines crossing in the last couple of minutes in terms of a response, or at least a view from the ECB's Nagel, a member, of course, of the Monetary Policy Setting Committee at the European Central Bank, talking about Fed independence. So a view on the Federal Reserve there coming from Joachim Nagel, of course, saying challenges to Fed independence could be felt beyond the US. This, of course, after and during which, of course, President Trump has ramped up that pressure on Fed Chair Jay Powell. So Joachim Nagel of the Bundesbank, of course, but also of the ECB, saying that challenges to Fed independence could be felt beyond the US, should not play with central bank independence. So a warning there from Joachim Nagel not to play, as he's described it, with central bank independence. Now, back to the G20 summit, where Joachim Nagel was speaking. Finance ministers, central bank governors, the hosts, South Africa, calling for greater cooperation as finance ministers and central bank governors gather, of course, under the cloud of President Trump's trade war. Let's talk to Sanusha Naidu now, senior research fellow at the Institute for Global Dialogue, someone as well with deep expertise on China and the interlinkages between China and the continent of Africa. Sanusha, what for you have been the key takeaways from this G20 meeting? Is this a talking shop, or is there real consequential cooperation that's coming out of this meeting?
A good day to you and to the viewers. I think the key question is really around finding the consensus around the document that needs to be put together by today that can go to the G20 summit in November. And that's a big challenge for the finance ministers at this meeting, because the consensus is really around key issues around the issue of the trade protectionism, the debt distress question. But more importantly, I think it's also around what was alluded to just now about the independence of the central banks, how much of political leeway do they have, and of course making decisions regarding the financial architecture, and bearing in mind that we also have to deal with the cost of capital and how cost of capital is impeding and impacting negatively on African countries in sub-Saharan Africa around issues in terms of how much it takes to actually borrow, but also in terms of money that is being used to remit and so forth. And so this is a big question in the meeting in the last 2 days around how do you actually ventilate a more kind of defraying of the costs when it comes to transactions in terms of whether it's the SWIFT system, which is also an impediment to the financial architecture, and the currency questions and volatility. So I think the consensus is the big question of what they're going to reach at the end of the 2 days.
Does it matter that the US is not there with a senior delegation? The Treasury Secretary, Scott Bessent, is not on the ground at the G20. Is the US listening?
Well, it's a difficult one to actually comment on because you're getting differing or varying interpretations. You've got, for example, the finance Sherpa track, which is the finance ministry in South Africa, the the Director General Duncan Peterson and others who have said that this hasn't deterred the meeting. It hasn't created any kind of bottleneck without having a senior administration from the U.S. representative at the meeting. This happened also in February, where there was no senior representation. But again, the question is, what will be the consensus document that will then find traction with the U.S. as an incoming chair of the G20 at the end of this year and beginning of next year. And that's going to be critical because a lot of these issues actually fit very smugly and intently in the mind of the Donald Trump presidency, whether it's around the question of the BRICS financial issues and the issue around the tariffs, the question of the role of the dollar, and the transboundary issues that actually impact on the cost of capital, like things like climate finance and issues relating to illicit financial flows, debt sustainability, questions of how much of debt Africa pays in terms of interest repayments and the impact that it has. So these are all kind of sitting kind of smack bang in the middle of some of the issues coming out from the Trump presidency around what does it mean in terms of the US's global financial footprint and the impact that has for other countries.
And all of this, to your point, at a time when the US is threatening 30% tariffs on South Africa by August the 1st, and potentially an additional 10% is what's been threatened because of their association and grouping with the BRICS nations. Is it your sense, is South Africa any closer to coming to some kind of agreement with the US when it comes to trade?
Well, what we're hearing is that there is trade talks happening, that the Department of Trade, Industry and Competition, which is the equivalent of our Ministry of Trade, is in negotiations and talks with counterparts in the U.S. We are seeing that there are other stakeholders like the union has also been part of the discussion in terms of AGOA. But I think at the end of the day, it's very difficult to try and pinpoint what is going to happen in terms of these discussions. Perhaps this is also part of the fact that it's a very unpredictable Trump presidency, so you're not really sure what it means when you talk about these kinds of discussions. But hopefully this is something that will be looked at in a more bigger question. And I think, what we really want to think about here is, again, it's not just about South Africa, BRICS or whatever. It's about a global issue and how this is undermining and creating more fragility in terms of global trade, and the protectionism issue on the trade linked to the currency question, linked to the cost of capital, and how much of this is going to impact not just South Africa, but in fact the U.S. economy more directly.
Just very briefly before we let you go, what's China's role been? Are they taking advantage of the US stepping back?
Well, the Chinese have always played that role in terms of being politically very visible in Africa, politically very visible in terms of what they want to achieve with their global frameworks like the Global Development Initiative and so forth. But again, it's difficult if you think about this little mini summit. There's the mini summit that Trump had with African countries around critical minerals, peace, and of course other issues. So again, I would say that it's transactional.
Yeah. Sanusha Naidu, with that insight, Senior Research Fellow at the Institute of Global Dialogue. Thank you for those views on the G20. Up next, Bloomberg Brief. European markets are up. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
A cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering.
and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The Fed's Waller makes the most vocal case yet to reduce rates as speculation over Powell's future continues to swirl. Another all-time high. Stronger data from retail sales to earnings keeps the risk party going. A beat, but is it enough? Netflix falls pre-market after topping estimates and boosting its outlook. Putting Netflix aside, it is a very buoyant and resilient equity market, an all-time high for both the S&P and the NASDAQ 100. Futures continue to move higher this morning by just 0.1%. By the way, the Mag 7, it's tech again that seems to be lifting everything, gaining for 7 consecutive days. That's the first time it's happened so far this year. Now, for this bond market, we had really resilient data, which of course also was helping equities. So you get a pricing out of some of the cuts. But what is even priced into this at the moment? You have the strong data from retail sales to jobless claims, but then you also have the unwinding of some of that trade that maybe Powell gets fired, but then you also have Chris Waller, the Fed governor, saying the most vocally yet that he will be voting for a 25 basis point reduction. So yeah, good luck sorting out how that should be factoring into your bond price. All right, that's our overall markets. Let's look at some of the stocks moving pre-market. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start there with Netflix reporting after the bell yesterday, beating on almost every major element, whether that was margin, revenue, or sales, even boosting its full-year guidance, but it was not enough to meet those lofty expectations. We have Netflix falling over 1% in pre-market trade. Let's stay with earnings, but go on to European defense. Saab, the Swedish defense contractor, one of the best performing stocks in Europe this morning, up 11% as that European defense trade rolls on. The stock is now up 130% this year, Danny, with the CEO saying that the sales boom is likely to last for multiple years. Let's move on to the companies reporting before the bell today. We have 3 big ones. Amex for a guide on consumer spending habits. Then we have the consumer conglomerate 3M and also Charles Schwab, one of the largest U.S. brokerage firms, all due to report before the bell on this Friday morning. Danny.
A couple names to watch out for. Valerie, thank you so much. We'll catch up with you later in the hour. Also this hour, in just moments, we'll be speaking with Anika Gupta of Wisdom Tree, who joins us to talk about this equity market at all-time highs. And Laura Sadel-Baker of ITR Economics joins us later this hour. to parse through what we heard from Fed Governor Waller. Now, again, another record high for U.S. stocks. WisdomTree's Anika Gupta looks to the lofty valuations, writing, quote, global equities are entering the second half of 2025 and the first half of 26 at a juncture where valuation cushions sit outside the United States and policy risk revolves around potential U.S. tariff escalation. Anika joins us now. She's Director of Macroeconomic Research at WisdomTree. Anika, great to see you this morning. So just given that, are you rotating, are you looking away from the United States elsewhere at this moment?
Well, I think a very good morning, Danny. We are looking at valuations at record highs. We've seen, equities in the U.S. again hit record highs. And obviously this is on lower breadth in the markets. But I think looking into the second half of 2025, what remains the overarching concern is tariff uncertainty, the Fed, remaining in a slower easing cycle. And obviously this could change. But given that scenario and given the uncertainty that still is prevailing in the markets, we believe that rotation into international markets where, we have a better discount opportunity, higher dividend yields where investors can actually seek a bit more protection is being offered. So we're seeing it in Europe with equity risk premiums around 6%. We're seeing that in Japan as well. And also emerging markets are gaining a bit more momentum this year.
So elsewhere gaining momentum, Anika, how much of this, though, is not just about elsewhere looking more attractive, but vulnerability within U.S. equity?
Yes, it is a bit of both. We've seen quite a bit of volatility just this week. I know overnight it's been risk on, but just this week we've had concerns of, that sell America rhetoric come back into the markets with questions on, Fed Chair Powell's seat. Obviously, the markets' qualms have been restored, but it's very important to keep in mind that that bifurcation in the market in the U.S. still exists, with those lofty valuations being dominated by the Mag 7, and we are also facing a slowing U.S. economy, which is likely to pressure earnings going into the second half of the year. In addition, with that tariff uncertainty looming, we are seeing, tighter supply chains. U.S. consumers will be faced with, that higher pricing in most of the goods that they are purchasing, given the fact that now that higher tariff uncertainty is likely to seep in to their purchasing patterns as well.
Anika, if I can pick up on one point you made, overall, look, it's uncertainty. You pointed out there, who knows how trade will play out? Who knows exactly what the rate picture will look like? The known thing, at least at this moment, seems to be that these hyperscalers, that big tech is spending like crazy. Day after day, we hear some story about how Mark Zuckerberg has poached some other AI player. We're about to get their earnings, probably going to see another round of really strong CapEx. Why can I not keep piling into Mag 7 if that seems like a sure thing at this moment?
Well, for the very reason that investors were caught off guard in the very first month of 2025, when we had the unveiling of DeepSeek in China at a fraction of a cost, and that was really a big wake-up call for investors globally, questioning whether those hyperscalers actually need to spend all that much when DeepSeek was able to unveil a model at a fraction of the cost. So those unknown risks still exist in the market. I think given the lofty valuations, given the concentration we had entering into 2025, what's important for investors to keep in mind is that with markets at record highs, it's better to diversify outside the U.S., look for opportunities where there are better earnings growth momentum existing, better pockets of the market. One such pocket that does come to mind is the defense sector within Europe, where we are seeing significant opportunity. And this is over a multi-year investment cycle.
Can you talk about that a bit more, Anika? Because you've written in your notes to clients that geopolitical risk has migrated from tail to base case, and it's a market that's notoriously bad at pricing in geopolitical risk. So where does that show up? Is it just in the defensives or elsewhere?
Absolutely. I mean, we 2025 is the best example of, these unknown risks emanating from the geopolitical landscape. And I think what it has become very evident for EU member states is they've realized Europe is underinvested for a very long period of time, and they're now beginning to bridge that underinvestment gap. In addition, with the uncertainty from the Trump administration, they've also realized that they need to reduce their reliance on the U.S. when it comes to spending on defense. And we're seeing that momentum build, on ground here in Europe. We're seeing greater collaboration between the defense sector and the industrial sector in trying to really pick up capacity and increase potential, supply chains here on ground. We've also seen policy initiative move in that direction to favor supportive investment flow towards the defense sector. And in addition, we've had one of the biggest catalysts play out, which was the NATO summit, which just changed the level playing field with a current 2% NATO guideline, which is being followed by EU member states, now being pushed higher to a much more ambitious target of 5% of defense spending as a percentage of GDP. Being the new NATO guideline.
Anika, just before we let you go, I had mentioned at the top of the show that it's confusing to understand what's actually priced in to this bond market, from the concerns about Powell to Fed Governor, not Fed Chair, maybe a Freudian slip there, Fed Governor Waller talking about a quarter-point cut, to really strong data. How do you understand what's priced in to debt right now?
Well, I think what's very important to keep in mind is, we have inflation close to the Fed's target rate, and it's impossible for the Fed to get it precisely right. And so, we've had Fed Chair Waller, we've had Fed President Waller, as well as Mary Daly, mention that, a minimum of 2 interest rate cuts are definitely priced into the market for the U.S. in 2025. Obviously, Waller's being a lot more aggressive, and I would agree with him. They might be a bit too late if we see further loosening or further deterioration in the labor market, and they do need to try to come in ahead of time and try to ensure that rates are trading at the correct pace.
Anika, you and I both slipping up, calling him Fed Chair. Who knows, next year that might be right. Anika, we're going to have to leave it there. Thank you so much for joining us. Wisdom Trees, Anika Gupta. All right, let's get you some other top stories now trending on the terminal this morning. And the EU is imposing new sanctions on Russia over its war against Ukraine. They include a revised oil price cap and new banking restrictions. In addition, 20 more Russian banks will be cut off the international payment system, SWIFT. Now, this is one I mentioned to Anika. Meta has hired a pair of key AI researchers who had worked at Apple shortly after poaching their boss. Bloomberg sources say it hired Mark Lee and Tom Guntner for its superintelligence lab team. The moves are part of a scramble for AI talent across the industry. And President Trump has been diagnosed with chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says he remains in excellent health with no signs of deep vein thrombosis, heart failure, or systematic illness. Doctors attribute recent hand bruising to aspirin use and frequent handshakes. Coming up, should the Fed cut in July? Governor Waller thinks so. We're going to have more on that coming up next. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Season is here.
The earnings are front and center. A slew of results already out.
Are tariffs going to eat into margins?
Bloomberg is first to break the numbers.
JP Morgan, Citi, Wells Fargo, Bank of America, Goldman, Morgan Stanley.
I'm getting my spreadsheets ready.
With the smartest insights.
It's going to be a can-kicking situation.
Expectations are relatively low.
The market is looking for confirmation of that growth narrative.
Continuing coverage on Bloomberg. Context changes everything.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs that are not unanchoring inflation expectations, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
So I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
I find it appropriate to hold our policy rate at the current level for some time.
Some divisions there coming to the front, coming to the fore, the Federal Reserve, over what exactly to do with rates. You heard there Governor Christopher Waller going further than any member, removing any doubt that he will be voting for a July cut. Let's unpack it all. Bloomberg's macro strategist Mark Cudmore joins us now. Mark, let's just take the argument on its face value. We can talk about the politics of it later. But a Waller who is saying we should be cutting in July, is there enough of a credible argument, and does he hold enough sway to push the committee towards that level?
The short answer is no to both. I think the context here is that Waller has long been in this camp on the extreme dovish side. Yes, he was a little bit more forceful and explicit in his wording, so that was slightly more interesting. But ultimately, his argument has not really changed, and it's not a very compelling argument. I come from a slightly more hawkish context, so I will give that disclaimer before I give that the view on Waller's perspective. So he's saying the labor market is stalling. Sure, it is stalling. That's absolutely fair. But because of the decline in immigration, we've still got a relatively tight labor market, and it's too early to react to that yet. Insurance cuts aren't a good idea. It's better to react more aggressively after the fact, in the context that we still have an inflation threat in the horizon. So not only are we at the end of the disinflation cycle, but we're about to get the tariffs come through, which might be quite inflationary. So I think it's right to pause at the moment from a policy point of view. That's, of course, the way the committee is going to think. The much more interesting takeaway here is that this is just before the Fed blackout period. We have become used to the idea that Fed policy members are wheeled out to correct market pricing to one vision going into the Fed blackout period. It's often been assumed that this has been coordinated, whether it has or not. So the fact that we're getting someone to so explicitly challenge the narrative going into the window, and this division of views, is a really, really interesting time for the FOMC committee, because it is now going to be a divided committee, and it shows that administration attacks on Powell is starting to erode some of his authority over the committee, and that makes it an entirely new environment that we're going into for trading the dollar and short-end rates.
Right. It begs the question, if he is being so vocal about it, is it an audition of sorts? Does he need to be more vocal to get the Trump administration's attention? And Mark, on that point, if it does look like Governor Waller might turn into Chair Waller, does the market change how it views these comments? Because it wasn't hugely moving, maybe a little bit of a reaction. But if he looks like he's likely to get the tip for the Fed chair, does that mean we need to take those comments more seriously?
It's an interesting one, and it'll be interesting to see whether we get any comments on that. I know certainly the idea that he's pitching for the governor role, sorry, the chair role, has been talked about a lot this morning. I'm unsure how seriously that's being considered. It seems like there are some very established frontrunners, and certainly from the knowledge that I have on the basis, I might be out of the loop on this, is that, you know, there's people who've been campaigning with Donald Trump for a long time, and therefore Waller is really an outside contender. And just because he's expressing dovishness and a desire to cut doesn't suddenly put him at the front of the line. Already Trump's preferred members are sounding very, very dovish. So surely something more than that would be needed to put him as a serious contender. So I don't think we're going to suddenly change the narrative of these context, these comments, but maybe it makes us see that a Fed over the coming year, sure, the committee doesn't have to listen to the Fed chair, but if we have a new Fed chair that wants to follow Trump's more dovish policy, it shows that there'll be other members that will also be more susceptible to political pressure and maybe gives us a more dovish composition overall. And the backdrop narrative of the next few years is that we're either going to have a Fed membership that is more dovish than orthodox economic policy would imply, or at least investors are going to believe that, and that is a negative backdrop for the dollar for the next few years.
Yeah, it's a really good point. If Waller isn't the next Fed chair, he, among others, might be able to kind of adopt that narrative. Mark, so wonderful to talk with you. Mark Cudmore there. And don't miss our interview. We're going to be speaking with Governor Christopher Waller. Bloomberg Surveillance will be leading that conversation, 8 a.m. Eastern Time, a must-watch. Coming up on your brief, it's the Wall Street Journal versus President Donald Trump over the Epstein letters. More on that. And what else is making your headlines in the front page news? That's coming up. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
This This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at some of your front pages this morning. What's on major publications? And first up, a Wall Street Journal exclusive alleging that President Donald Trump once sent a suggested letter for Jeffrey Epstein's birthday. The letter was among the documents examined by the Justice Department. The president called the letters fake and threatened to sue the paper. Next up, the New York Times has this, that the U.S. Congress has passed a bill to claw back $9 billion in foreign aid and public broadcast funds. The bill cuts more than $1 billion for the Corporation of Public Broadcasting, which funds both NPR and PBS. And on the Washington Post, The Late Show with Stephen Colbert will air its final episode in May of next year. Colbert, who has hosted the program for a decade now, announced that the show's end during a taping yesterday. Really? Has it already been a decade? Wow. CBS, owned by Paramount Global, said the cancellation was purely a financial decision against a challenging backdrop in late night. All right, now let's shift our focus back to trade. President Trump's U-turn this week on allowing NVIDIA and AMD to sell AI chips to China has sparked speculation of a further thaw in restrictions on trade and business between the world's two biggest economies. For more, let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, as we dig through the details, as the dust settles on these changes to AMD and NVIDIA, how much of this is a wholesale shift on the U.S.'s approach to China when it comes to access to American technology?
Well, what we're seeing and what we're hearing are two very different Donald Trumps from the one who just a few months ago was saying that China was the big enemy when it came to trade, and that the U.S. had to protect its critical technology from Chinese adopting a similar rival to American technology. And what we've seen recently is him backpedaling on the export controls that were put in place to protect American technology. So it's a pretty sharp reversal, and one that a lot of the more hawkish China observers are surprised has happened at least so quickly. What sources tell us is that President Trump really wants this summit to come together with President Xi, and he wants to do some sort of commercial deal, similar to the Phase 1 deal that he signed in his first term, one where China agrees to purchase a large amount of U.S. exports. So those seem to be driving this softer, friendlier tone that the president has, not only in his rhetoric, but in the actions that they're taking with these export controls on technology.
Hey, Brendan, I just want to set us up for what we're likely to see over the next week. We have a G20 summit happening now where Europe is there and trade is certainly being talked about. There's also an EU-China summit next week. What is the latest on any sort of negotiations with the EU and the U.S. on trade?
Well, they've been talking throughout the week between Brussels and Washington. This is really the key deal that needs to come together 2 weeks from today, basically the August 1st deadline. So that we have reported that they're bogged down on some issues, including cars and steel. That the non-tariff barriers are still big sticking points. But the mood music that we're picking up is that they still are working for a deal. But the EU in particular is planning for a worst case scenario, those 30% tariffs that President Trump has threatened to put on European goods. The EU could be ready to strike back with its countermeasures, tariffs on U.S. goods, and potentially even go after American services like U.S. tech giants.
Brendan, thank you so much for your reporting this morning. Bloomberg's Brendan Murray. Coming up, inflation, Fed speak, and Chair Powell. We'll get into all of it with Lauren Sadel-Baker of ITR Economics. That's coming up next. Stay with us on your brief.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The Fed's Waller makes the most vocal case yet to reduce rates as speculation over Powell's future continues to swirl. Another all-time high, stronger data from retail sales to earnings keeps the risk party going. And a beat, but is it enough? Netflix falls pre-market after topping estimates and boosting its outlook. Well, it's enough for this overall market, both S&P and NASDAQ hitting an all-time high. The rally continues this morning with futures up 0.1%. By the way, Mag 7, its seventh consecutive advance for the first time this year. So yeah, we got better retail sales, a fifth consecutive weekly decline in initial jobless claims. This is an economy that so far is resilient and is holding up. So you get a pricing out of more cuts for this bond market. But you get a little bit of back and forth with Waller saying that, yep, removing any doubt, he'll be voting for July cuts. You see the front end coming in a bit, down by about a basis point at 389. Your 10-year yield at 444. Let's get some stocks on the move this morning. With your pre-market movers is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Netflix because, man, there was a high bar for this earnings report. Netflix falling nearly 2% in pre-market trade, even though they beat on nearly every major metric, whether it was revenue, earnings, operating margin. They even raised their full-year guidance, but it was not enough to meet this high bar. Netflix shares are falling so far this morning. Let's move on to the energy sector because we have the fourth major deal for gas-powered generators in the U.S. as these operators scramble to keep up with these data centers, these AI data center energy demand. We have Talent Energy up 13.6%. It's spending $3.8 billion for two of the most efficient gas-powered energy generators in the U.S. Investors seem to be liking what they hear about that deal. Lastly, let's move on to some M&A speculation. This coming from the Wall Street Journal about a potential mega merger when it comes to the rail industry. We heard that Union Pacific is reportedly exploring a bid for Norfolk Southern. We're seeing both of those shares trade higher so far in extended trade. Danny.
Valerie, thank you so much for that recap. Some of the names to look out for in this morning's trade. Let's get back to our top story this morning. And it looks like Fed Governor Christopher Waller will indeed be voting to cut rates at the next meeting.
I believe that the Federal Open Market Committee, or FOMC, should reduce our policy rate by 25 basis points at our next meeting. So with inflation near target and upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate.
For more, let's go to Bloomberg's Kasia Kleeman-Shinska in Washington, D.C. Kasia, this comes off the back of all of this back and forth of are the Republicans looking at firing Powell? No, they're not. Was a letter drafted? Who's going to be the next Fed chair? Just put what Waller said in context of all of that, Kasia. Does it look like something of an audition?
Good morning. Indeed, we are seeing a little bit of a rally in the stock market this morning, as Valerie mentioned. So it looks like stocks, anyway, are going with it, with this urge from Governor Waller to lower interest rates at the upcoming FOMC meeting later this month. Still, Waller is in minority. The majority of the OMC, including Fed Chair Powell, expect to lower rates, but probably later this year after they see the impact from tariffs. Remember, President Trump announced that he will increase tariffs on August 1st, so the FOMC wants to see the impact before they move. Now, as you mentioned, there is this ongoing criticism, attack from the White House on Fed Chair Powell and the rest of the board. The White House, President Trump, wants the interest rates to come down soon, and there's this ongoing discussion whether he will replace Chair Powell before his term expires in May of next year. And Governor Waller is one of the potential candidates to take that spot.
And as that's going, again, some of the heat has backed off as to whether they would try to replace Powell before his term is up. But we got this from the representative from Florida, Anna Paulina Luna, who says on a post on X that she's criminally referring Jerome Powell to the Justice Department, investigate perjury regarding his crazy $2.5 billion building is what she wrote. Kasia, does that have any weight to it? Does it hold any weight if the representative were to try to do something like that?
Yes, so this request from a Republican representative in the U.S. House is not legally binding, but obviously it adds to this line of attack from the White House Office of Management and Budget, that Chair Powell is mismanaging the public finance because of the spending, the $2.5 billion spending on the renovation of the two buildings that they've had in downtown D.C., So it's an ongoing attack from President Trump, from his administration, and now from what it looks like a growing circle of Republicans in Congress over the renovation. Fed Chair Powell has come out to defend himself. He testified in Congress. He issued a letter. He even put up a website explaining the reason for this cost. These are two buildings that were built almost 100 years ago, and this is the first major renovation.
Kasia, before we let you go, it's also the conclusion of so-called Crypto Week in Washington, D.C. We have stablecoin legislation. What exactly does it look like?
Really a watershed moment for the crypto business there, with U.S. House and Senate passing legislation that would impose first ever regulation of the crypto business, starting with the stable coins, so the coins, tokens linked to the US dollar. That possibly opens the way for broader use of the stable coins in everyday finance. So that's why we saw a little bit of a rally in crypto assets this week as well.
Kasia, thank you so much for that. That is Kasia Kleeman-Shinska in Washington. Also, don't miss our interview, Governor Christopher Waller, 8 a.m. Eastern Time on Bloomberg Surveillance, a conversation you don't want to miss. But first, joining us now is Lauren Seidel-Baker, economist at ITR Economics. Lauren, so Waller removes any doubt. He will indeed be voting for a July cut. But does Waller hold both the sway of the committee and have the data backing him up to really encourage a more dovish shift at the FOMC?
No, he absolutely does not have the majority, although we did see in the most recent dot plot, there's something of a divergence, almost two camps emerging in those Fed expectations between those who are saying rates are appropriate, policy is appropriate, probably to end the year around this level, and those with a 50 basis points cut seen by year end. Now, 50 basis points at the end of the day, Waller is saying a 25 basis point cut in July. That's really not going to move the needle on these broad economic outcomes. I don't see that as being enough to really be the stimulative impact that would move some of these economic data points that we see. But at the end of the day, it is interesting to start to see two camps emerging in Fed policymakers.
Well, the camp that does want cuts, Lauren, a lot of the argument comes around this labor market, the fact that, sure, you had initial jobless claims yesterday, for example, falling slowing for a fifth consecutive time, but continuing claims continues to build up, which shows that hirings are slowing. Are there real cracks that can and should be addressed?
Here's where it just depends what metric you want to use to judge the labor market. So overall, if you just take any of our kind of median data points here, the labor market is still tight. Now, it's loosening because we're coming from such an incredibly tight starting point, but overall, we still have fewer than one job seeker for each available position out there. Now, where we're starting to see some differences beneath the surface is when you look at different skill sets, various industries. There are certainly some industries where folks who are out of work for much longer. It's harder to find those new positions. Others, though, where the real skills shortages are, folks just get snapped up very quickly. So I think the averages are kind of belying that divergence once you look at various skills, various income levels, and even various regions of the country.
So if it's divergent, if it's not a sure thing, Lauren, does it change depending on who is the Fed chair? So let's say we get someone in 2026 who's dovish regardless. There's this argument being made. Paul Donovan of UBS was here earlier in the program in the week talking about this idea that Waller is kind of more scary if you don't think the Fed should be cutting, because he has these credible arguments, versus someone else who would be a Fed chair in name only, that's so out of consensus that the rest of the FOMC doesn't listen to the person in charge. So how are you thinking about who the next leader of the Fed is and how that dictates where policy goes in 2026 and beyond?
We have to remember the Fed chair still just has one vote when it comes to actual policy. So even when Chair Powell does step down from the chairmanship, he still does have a vote, a seat on the committee for a few more years after. So as we look at the balance, right, of timing of each of those governors kind of rolling off the committee, there's no wave coming. There's no overwhelming opportunity, say, for Trump to put in folks with more dovish policy all at once. He'd really have to test the legal system to do so.
So we have higher than expected retail sales. You're talking about the differences in the labor market. At what point do we start to ask again, Lauren, is this an economy running hot? And is there a concern about inflation becoming de-anchored, especially as we understand more of the contours of what exactly tariffs and trade looks like?
I do see inflation gaining steam. It's not just because of tariffs, to be absolutely clear. If tariffs went away tomorrow, I still don't think we would see continued disinflation. We have just a lot of liquidity flowing through the system. Both fiscal and monetary policy have been supporting price pressures. This persistent wage pressure environment, that has been causing some upward pricing. So to see tariffs coming back, even to see the commodity cycle starting back up again, there are very, very real pricing pressures here. Now, some of these other policies might be slightly suppressive to growth. So balancing those two sides of the dual mandate, watching that labor market very closely, which again is not in trouble yet, but starting to show some cracks in some areas. That's going to be a tough job for the Fed going forward.
Well, 5-year inflation swaps, they're also the highest since March 2023. So, Lauren, if we put all these things we've been talking about together, that inflation is still a concern, the labor market isn't breaking down, yet we have more vocal critics of the Fed and more people within the FOMC starting to skew more dovish. Is there a risk that policy is taken down too soon? Are you concerned about that?
There is always a risk that policy moves too soon. There's always a risk that policy does not move soon enough. If we were just looking at this moment in history in an econ textbook, you're right, with inflation still above target, with, as I am seeing, persistent inflation pressures coming back onto the scene in the second half of this year, given that the labor market is still tight, the baseline answer, the correct answer on your Econ 101 test would be no, don't make cuts right now. However, there is so much noise out there, right? The challenge of, do you look through tariffs as a temporary, a one-time move in inflation? I think the Fed's been scared off of that word transitory, so I don't expect to see that pop back up again. But they are factoring in a lot of different parts of this equation.
Sometimes it's good to dust off that old Econ 101 textbook. Lauren, thank you so much for joining this morning. We really appreciate your time. Lauren Seidel-Baker of ITR Economics. Now let's get you some other top stories trending on the terminal this morning. The EU is imposing new sanctions on Russia over its war against Ukraine. They include a revised oil price cap and new banking restrictions. In addition, 20 more Russian banks will be cut off the international payment system, SWIFT. HSBC is disbanding a team of staffers focused on identifying and managing geopolitical risk. The move affects fewer than 10 roles across Asia, Europe, and other regions. Some of those staffers have been given the opportunity to apply for other jobs within the bank. And hedge funds are on the hunt for a record amount of office space in London. Following a period of bumper returns, money managers are currently searching for 474,000 square feet of space in the UK capital. Demand for hedge fund strategies remain high, with many of the world's largest multi-strat investment firms closed to new capital. Coming up, grab your popcorn. Netflix delivers a beat across the board, but shares are down just under 2% in the pre-market. We'll break it down next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
We remain convinced that AI represents an incredible opportunity to help creators make films and series better, not just cheaper. There are these AI-powered creator tools. So this is real people doing real work with better tools. Our creators are already seeing the benefits in production through pre-visualization and shot planning work, and certainly visual effects.
It's almost as if all of Hollywood went on strike over that. Anyway, Netflix down in the pre-market about 1.7%. It reported second quarter earnings. That loss in the pre-market, despite the streaming giant beating on almost every major metric and boosting its full-year forecast. Let's unpack it all with Bloomberg Tech Europe host Tom McKenzie. So, Tom, strong results, but stocks are down. What was the takeaway for you?
Yeah, as you say, look, across every part of the business, it was a beat in the second quarter. And to your point, they raised the guidance in terms of revenues and profit margins as well. In a quarter, and going back to the second quarter, a quarter that's traditionally pretty soft for Netflix. Normally they do very well in first quarter and towards the end of the year. Second quarter, normally a bit quieter. But they had these new releases. Ginny and Georgia, that one passed me by, but Squid Game certainly did not. And that helped in terms of the ad sales, where executives said they saw pretty decent gains in terms of ad sales. They saw decent gains in terms of subs as well, so subscriptions being added. and additional membership as well. But look, you're talking about the pre-market pricing, of course, lower. This is a stock that's almost doubled in the last 12 months. It's got a market cap of about $500 billion. That's more than their three major competitors, including Comcast and Disney, Warner Brothers combined. JP Morgan saying, look, Netflix is executing well. That is clear from Q2. But it's not a surprise that there's going to be a bit of profit taking. The stock needs to take a bit of a breather at this point.
Yeah, it's run up so much. By the way, Tom, I don't think you're the audience for Ginny and Georgia. Not an insult. I'm not sure I am either, to be fair. Elsewhere in the world of tech, it seems like every day there's a new headline of who has Mark Zuckerberg poached from what company to join his superintelligence team. Who do we got this time, Tom?
Yeah, look, it's almost a daily occurrence, isn't it? And it's a reminder of just how determined, how ambitious, arguably how aggressive Mark Zuckerberg is being in putting together this super intelligence team. He poached their boss, and now he's poached them. We're talking about Mark Lee and Tom Gunter, both formerly of Apple. And again, previously we'd reported that their boss had been poached by Mark Zuckerberg. Again, for their superintelligence labs business. Mark Zuckerberg saying and putting out a post, and he said, I am focused, and we are focused on building the most elite and talent-dense team in the industry. And he continues to hire aggressively with massive pay packages. We know that Apple has offered some of their AI researchers higher pay and higher comp, but nothing that matches the kind of dollar numbers that Mark Zuckerberg and Meta are putting towards them. Upwards of $200 million for the boss of these two individuals who were hired. So the money is incredible. And he's spending very heavily on data centers as well, saying they will spend tens of billions of dollars on building out data centers to support their growth around AI. But it's also a reminder of the tumult, essentially, and the lack of direction within Apple as they lose this talent. They're still trying to decide whether they go for an in-house model to power Siri, which is expected to be updated in 2026, or whether they take an off-the-shelf option, for example, from Anthropic, or OpenAI to power Siri in 2026. That debate continues, and so that lack of certainty in terms of the path forward for Apple is leaving an opening for Mark Zuckerberg to poach.
Yeah, again, just incredible the amount of money that they are spending. Tom, thank you very much for that. That is our Bloomberg Tech Europe anchor, Tom McKenzie. Let's turn now to banking as we get the wrap-up of banking season earnings. Goldman Sachs now launching a program to retain junior talent. They are offering intern jobs in private equity internally to dissuade them from jumping ship to potentially more lucrative jobs in private equity shops. For more, we're joined by Bloomberg's Jennifer Serain, who leads our finance coverage in the EMEA region. Jenny, this story has kind of been bubbling up, this idea that a lot of these banks didn't like that PE was coming in and poaching some of their talent even before they had started. So how compelling is this from Goldman if they say, hey, don't go elsewhere, just stay with us in our private equity divisions?
I think it could ultimately be pretty compelling. I mean, what these analysts often say is, you know, their ultimate goal is to get to a role in private markets. And so they see, and these private equity firms see Goldman as a great training ground. You know, you spend your 2 years, you do your hard time on the investment banking side and kind of figure out Excel, know how to do all the modeling, and then you jump ship to some of the more exciting parts of the industry. Goldman is saying, no, you don't need to do that. You still do your 2 years in investment banking, but now, you know, instead of jumping ship to an outside firm, we'll move you over to our asset management unit. You'll still get that private markets experience. You can have a good career here. So it'll be interesting to see if it works. I think, you know, compensation obviously will be a huge part of this. A big reason that folks like to make that jump over to PE and the private markets firms is you then kind of have that stake, and you know, it's very eat what you kill. So if your deal turns out well, you get compensated appropriately for you. It doesn't work quite like that on Wall Street. So we'll see if, you know, behind this, if they have to start making more changes on the comp side. But I definitely think this is kind of the bank's first volley in terms of keeping people on side and not just being viewed as this training ground for a greater opportunity elsewhere.
Yeah, probably not great for the Apollos of the world, which said, hey, we're going to pull back, only to see Goldman still trying to get their employees to work in their private equity divisions. Hey, Jenny, just before we let you go, there was this latest headline that popped up yesterday that there was a Wells Fargo banker, an American one, who was blocked from leaving China, and Wells was recommending not any of its employees to go to China. What do we know about what's happening there?
I mean, I think right now all we know is that so far Wells Fargo, you know, they're saying they're working with the appropriate channels to try and get this employee back home. She's based in Atlanta, and so they're trying to go through all the channels. And I think, it'll be interesting to see if we start to see this bleed across to other Wall Street firms. Generally, the industry kind of moves in lockstep when they have, travel bans or at least travel advisories. But this was, an individual employee, and so it'll be interesting to see if we see other banks, taking a note and trying to kind of protect their own employees who might be traveling to China right now.
Jenny, really appreciate your time this morning. Bloomberg's Jennifer Serrain. Coming up, we're going to set you up for your trading day on this Friday. More earnings, more data. That's coming up next. Stay with your Bloomberg Brief.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Friday. First up, we're going to get some earnings coming in, those from 3M and American Express, both before the bell. U.S. housing data, that comes in at 8:30 a.m. Eastern. We'll also have UMich consumer sentiment, that comes at 10 a.m. Also, keep an eye out for any trade updates over the weekend. Treasury Secretary Scott Bessent will be heading to Osaka for the 2025 World Expo. We've already getting some headlines out of there, as she was saying, talks, or at least they expect a good deal to come out. Also, one to not miss, our interview with Fed Governor Chris Waller. That is at 8 a.m. after the Fed Governor endorsed a 25 basis point cut. All right, quickly, let's just go through some of the stocks moving in the pre-market. Netflix down 1.7%, a beat across the board, but it's run up a lot this year, really high expectations. Schwab, though, shares up 1.5%, just thereabouts. It's going to have earnings before the market open. And Talon Energy, a huge rally here, up 14%. It agreed to acquire a power plant in Pennsylvania and another in Ohio for about $3.8 billion. So we'll leave you with a picture of overall markets. Dollar weaker after those comments from Chris Waller. That is it for your brief. Surveillance takes things ahead here with a conversation with the Fed Governor.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
As long as there's cash in people's pockets in FOMO, markets are going to continue to grind.
The tailwinds for the market is basically the speculative frenzy that is going on right now.
A lot of what the issues are that could result in a repricing, they're all out there. The question is, are the markets reflecting that?
The market is expecting lower rates. This is what the beginning of a new bull market looks like.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, dissent is brewing.
Looking across the soft and hard data, I get a picture of a labor market on the edge. Policy should look through these tariff effects and focus on underlying inflation, which seems to be close to the FOMC's 2% goal. I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now.
Fed Governor Chris Waller pushing for a rate cut, suggesting the labor market is on edge. As Fed Chair Jay Powell is attempting to address criticism coming from the White House, the U.S. equity market is cutting through the noise and heading into the weekend sitting at fresh all-time highs.
And part of the reason why is because companies are saying things are actually looking better, and there is more confidence coming from consumers, and you saw that reflected in the hard data yesterday with retail sales coming in better than expected. So then we have to turn to the Fed. The idea of strength versus weakness, the fact that Fed Governor Chris Waller is talking about potential weakness and the need to cut. Is that because of a lack of inflation, or is it because there is something emerging under the hood that maybe equities are not picking up on?
Later on this morning, a must-watch conversation, 8 a.m. Eastern Time, 2 hours from now. A conversation here in New York City with the man himself, Governor Chris Waller. If you went through that speech last night, two big assumptions here, Bramo. A large share of tariff increases won't be passed through to consumers, one, and two, any increase would fade over the next year or so.
And it all comes down to, in terms of the why, the labor market not seeing the wage increases that would perpetuate some sort of inflation over a longer period of time. He said, looking across the soft and hard data, I get a picture of a labor market on edge. And he said that the risk to a weaker jobs market is greater and sufficient than the risk of inflation to cut rates. He might have some company. An increasing number of Fed members seem to have a similar kind of idea as he.
Just how much dissent will we see at the end of this month? This is going to be music to the ears of this president who spent the whole week going after Chairman Powell.
Absolutely, especially when Christopher Waller came out and his first point was about tariffs, saying tariffs are a one-off price increase in price levels. Standard central bank practice is to look through these price level effects, given the fact that the Fed chair, Jay Powell, has continuously said we need to wait for the tariff rates to decide whether or not we're going to cut rates. Also, interesting part, Q&A session. Has President Trump or anyone in the administration asked you to take on that role? Nope. Next question.
Nope. This is not political. Remember that the last time Governor Waller spoke? Let's talk about the data. This week, retail sales decent. Jobless claims better. Downside surprise on CPI, on PPI. You're going to have a very split FOMC at the meeting in a few weeks' time.
Especially because it's not just Chris Waller and Governor Bowman. It's also Mary Daly, the San Francisco Fed president, who spoke with our own Michael McKee and talked about how she does see a growing risk, and she's increasingly of the view, similar to Chris Waller, that the inflation coming from tariffs isn't going to be sustained. I just wonder if it's going to be 2 dissenters or if it's going to be more.
Chairman Powell might be increasingly lonely facing more and more criticism down in Washington, D.C., and writing a letter, I believe, or getting someone to write a letter back to the White House to talk about how seriously they take public resources.
Right. He went to the OMB director, Russ Vought, with this letter talking about the fact that, yes, they have this transparency now when it comes to renovations. They want to be honest with the administration. They say they have been transparent. The Fed has also added a web page for transparency on the renovations, according to Powell. He says they deny that there's VIP elevators. He defends the roof that they had to fix. Quote, there are no special private or VIP elevators being constructed as part of the project. Quote, there are other references in the plan to vegetated roofs, often referred to as green roofs, which are commonly used to help with stormwater management to increase building efficiency and roof longevity. Green roofs are found on other federal buildings like the Department of Justice. So really trying to make this case that what we are doing is normal procedure, and other institutions and buildings have done it as well.
I get the feeling even with this letter, this story won't die, right? It's not going to die.
I did not have on my bingo card for 2025 that we all would be scrutinizing the line items of the renovation of the new Fed building, yet here we are.
Here we are, doing okay. Equity futures on the S&P, positive once again by 0.1%. Coming up this hour, we'll catch up with Peter Oppenheimer of Goldman Sachs with stocks back at all-time highs. Tobin Marcus of Wolfe Research as Fed Chair Jay Powell responds to the White House, and Henry McVeigh of KKR on Governor Waller's push for a July rate cut. We begin this out with stocks at all-time highs and Fed Governor Chris Waller pushing for a rate cut. Peter Oppenheimer of Goldman Sachs writing, while U.S. fundamentals remain solid, the valuation premium is increasingly difficult to justify. Peter joins us now for more. Peter, welcome to the program, sir. Let's talk about the valuation premium and the why. The data this week is good. The earnings have been okay, and we've got an FOMC slowly leaning towards a rate cut. What's not to like?
Well, John, I think this is a relative rather than an absolute story. You're right. If interest rates are coming down, and we think they are, and the economy continues to grow, if even at a more moderate rate, generally that's a good backdrop for risk assets and for equities, and the US is no exception, particularly as it's increasingly again dominated by its biggest tech stocks, which are generating really strong earnings growth. But it's really the relative premium against other markets, which has reached a record high, which is harder to justify when other markets are beginning to see their own tailwinds. Europe, for example, is enjoying stronger growth. You know, we think about last year, the US economy was growing at nearly 3%. Germany was stagnant. By next year, they're likely to be growing at relatively similar rates, and yet the valuation gaps are extremely wide, and that's an opportunity, we think, to diversify.
It is a question of where you diversify, given the fact that a lot of people are expressing it through the currency, and the currency is having a balancing effect in so many ways, given the fact that it might actually be a tailwind for U.S. corporate earnings and a headwind for European ones. How do you factor that into this equation?
That's a very good point and absolutely right, and particularly for the dominant tech stocks, which are very global in terms of their revenue streams, and they have very strong balance sheets, a weaker dollar will help them. So that is good indeed for the dominant companies in the US. And from an earnings translation perspective, it's a headwind in Europe or indeed Asia. But on the other hand, in terms of flows, what we're beginning to see is more appetite for US investors to spread their risk, to diversify, to benefit from some currency gains that they may get in cheaper markets like Europe or emerging markets, for example. And indeed, it's also an increasing incentive for investors in Europe to keep more of their funds at home. So from an earnings translation perspective, it's a headwind in Europe, It's a tailwind in the US, but from a diversification perspective for investors, I think this is likely to encourage a broader spread of assets than we've generally seen over the last decade.
How interest rate sensitive is this story at a time where some people are talking about possibly an ECB cutting rates more quickly than a Fed, and then a question of whether maybe the Fed will cut rates just as quickly in perhaps a different composition at the Fed?
Well, we're more mature through the interest rate cycle in Europe, at least in the Eurozone. We're expecting one more rate cut, getting policy rates down to 1 3/4. We think we have a series of rate cuts to look forward to in the US to get policy rates down to 3 1/4. What I think is worth also emphasizing, though, is that while there are prospects for bigger rate cuts from a higher level in the US than perhaps in Europe, long-term interest rates are not really coming down, and that's a reflection, of course, of concerns about debt sustainability and debt financing, not just in the US, but in other countries as well. Bear in mind, in Germany, while we're getting these policy rate cuts, long-term interest rates are actually edging up as it also finally increases its borrowing and fiscal spending, which is good for growth, good for the equity market, but of course puts upward pressure on long-term interest rates.
Peter, speaking of Germany, the Bundesbank president today came out and said that challenges to Fed independence, which he calls in the DNA, the autonomy of good central banking, would resonate beyond the shores of the United States. What kind of impact could we see if we were to see the president of the United States get rid of Jay Powell and fire him in Europe or inside Asia and emerging markets?
Well, look, we shouldn't forget that independent central banks have not always been the norm throughout history, and this was something that really gained prominence in the 1990s and beyond. Of course, that has helped both to bring down inflation, to bring down inflation risk premia as investors have become more confident in stability, and have brought down risk premia and the cost of capital in general. I think anything that challenges the independence of the central bank will be reflected in higher risk premia. But I think we're a long way away from that. And as you've been saying in your reports, the conditions in the US are favoring interest rate cuts anyway. We're getting into a more benign phase of the cycle after the big inflation rises that we saw following the pandemic. Unemployment's edging up a little bit, and there is room to cut rates. That's true in the US, it's true across Europe, the UK, and other areas as well. And by the way, some weakness in the dollar and interest rates coming down in the US will resonate and be positive, I think, beyond US shores. Very beneficial, for example, for emerging markets also, which have tended to lag behind over a long period of time. So I think there's a long way, we're a long way away yet from people really worrying about central bank independence.
Let's hope you're right, sir. It's going to catch up. Peter Oppenheimer of Goldman Sachs. Peter, thank you. A little bit later this hour, we'll catch up with Henry McVeigh of KKR. Henry making the point we're about to see a global easing cycle, of which I'm sure the ECB and the Fed further down the road might be a part of.
Yeah, and this really speaks to the question of, is it justified at a time where you potentially have a lot of productivity gains, and you potentially have this entire investment cycle? And that's also part of what Henry McVeigh is talking about, the idea that we're about to see a reindustrialization akin to what we haven't seen for a very long time on the heels of AI that allows that disinflationary force along with strength.
What I find interesting in the intersection of politics with all of this, if people are starting to say that we're going to see rate cuts brought up, I mean, you have Christopher Waller talking about happening in the next 2 weeks, then Trump might get what he wants and Powell might still be the Fed chair. He might not have to fire him, and he's still going to be able to get what he wants right now, because some of the data for some people are pointing to the fact that there is an opening to bring interest rates down.
So much drama this week. Stock market, all-time highs going into the weekend. Equity futures this morning positive by another 1/10%. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Fed Governor Chris Waller is calling for the Fed to cut rates when they meet later this month. Waller said that inflation from tariffs will be temporary and warned that while the labour market looks fine on the surface, private sector job growth is near, quote, stall speed. Waller will join surveillance at 8 a.m. Eastern this morning. Elsewhere, Netflix beat expectations across the board in the second quarter, posting revenue of $11.1 billion. It also raised full-year guidance, forecasting $45 billion in sales and near 30% margin. The company's market cap now exceeds $500 billion as it leans into content and ads amid rising global competition. And President Trump has been diagnosed with chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says he remains in excellent health with no signs of DVT, heart failure or systemic illness, and doctors attribute the recent hand bruising to aspirin use and frequent handshakes, calling it benign. That's your Bloomberg Brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, pressure building on Fed Chair Jay Powell.
I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman.
Up next on the programme, Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
2 days of gains on the S&P 500, heading into the weekend at all-time highs and adding just a little bit of weight to the rally this morning. Up 0.1% on the S&P. On the NASDAQ, up 0.1% also. Bramo, yesterday, Mike Wilson, Morgan Stanley. This is what the beginning of a new bull market looks like.
And a lot of people seem to agree with him. Henry McVeigh of KKR, you mentioned him, he's going to be on later, seems to agree in the sense that suddenly we see this investment from AI percolating through the entire corporate ecosystem. That is what we're seeing in earnings, and that is the reason why people are looking past all of the noise in the headlines. They're sick of them. They want to just see what the companies are actually doing.
Freaking out for the last several months about policy. I get it for good reason. You sat down with Scott Kirby of United Airlines. When you listen to these business leaders right now, just stay in the course. Seem pretty confident about the back half of 25.
After they saw the one big beautiful bill passed, companies got a lot more confident. People started traveling more for business. But then you saw consumers sick of just being numb by headlines. confidence. They want to travel. They want to spend. Watch what they do, not what they say. When you watch what they do, they're still going out there and living just as the way that they did before.
If you are just tuning in, welcome to the program. Stocks on a record-breaking run once again on the S&P 500 this morning, just about positive. Under surveillance this morning, pressure building on Fed Chair Jay Powell.
I don't believe there's a deadline the president has set for Rust Belt, but I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman. It's completely unnecessary. It's overpriced, and I think it's a good thing the administration, led by the president, is looking into it.
Here's the latest this morning. Fed Chair Jay Powell responding to White House criticism over the Fed's renovation project, writing in a letter to the Director of the Office of Management and Budget, "We take seriously the responsibility to be good stewards of public resources as we fulfill the duties given to us by Congress on behalf of the American people." Joining us now from Washington, Mike Shepard. Shep, as we said at the start of this program, this story just won't die.
Eager to keep this one alive because, in a way, they are trying to lay the groundwork for a possible case to move against Powell if President Donald Trump really does want to set up a decision to fire him. At some point, they would need some grounds, they would need some cause. And we have heard the president and his allies, you just heard White House Press Secretary Caroline Leavitt refer to it again, making these accusations of lavish spending. The Fed chair is trying to counter all that, pointing to the fact that, look, these buildings that constitute the Fed headquarters near the National Mall here in downtown Washington, they're nearly a century old, and they need extensive upgrades. They have not been renovated really since they were constructed in the 1930s, and they need extensive abatement of lead and asbestos and other safety upgrades for fire and ventilation purposes too. But look, John, this is really far less about a renovation project. It's really about whether the Fed chairman will heed the president's call to lower interest rates. This is a case that Donald Trump made in the Oval Office on Wednesday with Anne-Marie Hordern right next to him, practically, hearing him argue for lower rates. But right now, the Fed chair is not ready to bend to the president's will. He is not prepared to do so. He wants to see the data. For Donald Trump, the data are there. He is calling for this. He sees the European Central Bank making moves in that direction. He's also looking at what many are seeing as relatively low or tame inflation, giving the Fed enough leeway to act. So we're going to have to be watching this very closely, both on the renovation front and on the body language when it comes to interest rates. John.
Mike Shepard, thank you, sir. Shep, we'll catch up with you in the next hour. Joining us now to extend the conversation, Tobin Marcus of Wolfe Research. Tobin, welcome to the program. Endgame. Just what is the endgame right here in Washington?
So I think the end game remains to be determined by the president. I think that what we're seeing now in terms of the investigation and the heavy public criticism of this renovation project is giving him optionality, which has often been the approach in this administration. I think they're trying to create a legal predicate if they need it, since the Supreme Court has made clear that they're not going to accept a Fed chair firing without cause. You know, that we're seeing a kind of pretextual effort to establish cause if the president decides to go down that road. But I do not think that a decision has been made.
Well, if a decision hasn't been made, though, and he continues to go after Jay Powell, potentially to give him an opening to firing, but if he doesn't, and say we even see the Fed chair come out and announce at some point between now and the end of the year a Fed cut, what kind of damage is being done in this interim?
I think as long as nothing really dramatic actually happens, it's not going to be the kind of thing that worries markets long term. I think it's going to, it'll continue to worry those of us in the policy community. It's not a great thing to see. There's definitely a process of kind of politicization going on in terms of a more overt effort to put pressure on the Fed. Obviously, it's not completely insulated from political pressure, sort of cycle in and cycle out. But this is clearly more overt than we typically see. But I don't think it's going to be something that, concretely impacts markets if they don't actually go ahead and make a real attempt to fire him.
As Mike Shep was saying, I was in the Oval Office with the president on Wednesday, and we were questioning him about this. And walking in, I saw the renovations underway for the Rose Garden, a second time for this president. We've also seen this president also have cost overruns when it comes to Air Force One. Does this argument work for someone who has also had renovations and cost overruns?
I think when you're looking at the renovation project objectively, it's expensive. It is somewhat overcost. I'm sure it has not been executed perfectly. But to your point, government renovation projects, government, projects in general very commonly run over costs. So, again, I think it's fairly clearly pretextual. If they do end up in litigation over this, like the fact that it's pretextual doesn't necessarily mean that it won't work. I do think there will be some reluctance from the conservative majority on the Supreme Court to second guess executive discretion about what constitutes cause. The kind of legal definitions about what constitutes cause are fairly vague and have not been extensively litigated. There are these general terms like inefficiency and neglect of duty. So again, I think they can make the case. But it does certainly put those of us in the policy business in an unusual position of being, experts on beehive costs and marble and so forth these days.
Tobin, it's true, and we all are sort of wondering how August or July of 2025 became the renovation month, where we all became experts. I'm curious if you understand why. Why now? Why we're getting this sort of push to get rid of Fed Chair Jay Powell after there had been a lot of discussions earlier this year. The economy is doing okay. We are seeing a stock market near all-time highs. Do you have a sense of the timing and the purpose behind it?
Well, look, I think the president has been pretty clearly frustrated with Powell for a long time, and this is something that he has been thinking about on and off. To your point, we've had sort of another cycle of this in April when the speculation about a possible firing reached kind of a boiling point, and then they took down the temperature a little bit. So I think the frustration has never gone away, and it's sort of bubbling to the surface again based on the latest data. I mean, to your point, the fact that markets are at all-time highs is something that President Trump has pointed out as a reason to cut rates. I think most of the folks in the Fed system would look at it the opposite way, that's a source of, easy financial conditions that would not necessarily make you think that you need to cut rates. It is kind of a murky data picture. I think the arguments on both sides are pretty real, but I don't think that Powell's going to change his position anytime soon.
How much support does President Trump have in Congress to really go through with a move like this?
I think he has enough support to get a successor confirmed, which is all that really matters. There's plenty of concern about this. You have had various Senate Republicans going on the record with their concerns over the course of the past few days, but I don't think they're going to do anything about it. I'd be very, very, very surprised to see anything like a threatened embargo of a potential successor if Powell is ousted, which is really the kind of point of leverage that they have. I really do not think anyone's prepared to cross that bridge. And short of that, he referenced the enthusiastic reception he got from House conservatives when floating this possibility the other day. Again, the sort of senators and moderates are more apprehensive, but all of them, I think, are hoping for an outcome rather than trying to effectuate it.
Tobin Marcus of Wolf Research. Tobin, thank you, sir. You're right to keep pointing out all-time highs in the equity market. I wonder how long they'll last if you do fire the Fed chair.
It depends on whether the market responds pretty much the way we imagine that it would, which is a weaker dollar and higher long-term yields, because essentially this would undermine some of the long institutional belief that, yes, the Fed is independent. Is that part of the reason why President Trump is reluctant to really take this ultimate step?
Market's not pushing back yet, though, is it? And we've talked about this a few times with regards to trade as well. Is that a market ignoring some of these policy threats or endorsing them? And the president reflected on that to start the week, suggesting that maybe it's an endorsement of some of these threats.
Or is it a market that's had its face ripped off 15 million times and is sick of getting whipsawed by a headline that gets reversed to prove a point? So they're not going to even do it. So ultimately, President Trump is playing chicken with a market that doesn't want to respond too soon. It sets up a pretty uncomfortable situation.
That right there is the sound of exhaustion going into the weekend. Just exhausted by some of these stories, not just you. I think all of us. Coming up on the program, Jason Bazinet of Citi on another strong quarter for Netflix, plus Yahira with your morning movers, and an update on the race to power AI.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Later on this morning, in about 1 hour and 30 minutes time, a must-watch conversation. Governor Waller, 8 a.m. Eastern time, right here, live and exclusive on Bloomberg Surveillance, making the case for a 25 basis point rate cut. The big push starts right now.
Saying that the risk to the labor market is clearly more of a concern to him than any kind of potential prolonged inflationary wave coming from tariffs. Is this the shadow Fed chair? How much clout does this type of proclamation have on the broader committee?
I'm not sure he'd describe himself as that.
I can guarantee he won't.
But others might in the months to come. Equity futures on the S&P 500, just about positive. Welcome to the program. 2 days of gains into Friday, going into the weekend at record highs. On the Nasdaq 100, just about positive, 2 unchanged so far this morning. With 3 hours until the opening bell, let's get you some morning moves and cross over to Yahira. Hey, Yahira.
Hi, John. It was another blowout quarter for Netflix, but as you can see, shares are lower by 1.6%. That's because the stock has had a huge run-up in the past year. But as I said, another exceptional quarter. Profits, revenue, and forecasts all topped expectations. And given its international presence, a weaker dollar helped contribute to that. It's also part of the reason why it expects net income to exceed $10 billion for the first time ever this year. So quite the milestone for the streamer. And we move on to Circle. Those shares are up 2% after Congress handed the crypto industry a big win. Lawmakers passed the first federal law to regulate stablecoins, the digital tokens tied to the dollar, and Circle is one of the companies that issues those coins. And there is no shortage of deals in the energy space due to the AI boom. And here is the latest. It involves Talon Energy, which is up nearly 15% after announcing a $3.8 billion purchase of 2 major natural gas plants in Pennsylvania and Ohio. This is as we see the biggest surge in electricity demand due to AI in decades, and these gas power plants are able to provide that around-the-clock power needed to power them. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, one of our top stories, Fed Governor Chris Waller saying the central bank should cut rates this month. Waller saying the labor market is, quote, on the edge, and policymakers should not wait until it worsens. This is a forceful argument against the key line coming out of the Federal Reserve over the past few months. The economy is solid, and we can wait. Here's a gentleman that's telling you the economy is no longer solid.
He's pointing to the private payrolls. When he says you look under the hood, you can see that any kind of increase in some of the payrolls number has come from public sector hiring, and it doesn't speak to the kind of strength that would lead to wage increases. That's a key component of any kind of inflationary wave. The reason why we're focusing on him, I think, might be more interesting than even his argument, which is he is considered the dark horse to be the next Fed chair, Is his view taking disproportionate clout when it comes to swaying other members, especially with some of the jawboning coming from the White House?
What is so interesting about his case right now is that, of course, he is a name that continuously gets called upon, potentially that can become Fed chair. But this is someone who, because he is making an economic case, and he's not just throwing, spaghetti at the wall in terms of how bad Jay Powell is for a number of things like renovations. He's making an economic case, which means he's credible inside the institution. He's credible to economic voices at the White House, and he's credible, most importantly, to the market.
I heard the same thing from Neil Datta of Ranmac, that if you want lower rates, that's the guy that can help affect the situation, because he's inside the institution giving you a credible economic argument to lower interest rates, and he can bring the committee with him. You select someone from the outside, to your point, Anne-Marie, that quest, that mission is a whole lot harder.
If you have someone who's quoting the Beige Book as justification
Get
for
on
why
board.
to cut rates, get on board. If you have someone who's saying you need to overhaul the whole institution, and really this is just a total bungled organization that has caused inflation to take off, well, it's a little bit of a harder sell and lacks the same kind of credibility.
We'll give Governor Waller some time to present his argument a little bit later this morning. Again, don't miss that at 8 a.m. Eastern Time, a must-watch conversation. Let's turn to this story. The EU hitting Russia with a fresh round of sanctions over its war in Ukraine. The EU cutting off 20 additional Russian banks from international payment systems and setting a tight curb on fuel made from Russian crude.
So this goes back to the oil price cap, and they proposed moving it from $60 a barrel to $45. They ended on $48 a barrel. What I would note is that this is an important development, and it's really being welcomed by Ukraine in terms of continuing the pressure on Russia. But the start of the year, I can't get over this report for the Center for Research on Energy and Clean Air. The EU is spending more money on Russian fossil fuels that they continuously import than they are on financial aid to Ukraine. And the EU has yet to completely end its reliance on Russian oil and gas. They're going to do that not this year, not next year. The aim is for 2027.
When you break it down like that, the whole thing sounds absolutely ridiculous. For all the calls of the Europeans to get the United States to put pressure on the Russians, when you hear it broken down the way you just did, it's just absolute nonsense.
It sort of points to the moral high ground. Who really has it in terms of taking a hard line on Russia? And at this point, how much clout does Europe have, even with each other, to get each other on board to execute some of these potential policies?
That's the latest on the war between Russia and Ukraine. I wanted to squeeze this story in. Wells Fargo suspending travel to China after one of its top traders was blocked from leaving the country. The U.S. Embassy said it raised the case with Chinese authorities. China's foreign ministry said it wasn't familiar with the situation.
Meanwhile, Wells Fargo has banned all travel, at least temporarily, for its employees. What a shocker. This really just goes to underscore why it is so difficult for multinationals in the United States to do business in China. And increasingly so, especially if any individual over in that country is used as a pawn in any kind of escalating trade war. I know that, John, you've been eager to get to China. I just wonder if that's going to be, potentially something that hampers that.
I don't think John will be going to China anytime soon, but China's use of exit bans has been this point of contention between Beijing and Washington. The State Department repeatedly advises citizens to reconsider travel to China based on what it calls the arbitrary enforcement of local laws, including what happens with exit bans. And this is why you see a number of banks and companies really scale down how much they want to send travelers over to China.
It's getting harder and harder to do business in both countries at the moment. Let's put it that way. Let's turn to the earnings. Netflix reporting better than expected second quarter results and raising its full year forecast. Jason Bazinet of Citi has a neutral rating and a $12.50 price target on Netflix, and he joins us now for more. Jason, welcome to the program, sir. Decent numbers. Stock's a little bit lower in the pre-market. Do you think that's just a reflection of what a strong rally we've had year to date of something like 40% plus?
I think it's a little bit the rally and a little bit the source of the beat was really the weaker U.S. dollar. So it's sort of viewed as a sort of low quality beat, if you want to think about it that way.
So if you strip out the FX tailwind, Jason, what's left?
In terms of
where the
why else they
performance
beat
came
the quarter?
from?
Yeah. I mean, look, they had decent pricing growth. They had decent sub growth. I mean, they're definitely growing in ways other than a weaker U.S. dollar. My only point is the source of the beat was primarily related to the weaker dollar.
It goes to the question of how high the bar is at this point for the earnings, especially given the fact, as John mentioned, it's up more than 42% so far year to date. I just wonder if this is still a growth stock in the same kind of way, given that they no longer provide subscriber information and they're really facing off with pretty significant penetration.
Yeah, no, I agree with you. I mean, if I went back 18 months ago, the bull case on Netflix was a 25 multiple on 25 earnings. And now the bull case is a 40 multiple on 2027 earnings, which the bulls would argue is $1,600 a share. The question is, why so much multiple expansion from 25 times to 40 times? I would argue what Netflix has benefited from is really sort of a safe haven status from PMs. They look at Netflix, they say there's no AI risk, there's no recession risk, there's no government intervention, there's no tariff risk. So if you owned one of these big mega cap companies and you go look for a safe harbor, Netflix checks all those boxes, and that's why you've seen the multiple expansion. The question going forward is, can it hold this multiple? And if you look at street numbers and even the company's leaked memo, it talks about top line growth decelerating over the next 4 years. So that's the real question. Can the multiple hold at this elevated level if the top line is going to decelerate going forward?
There's a deeper economic question underpinning this as well, which is, do they have the power to raise prices substantially, given the fact that a lot of people are concerned about the trajectory for the average consumer? Do you get the sense that people are overestimating their ability to keep charging us more and more?
When I do the math on Netflix, their price per consumed minute sits right on top of linear television. So the threshold question is, can they continue to grow engagement? The troubling thing that is beginning to happen, and it came up over and over again on the earnings call last night, is Netflix is sort of winning the battle against pay TV as pay TV declines. It is losing the war relative to consumers' consumption of video. And the best example of this is over the last 18 months, Netflix and YouTube were at parity of 8% of U.S. viewing share. Netflix is still 8%. They've been flat. And yet YouTube has gone from 8% share to 12%. And so what consumers are saying is they want to embrace these sort of open platforms, lean into the creator economy, where Netflix really isn't participating. And that's the challenge. If they don't get their share of viewing up, then it's going to be difficult to continue to increase prices.
How could they participate in that space?
Well, there's sort of the half step and then there's the full step, right? The half step would be to go into some of the most iconic creators on YouTube and give them their own show on Netflix, which is produced by Netflix, greenlit by Netflix. That's sort of the half step. The full step would be just to go in a more full-throated way and set up a parallel business very similar to YouTube, where you just sort of open up your platform, you let people upload videos to it, and then there's all sorts of questions around, does that dilute the Netflix brand? Is that, content high quality enough? And so those are strategic questions that Netflix is going to have to answer.
And how would they make money in that case? Would it just be through traditional advertising?
Well, yeah, exactly. I mean, if you look at YouTube's, payout, it runs about roughly half of all the revenue that comes in is paid out to the creators. It's not totally obvious to me that would be dilutive to Netflix's margins. If you look at their cost of goods for all the content that they produce, it's sort of in that same zip code.
Jason Bazinet of Citi. Jason, appreciate you jumping on to catch up with us. Thank you, sir. Stock is lower in the pre-market by close to 2% after a major rally so far year to date.
What he was just talking about is fascinating, how quickly YouTube has gained against
Massive.
Netflix. And I wonder how much this is just that people's attention spans are really low.
Getting shorter and shorter.
And so if you have some kind of cute little clip that's really attention grabbing, that's generated specifically for you.
Speaking from experience, aren't you?
That you can handle it for about 2 minutes.
Just sit there scrolling.
And you don't fall asleep.
I want to see your Explore page.
Please don't. Can you imagine? Yeah, that's me.
Just sort of golf clips on my end. Just sort of sit there scrolling.
Sure. Yeah.
Then they filter tennis in. If you watch it for too long, all you get is tennis. Just like that.
It's pretty much anything.
I know.
It sort of reminds you of your bad habits in real time.
Sports, apparently. We're down about 1.7% on Netflix. You haven't shared your bad habits. I don't know what you're looking at.
Mine is rehabilitation of abandoned pets.
Okay. That's what, you do that in the morning or at night?
Let's move on.
Okay, all right. That sounds fine. Let's give you an update on stories elsewhere this morning. Find something new out every single day. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump authorized the Justice Department to seek the release of grand jury testimony in the Jeffrey Epstein case. The move came after the Wall Street Journal published a story alleging that Trump sent a suggestive letter to Epstein for his birthday. Trump called the accusations fake, and it's unclear whether the testimony, which is typically kept secret, will be released. Elsewhere, Burberry shares are getting a boost in London trading. The luxury fashion house reporting a smaller than expected decline in comparable sales. It also saw better than expected growth in its Americas segment. And Apple is losing more top talent. Sources telling us here at Bloomberg that Meta hired a pair of key AI researchers who work for the iPhone maker's Superintelligence Labs team. Earlier this week, Zuckerberg posted on Threads that Meta would invest hundreds of billions of dollars on advanced AI. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, Governor Waller pushing for a rate cut.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, I would support even further 25 basis point cuts to move policy towards neutral.
Up next on the programme, Henry McVeigh of KKR, live from New York City. You're watching Bloomberg TV.
You missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the U.S. is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The president up early, going after Chairman Powell once again. Here's the quote from this post this morning. Too late in the Fed, choking out the housing market and their high rate makes it difficult for people, especially the young, to buy a house. Goes on to say, he is truly one of my worst appointments. Some acknowledgement of the fact that he did appoint him to be Fed chair.
Yeah, it does raise a question of how he's going to avoid making that type of what he would view as a mistake going forward in his next Fed selection. How can he ensure that if they're looking at the economic data and that really is the driving factor?
That line is standing out to me. He's truly one of my worst appointments because on Wednesday, the president said who appointed this guy, and then Joe Biden reappointed him, pretty much glossing over the fact that actually it was Trump and his administration that first gave Powell that job. So here is a little bit of introspective looking from the president of the United States saying, I actually put him there and it wasn't a good decision.
If you are just joining us, welcome to the program. Some division emerging at the Federal Reserve. Under surveillance this morning, Governor Waller pushing for a rate cut.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
Here's the latest this morning. Federal Reserve Governor Christopher Waller pushing for rate cuts. Henry McVeigh of KKR writing the following: our glass still half full thinking is that attractive financial conditions, a global easing cycle, and ongoing productivity gains will continue to drive this cycle both further and longer than many people think. I'm pleased to say that Henry joins us in the studio. Henry, good morning. Good to see you.
It's great to see you. Thanks for having me in.
Thanks for being here. Let's talk about the price of the story. You say markets are reasonably valued and not overvalued. What's the difference between the two?
So I think what we've seen over the years is that the quality of the S&P has actually improved, right? You cut taxes, corporate taxes went from 31 to 21, so there's more free cash flow. The second is that the index has moved to be more towards services companies that have a higher return on capital, and then they have higher margins. So I think what we've seen, this whole rally has been fought. If you go back, we were up 55% in the last 2.5 years. And generally, there's been a lot of noise out there, and so people have not gotten fully invested. Our view is that the cycle will go on. This is like the 90s and the 60s, where you have a productivity-driven cycle. They last longer. 2022 was like 1994, where the bond market sold off. People moved to the sidelines. You really wanted to buy that in 1995, and it ran for another 5 years. We think that's very similar. Productivity-driven cycles, they just act differently, right? Most people would say ISM's been below 50 for 26 out of 27 months, and we haven't had a recession. There's something different going on, and we've seen this 1 or 2 other decades. We own 200 companies around the world. We've got lots of different data points on how corporates are functioning, and when COVID hit, what they did is they really focused on automation and digitalization. We were talking about this a little bit before, and that spending is yielding really good results. I don't actually think we've had the AI boom flow through the data yet. And so that's, I think you have to keep that in check, but I think that could be a little more addition to this productivity-driven cycle that we've seen. It's largely in the U.S. I mean, I travel all around the world. We've got 24 offices, but most CEOs today need, for competitive reasons, to invest in technology, and they're squeezing more out of their business and their cash flow.
If you have this huge investment boom, you have a huge technology cycle, and you have consumers that are hanging in there. We just saw that with retail sales. What gives you confidence that inflation is going to come down enough over the long term to lead to a global easing cycle?
Yeah, so this is a great question. My actually view, we've been talking about at KKR, this higher resting heart rate for inflation this time. The Fed has told us they're going to miss their mandate for 7 years in a row. I bet there are very few of your viewers who actually were investing when they missed it 7 years in a row. So I actually don't think in the U.S. it's going to come down. What's different, the global easing cycle, we track the top 25 central banks around the world and what they're doing. In 2022, 84% of them were raising rates. Today, only 8 are. So they're starting to ease. This cycle was actually led by the ECB. It's the first time we actually had the ECB out in front of the Fed. So I think inflation will stay stickier here than in other places of the world, but you have to look at it on a global basis. And one other point I would say is that when I started doing financial services and macro, the Fed's balance sheet was about 6% of GDP. Then it went to 34% during COVID, and then it's back down to 22 to 24%. That's still a huge number. That's a multiple of 4 versus normal, and that money is sitting on the sidelines. And it is, particularly in the insurance arena, that money needs to get invested to make the retirees actually achieve their returns. So the credit markets this cycle, you have less bank deleveraging, you got higher quality, high yield, and then you've got this kind of tsunami of money that needs to get invested. One of the things that I love about our platform is we can look across relative value across the capital structure, and what you see, it changes by day in terms of where there's value in credit, but overall, it's behaved incredibly, much more benign this cycle than in the prior cycles.
And the higher yields has led a lot of people to say this is the golden era for credit, particularly private credit, and moving away from private equity.
Yeah.
And we've seen some real concern about exits not coming to the fore, and now universities selling some of their PE holdings for liquidity. Why do you push back against the idea that this really could lead to some sort of material weakening in the base of your original business?
Yeah, so what I would say is one of the reasons in 2006 and 2007, KKR probably over-deployed a little bit. You have to have linear pacing when you do private equity. This year, in 21, 22, and 23, we did kind of a quarter of the fund. That's the way you never have to make a big bet. What the industry did is it probably, in general, overinvested in 21 and early 22, so they're going to have to work that out. So I do think we've led to some differentiated outcomes. I think for the industry, though, what you're starting to see right now is monetizations pick up a little bit, the IPO market's opening over time, and you've seen this real shift in our focus. This is a world where you're going to make more private equity, kind of make your own luck through operational improvement, corporate carve-outs, public to privates. I think there'll be less that vintage where many in private equity were going private to private investments. I don't think those deals will perform as well. We certainly, one of the reasons I have a job is we had made that mistake in 2006 and 7, and I think the industry will catch up to where we are after this latest cycle. So I'm not as, for overall, I acknowledge there was over-deployment for the industry in 21 and 22. I don't think we're suffering from that. And in general, what I would say is that over time, if you're a long-term investor, private equity has delivered about 400 to 500 basis points better than most public equity markets.
We just have about a minute. America versus Europe.
Yeah.
Which do you prefer? And it's because you don't believe in American exceptionalism.
I think that what we're seeing in both regions is they're going to perform. The U.S. today has better companies. What the sentiment coming out of Davos was so negative on Europe. If they just did anything, I mean, you guys reported on this. Yeah. If anything went well, they delivered. Interestingly, Europe has actually been one of our best performing regions. A lot of really good entrepreneurs, a lot of stuff in infrastructure that's done well. Huh?
Will it keep being its best?
I think where you should watch, I think defense stocks are going to do well there. I think that financial services are going to do well, and watch some of the smaller tech companies. But over time, it's all about productivity. We've been saying that for years. Continue to focus on that. Happy to come back and beat the drum on that. So happy Friday to you all.
Look forward to seeing you again. Okay. Perfect wrap for the conversation, sir.
Sounds good.
You're a professional. Thank you. Henrik Vey there of KKR. A range of issues to work through. That wall of money, though, is key.
And that's one reason why a lot of people, including Mike Wilson, who is colored as this huge bear on Wall Street, has actually turned really positive and says it's the early stages, as he was talking to you guys yesterday, of some sort of bull market.
The amount of money that's been invested right now, you were talking about that briefly, is unbelievable. A quote that stands out for me in the last 12 months or so came from the Alphabet CEO. The biggest risk right now for them is underinvesting and not over-investing. They see some of these themes, these trends, the technological advancements of the last several years as an existential risk to their companies. And I think you see that, not in the words, not just in the words of the Alphabet CEO, but also in the actions of the Meta CEO, Mark Zuckerberg, in the past few months.
And when you talk to executives across corporate America, it's not just the big tech CEOs that are talking about this. It's everyone. It's even the retailers. It's the fast food players. It's just this idea you need to be in on a game that is not going away.
The conversation continues on Bloomberg Surveillance. Coming up next, Dan Greenhouse of Solis Alternative Asset Management, Monica Guerra of Morgan Stanley, the SEC Chair, Paul Adkins, and Sarah Malik of Nuveen. The second hour of Bloomberg Surveillance is up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
A cidade estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida. Eu temo
né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The underlying economy remains relatively strong.
There is pent-up demand in the economy.
There's a lot of fragmentation in this U.S. consumer right now.
Low-end consumer has been in trouble for quite some time.
I think we'll see that better read probably in August and September on really the true health of the consumer.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs heading into the weekend in the equity market at the moment. We're positive by not even 0.1%, just about unchanged on the NASDAQ 100. Later on this morning, 60 minutes from now, must-watch conversation. The Fed Governor, Christopher Waller, on this program after making the argument for a 25 basis point rate reduction.
And a 25 basis point reduction this month, and that is out of consensus. He is one of two members. The other, Mickey Bowman, has suggested she'd be open to this. But if you listen to the rhetoric of a growing number of other Fed chairs, it also signals a potential openness to this type of rate cut, given the fact there hasn't been the same kind of growth in the labor market that many of them would like to see.
He is making a credible argument for lower interest rates, which will be music to the ears of this guy right here, the President of the United States, writing just moments ago, too late and the Fed are choking out the housing market with their high rates.
And the president saying that Jay Powell's one of his worst appointments. He's clearly frustrated. He's going after the renovations at the Fed. He continuously talks about how the rate needs to come down. But Jonathan, the words you used just there, credible. When you have Governor Waller coming out and listing the economic reasons why he thinks there should be a Fed rate cut, he is not only credible to the institution of the Fed, he's making arguments when he talks about tariffs being only a one-off increase in price levels. That's credibility to the economic advisors in the White House, and he's credible right now to the markets.
Consequences and risks. You've been focused on this for quite a while. Just to reflect on the 100 basis points of easing at the back end of last year and what happened at the long end of the curve when they did that. Yields went up, not down. Mortgage rates were higher, not lower. And that's going to be an interesting piece of the conversation later this morning.
To take a phrase that you've said quite a bit about other potential policy changes, the market has a vote. And this, to me, really is the ultimate question. Did we get a sense of what that vote would look like earlier this week when President Trump did suggest that he was ready to fire Powell, or at least that it was reported that he had drafted even a letter to do so? It just raises a question. Is the market in a place to understand that, yes, it is an appropriate time to cut rates by 50 basis points this year? And the answer is yes. That's the amazing thing. But how much more do you ultimately end up seeing?
The president talked about the fact, at least when I was in the Oval Office, about it was concepts of a plan of potentially firing Jay Powell, and he was spitfiring basically Republicans about potentially doing this. But asked yesterday, Governor Waller, he was asked, has Trump or anyone in the Trump administration asked you potentially to take that job? Nope. Next question. He doesn't want to be caught in the politics of this, and he's squarely focused on the economic reasoning behind his thesis of cutting Fed rates.
That specific question might be one we avoid a little bit later this morning. One-word answers aren't great for TV, are they? Just sort of nope. Move on.
Are you the shadow Fed chair? Nope. Have you talked to President Trump? Nope. Are you planning on being the next Fed chair?
Remember Chairman Powell in the news conference?
Yep.
Can you be fired?
Nope.
No.
Well, there you go. This sort of sets off the battle. It is going to be an interesting point, though. Who is going to be watching this interview?
Bond yields this morning lower by 2 basis points on a 2-year. On a 10-year, we're down by 2 basis points to 4.43. Coming up this hour, Dan Greenhouse of Solace Alternative Asset Management as stocks set new highs. Monica Guerra of Morgan Stanley as Fed Chair Jay Powell addresses White House criticism, and SEC Chair Paul Atkins on a victory for the crypto industry. We begin this hour with stocks steady following a week of stronger than expected economic data. Dan Greenhouse of Solace Alternative Asset Management writing, certainly everyone thinks the coast is all clear, but I'd like to see the July and August data before drinking my own Kool-Aid. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
Do you like the data you've seen so far?
Yes, of course. And I think I tried to get the chart, but apparently we couldn't get it in time. But Anna Wong from Bloomberg Economics has a terrific chart showing the Bloomberg surprise indices.
I'll get Bobby in the control room to bring it up.
Jimmy, I think it was Jimmy. Who I have
it.
made famous despite not existing. But yes, but the point of the indices are that you see inflation surprise indices are obviously coming in less than expected. Growth indices are coming in above expectations. And I think more than anything else, that explains the situation which we find ourselves. And when people ask TV, investors, whomever, why are equity markets at a high? Why are credit spreads as tight? That's as good an answer as anything that you could give.
The labour market's on the edge. According to Governor Waller on the FOMC, do you think the labour market's on the edge?
I don't know if I'd say it's on the edge, but you've clearly seen a deceleration. He mentioned, I mean, his speech is, for those of us who have been talking about the likelihood of a rate cut while not positioning ourselves for Fed chair, although I would take the job, admittedly. Waller's speech is everything that we've been talking about, and he mentions how private sector job growth has decelerated. Last month it printed in the double digits, and you want to be ahead of this weakness. And I think on the labor market front, that's a correct argument to make. I've been making it. I'm glad to see him doing so, and I think it's the correct one.
The ironic thing is that the committee believes in cutting rates by 50 basis points. That's the midpoint of the committee. Does it matter if they do it this month or if they do it in September? Does it matter if they do it 1 time or 2 times, if it's 50 basis points? How much of a consequence, to John's point, does this have for longer-term inflation?
I always appreciate you asking questions that you know the answer to. The answer is no. 1 month, 2 months, 3 months here or there doesn't matter.
I don't know. Maybe it matters tremendously to you, but carry on.
I don't think it matters.
Okay.
I'd be hard-pressed
They're
to believe
Lisa's
it.
favorites.
Well.
All right, let's move on.
But like, so if the point is the direction of travel. So we know, I would argue that your over-under over the next 12 months, let's say, is for 100 basis points of reductions to get yourself into the mid-3s by next summer, something like that. That seems to me to be entirely justified. And in Waller's Q&A yesterday, he got asked about a long cycle, so to speak. So whenever you talk about interest rate reductions, it becomes 200, 300. His point in the Q&A was simply, let's just get the process started here. I think we're restrictive. We shouldn't be restrictive. And I think that's the argument I'm making. Again, I think you can get 4 reductions by next summer. But the point is that I think rates are too high at this point. You've seen some deceleration. I don't believe the tariff and inflation story, which he touched on, And so when you put that all together, the basis is there, the context is there for some rate reductions.
You talked a little bit about how there is no true political independence on the Federal Reserve, which is a pretty provocative statement given that a lot of people have spent a lot of time, including myself, talking about what the loss of political independence would mean for the Fed and what kind of risk premium that would really charge on U.S. assets. Why do you reject this notion that this is even something that we should really be spending so much time on?
It's not that I reject that the central bank is independent, because clearly it is. What I reject is the idea that somehow it's completely devoid of politics. The chair is obviously appointed by the president. The board is appointed by the president, approved by the Senate. Famously, during the GFC, the Fed chair and the Treasury Secretary were having lunch every day, or at least once a week. That's a tradition that has continued, as I understand it. So my point is just, let's not live in a fairy tale land where politics plays no role. Do I think Jay Powell is holding rates steady and coercing the board to do so for politics? No, I don't. Do I think that politics plays a role in the central bank? Yes, I do. So, but within that context, I do hope, as all bank CEOs have articulated, and I imagine many people who sit in my seat have articulated, I do hope that the existing amount of central bank independence that we have persists. And I would point to the recent Supreme Court cases. There is a push for everyone in the executive branch to be answerable to the president, a view that I largely ascribe to. Two court cases, Wilcox and Saylor Law, obviously have played into this idea that the head of the Consumer Financial Protection Board, the FHFA, et cetera, are fireable by the president. But as many people know, that the Supreme Court seems to have carved out the Fed chair from that grouping, owing to its historical roots in the first and second Bank of the United States. I'm not sure if a case came to the United States that would hold up, came to the Supreme Court that would hold up, but at least for now, that seems to be in place.
To your point, though, on Fed independence, JP Morgan put out a note yesterday talking about the myth of this independence. And if Jay Powell is fired or stepped down, or even if we're thinking about just who Trump is going to appoint next, who do you think is actually credible, given the fact that we've seen people change their tone to really try to ingratiate themselves to what the president wants to see?
I don't think there's any doubt that the most credible of the people being discussed is Christopher Waller. He is known by the street. He was director of research at the Federal Reserve, became a governor, and was immediately thought of as a thought leader on the board, and correctly so, and remains today. He is, as I mentioned earlier, articulating the most cogent and, I would argue, accurate case for why rates can and should come down. I think if he was appointed Federal Reserve Chair next year, I don't think the street would have any problem with that at all.
So markets wouldn't push back, but what about the two Kevins?
I don't think the markets would push back per se. It's not as if it's not as if you're making the Hamburglar the head of the Federal Reserve. I mean, these are all qualified, credible individuals. Obviously, there's a political component to them varying up and down the spectrum. I don't think the market would necessarily freak out. Now, that said, if you were able to and successfully fire the Fed chair for the stated reason that interest rates should be lower, and someone came in and immediately cut by 50 or 75 basis points, we might be having a different conversation. But to the extent that a president of the United States wants lower interest rates, I don't think that's necessarily front page news.
This market has hardly blinked. In fact, when we had the reports out about the firing of the Fed chair, all of these reports started to drop. He's got a letter, it's imminent. Markets barely moved. I thought that price action was really tame. And I found a lot of the price action to be very tame in the face of increasing threats coming from the White House. Why do you think that is?
Well, listen, the short term is algo-driven, so I will chalk any short-term move up to algorithms. But the truth is, in this conversation, the larger issue with respect to the central bank is not a minute, an hour move. It's what happens, to Lisa's insinuation earlier, what happens over time. How much extra compensation do investors demand for a central bank that they perceive to be less independent? That's worth 25, 50, whatever it might be, basis points over the long term, which ultimately increases borrowing costs for the United States. So I wouldn't look too much into that short-term move the other day and say, well, the curve steepened, the dollar sold off. I'm not saying they're illegitimate moves or incorrect moves. I just think this issue plays out over a much longer period of time than an hour.
And the answer is more. They want more compensation for holding U.S. assets.
And how much is this going to be expressed in the yield curve? How much is this going to be expressed through the currency channels? A lot of people saying the currency channels are going to bear the brunt of it, which is why the consensus right now, and the most crowded trade according to the last BAML survey, is short dollar.
Dan talked about qualifications. It's not about qualifications, it's about motives and perceived motives. The perception of the market of what the motives are of that individual. And if they come from within the White House, given the pressure that's being put on at the moment, clearly a lot of people in this market will perceive that individual as having motives that are distinct and divorced from where the economic data is, and ultimately they'll be following where the politics are going.
And given that the motives might be more political in certain cases than maybe economic, that would be the theory for markets, there would be a concern that it would allow inflation to pick up steam on the longer term, which is why people might be more reluctant to buy into longer term bonds. That is what people are looking for in terms of the vote from the market.
That was Lisa answering her own question from earlier, Dan. There you go.
No better question than the one you know the answer to.
Better than yours. Dan Greenhouse of Solid Alternative Asset Management. Dan, appreciate it. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of Chevron and Hess rising in the pre-market after they were cleared to move forward with a mega merger. An arbitration panel dismissed Exxon's attempt to block the deal. Exxon had claimed that it had a contractual right to bid for Hess's assets in Guyana. And elsewhere, the US House of Representatives passed a bill to create a first-ever regulatory framework for stablecoins. It introduced federal or state oversight of dollar-linked stablecoins to legitimize the market. The bill now awaits Senate consideration. And in sports, round 2 of the Open Championship is underway at Royal Portrush in Northern Ireland. 5 players from a record 5 countries tied for the lead at 4 under 67 in the tightest logjam since 1938. Top-ranked players remaining within striking distance include Scotty Scheffler, Phil Mickelson, Rory McIlroy and defending champion Xander Schauffele. That should be my brief, John.
Lizzie, thank you. Appreciate it. The Open Championship, not the British Open, the Open Championship. You're very sensitive about these things.
All I know is that this is what's going up on your YouTube feed. Just one clip after another of this. This is an entire
I've been very
weekend.
disciplined.
Oh, yeah? This morning.
There's nothing on the screen apart from markets. Okay? Up next, scrutinizing Fed renovations.
I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the Federal Reserve Chairman.
Markets and drawings from architects. Up next, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Live from New York City, welcome to the program. Just about unchanged this morning on the S&P 500. and on the NASDAQ. The focus down in Washington, D.C. is on this, scrutinizing Fed renovations.
I don't believe there's a deadline the president has set for Rust vote, but I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman. It's completely unnecessary. It's overpriced, and I think it's a good thing the administration, led by the president, is looking into it.
Here's the latest this morning. Fed Chair Jay Powell defending the Fed's renovation project, writing in a letter to the director of the Office of Management and Budget, "We take seriously the responsibility to be good stewards of public resources." Bloomberg's Mike Shepard joins us now for more. Shep, is this a serious pursuit or a distraction in the nation's capital?
Well, this is a serious pursuit because ultimately it's not just about the building renovation at issue in this letter that Jay Powell sent to the budget chief at the White House, Russ Vought. It's about interest rate policy and whether the Fed chair will actually bend to the president's will when it comes to lowering interest rates. We heard Donald Trump just in the past hour make yet another demand of Powell and the board to lower interest rates. There's a meeting coming up at the end of the month. The president is now linking the Fed's unwillingness to lower its benchmark rate to tightness in the housing market. And he's saying that real Americans are starting to feel this pain. And he is also pointing to what he sees as lower inflation, giving the Fed leeway to do so. And of course, he added in some of the typical insults that he has been hurling at Powell in recent weeks. We heard him call the Fed chair a knucklehead in the Oval Office the other day. Today, he added numbskull to add emphasis. But when it comes to the building, John, this is really what would be used potentially as grounds to oust the Fed chair if Donald Trump decided to actually follow through with that. They would need grounds to boot him out of office. They can't just fire him because they don't like his interest rate policy. The Fed is an independent body. The board votes on interest rates. It's not just the Fed chair. So they would have to find other grounds. And you have seen Trump and Republican allies using this as an argument gradually to undermine the Fed chair, but perhaps create an argument or grounds to maybe legally move against Powell if that comes to actually happen in coming weeks and months.
Attempting to build a legal case. Mike Shepard, thank you, sir, down in Washington. Let's talk about the economic case to lower interest rates. Governor Waller presented one yesterday evening. Others have said wait. And they've said wait because they want clarity on policy, and we haven't had that yet. And then once they've got the clarity on policy, they want to wait and see the pass-through to inflation, see how that builds in the next few months.
We've already gotten a hint, particularly in home goods and appliances, in terms of what the tariffs have done to inflation in those sectors. Whether it comes away at the expense of people spending elsewhere is sort of the key question, especially on the heels of yesterday's retail sales number that came in pretty hot.
That was decent. Jobless claims were lower. We've talked about softer PPI, softer CPI. Let's have this conversation now. Monica Guerra of Morgan Stanley joins us for more. Monica, good morning.
Good morning.
We've had exemptions, extensions. What is the effective tariff rate in this country now compared to where it was at the start of the year?
And now the estimate's around 15 to 12%, depending on how you're actually counting, which really is 5 times the average effective tariff rate on January 1. And so what we're really waiting for is this pass-through of inflationary impact. We've essentially been in this wait-and-see period where some folks are saying, see, the tariffs haven't really had any major implications. And you've outlined some of the positive data that we've seen come in, but we are starting to see some weakening and some cracks. The other thing I just want to mention is that, the dollar is actually down, about 10% from the beginning of the year. And so that plays another additional factor in this when we're thinking about the role of tariffs and the economy.
When it comes to the tariffs, Governor Waller making the case yesterday, they are a one-off increase in price levels. Do you agree?
Yes, we're looking at idiosyncratic sectoral industry-based tariffs, 100%. But when we're thinking about the universal tariff shift upward, you're going to get not just that one-time cost level shift, but then you have anticipatory cost pass-throughs, right? You have the consumer having a pull forward in demand. All of these things get the flow of money moving faster and push up on inflation. Then you throw into the equation the dynamic between a lower dollar and potential tariffs or higher tariff rates. That means that importers are going to have to actually pay more. There's going to be a much higher burden from them if the dollar is weaker against the goods that they're bringing in, which means potentially higher inflation for the consumer.
When it comes to the tariff negotiations right now, the president is talking about 10 to 15% for 150 countries or so, but they are in active negotiations with a handful of the U.S. biggest trading partners. When do you expect these deals to get done?
Well, we're supposed to have some clarity right on August 1st, but we've seen that continue to, kick the can. I do think we're going to get more deals in the coming weeks. And so again, this is going to be a patchwork, and we have to see how it all pans out. Now, one of the other interesting things about this is that just because you're getting a universal tariff rate of 25% on Japan, only 50% of the goods that we'd be importing from them are going to be subject to that 25%, right? When we're thinking about the total burden to U.S. imports. So when we're thinking this through, you have to put that patchwork into effect and recognize that it's not just a country and regional specific risk, but then there's also sector and industry specific impacts, because we're not going to be importing the same goods from Japan that we would from other countries, for example.
It's such a complicated picture, which is a reason why people are struggling to put it all together, not least of which is the Fed officials. This idea of who pays the tariffs is fascinating, and your discussion around the dollar, I really want to focus on. How much does that allow companies to absorb more of the hit in their profit margins because they have such a competitive advantage overseas and might be gaining business overseas that actually leads back to higher profits based on the currency differential?
Yeah, that's a great question. So when we're thinking that through, you have to look at who has the highest percent of revenue exposure to foreign, right, to foreign customers, foreign clients. And that's going to be tech. That's first out of the gate, as well as materials. And you're looking at, the materials, energy, and tech sectors as the potential winners with having that weaker dollar in this tariff game. Now, if we pivot and we look to domestic concentrated revenue bases, those are going to be the industries and sectors that are going to be the hardest hit, because they're going to have to absorb those import costs at a much weaker dollar.
When you put all this together, it seems reasonable to sort of infer that this is going to be less of an impact than people might have believed at the outside of some of these tariff threats. What are you watching for that might indicate that there are prolonged inflationary forces at play here that could stretch more than just a couple of months?
And for us, we're looking at how the consumer is behaving. So as soon as people stop going out to eat, that's going to be your big red flag, right? Travel, has been sort of in flux, but positive overall. But usually it's travel and then restaurants. And if going out to eat is the first thing that goes, that's the biggest marker that people are starting to pull back and move home. The other thing I just want to emphasize here for us when we're thinking about how to position around this is not just looking to the potential winners, like a tech industry, for example, but keeping into account that we do still expect inflationary pressures. I think the debate is really around the magnitude. How bad could it be, like you mentioned, Lisa? And really making sure that you have diversification across not just the inflationary hedges, right, real assets, alternatives, but also, looking for those winners as well.
Monica Guerra of Morgan Stanley. Monica, appreciate it. It feels like we're the frog being slowly boiled by all the tariff headlines, right? Well, before you know it, you're at 25% effective tariffs, just like that.
Because markets aren't pushing back, because they're seeing all the different ways that it can be offset in different pieces. And then all of a sudden you're looking at this tariff load. And if we stop going out to eat, evidently that's a problem. I will say it's really expensive to go out to eat, especially when you add taxes and then tip, and it just becomes sort of
getting more and more expensive.
Isn't it? I mean, is it just me? I mean,
it's not just you.
It's just like hard to justify.
Just the hits keep coming.
I mean, and then ordering in, and then delivery.
It's Friday. Come on.
Okay.
Right, don't cancel date night this early.
Lisa's not going out to eat this weekend. Up next on the program, the chair of the SEC, Paul Adkins, as the House passes landmark stablecoin legislation. Plus, we'll catch up with Yahira with your morning movers and a step forward for a mega crude merger.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making the case for lower rates. 30 minutes away, we'll catch up with Governor Christopher Waller of the Federal Reserve, who yesterday here in New York City called for a 25 basis point reduction of Fed funds. Today, later this morning, he'll articulate why. We're hearing from the president. He's got this to say: lower the rate, too late. The hits keep coming. This pressure is unrelenting.
Yeah, talking about how President Trump saying that Jay Powell was one of his worst appointments ever, as he really does push him to lower rates. I assume that the argument, lower the rate too late, has less emphasis in markets than going through the labor market data and citing the beige book on 3 occasions.
Yeah, that doesn't work on social media, right?
If you look at the June 4th beige book.
We'll have a more sophisticated conversation hopefully later this morning. Equity futures right now on the S&P 500 just about unchanged. Likewise on the NASDAQ with your morning movers. Here's Yahira. Morning, Yahira.
Hi, John. We start with some major news in the oil space. Take a look at Chevron and Hess. Both shares are rising after Hess won its arbitration battle with ExxonMobil, clearing the way for Chevron's $53 billion takeover to finally move forward. The ruling ends months of uncertainty tied to Hess's valuable stake in the Guyana oil fields, which is one of the fastest growing oil areas in the world. So Chevron really needed this win in order to justify this deal. And here's another big winner from all the volatility we saw in the second quarter. Take a look at Interactive Brokers. Shares are up 5.5% after the online brokerage posted higher than expected profit and revenue as trading volume soared. Commission revenue jumped 27% thanks to more active users. And we end on 3M shares. They are also higher. It just reported results and it raised its profit forecast and beat Wall Street estimates, even while factoring in the impact of tariffs. Shares are up 2.5%. The maker of Post-it notes now expects earnings as high as $8 a share this year. That is 10 cents higher than the upper end of its previous forecast. But it's no accident. CEO William Brown, who is fairly new to the role, has been shifting production and pricing in order to blunt the impact from those tariffs. So another American company navigating these tariffs pretty well, John.
Yahira, thank you. Talking about corporate resilience over and over again. Savita Subramanian of Bank of America made that argument so many times. Don't underestimate corporate America.
They are right now finding a lot of pathways to absorb some of the costs and really just do fine. And a lot of this does have to do with what they're doing with technology. Really, I can't stress that enough. When I hear more and more about it, it really blows me away.
That's amazing. We'll get to more on tech in just a moment. On our radar this morning, Fed Chair Jay Powell responding to criticism of a $2.5 billion renovation project at the Federal Reserve. Powell writing to the White House, quote, "We take seriously the responsibility to be good stewards of public resources."
And you can go on the Fed webpage now and look at all the reasons why they say they need these renovations. Powell is denying in this letter, though, to the OMB director about VIP elevators. He defends the vegetated roofs. I think what stands out to me on the Fed website, and Lisa's laughing because it all has become a little bit dramatic and much, is that they say these buildings have not been comprehensively renovated since their construction in the 1930s. The bottom line is Powell's out defending this because the administration continues to attack. This is a new line attack. First, it was was about you should be lowering interest rates. Now it's about that you're over budget when it comes to these renovations. And they're trying to, at least at minimum, undermine how the public feels about Fed Chair Jay Powell.
The pressure keeps coming. The president, again, pushing this morning for lower interest rates at the Federal Reserve. Lisa was talking about tech. I want to talk about Meta, continuing to build its artificial intelligence team. Sources telling us here at Bloomberg, the social media giant hired 2 more AI researchers from Apple after poaching their former boss from the iPhone maker.
It looks like Apple's a sitting duck. I mean, for absolutely everyone in terms of its talent, especially as it struggles to really get inroads on the AI story. This, though, speaks to the existential risk that not being at the forefront of technology is for the likes of Meta, for the likes of Google, for the likes of Microsoft. If you don't have the top talent, that could potentially sink you. That could own you later on. And that maybe is the reason why people are getting a little concerned about Apple, because they are losing this talent and they haven't made those inroads.
The Alphabet CEO several months ago, we said it in the last hour, the biggest risk is underinvesting and not overinvesting. And they see a lot of these themes as an existential risk.
The competition isn't just coming from the tech companies. It's also coming from across the stack, because every single company could potentially miss out if they aren't necessarily at the forefront of whatever trend the consumer is experiencing with the interface for each business. And that really is what you're hearing across corporate America.
Some of the biggest banks on Wall Street feeling insecure as well. Goldman Sachs taking another step to try and keep its interns and new employees away from competitors. According to a memo seen by Bloomberg, the bank is launching a program to offer applicants a path to the asset management unit, which has a private markets arm.
Evidently, the first one didn't work, which was loyalty pledges. So standing around being like, we promise, we will not accept a job. This is, you know, okay, we'll try something else. We'll give you an opportunity to maybe have a similar type of job, and that could potentially be the right approach.
To the bank's defense, although the loyalty test was so interesting, it reminded me of what actually the Trump administration was doing, what I pledge allegiance to the Goldman Sachs. Anyway, what the banks are saying to their defense is we go out, we spend a tremendous amount of money going out, finding talent. We're the ones that are making sure these individuals are trained. We want to keep them in-house. So that now they have a pathway.
That's the latest on Wall Street. We've got a special guest, so let's get to him. Congress passing the first federal legislation to regulate stable coins in a major win for the crypto market. Joining us now, I'm really pleased to say, for a first time here on Bloomberg TV, on Bloomberg Surveillance, the SEC Chairman, Paul Atkins. Chair Atkins, welcome to the program, sir. It's good to see you.
Good to see you. Thank you very much for having me.
Well, thank you for being here. Before we get into it, I wanted to offer you the opportunity, sir, to talk about your philosophy in this seat versus what came before you and the difference maybe between deregulation and just innovation.
Well, thank you very much. We are out to, obviously change direction at the SEC, and I think we've already done that here in my first 2.5 or so months at the agency. But we're moving away from regulation through enforcement and uncertainty in the markets, especially with respect to cryptocurrencies and digital assets in general. And we're looking to set firm, clear rules of the road for people who are operating in that environment so that innovators can innovate. They can rely on their advisors to tell them, which is the right direction and how they can build on solid ground.
Regulators, though, can't step in without explicit action from Congress. So when it comes to cryptocurrencies and the SEC, what actually comes next? What are your plans?
Well, so even before I got to the SEC, Hester Peirce, who's one of the commissioners, and she used to be my counsel when I was a commissioner back in 2002 to 2008, was in charge of a crypto task force that we're calling it, and they are focusing on making clear rules for the industry. So, for example, things like meme coins and stable coins that was just the subject of the bill that was passed yesterday are not securities, and before that was not necessarily clear. And so that's an example of how we're trying to put people at ease in the marketplace so that they can innovate and they can move forward with their plans and not have to look over their shoulder.
When you were talking to reporters yesterday after the passing of this legislation, I believe you'll be at the White House today with the president when he signs it, you said the SEC is considering a, quote, innovative exemption from regulations to incentivize tokenization. What does that exactly mean, innovative exemption, and how long does this process take?
Well, it'll be an iterative process, and right now we are working on setting forth different things that can, again, make it clear for people in the marketplace, which way is the true north for them, let's just say, so that they don't have to worry about falling off the ditch and, falling into the ditch and getting in trouble with the regulators. And so part of that will be working with our colleagues at the other regulators, and especially the Commodity Futures Trading Commission. But let's just say that as we go forth and as we interact with the marketplace, we've had 5 roundtables now looking at various aspects of the digital asset space. So we are working hard at coming up with guidance and rules, and we'll use every tool in our toolbox to help people understand what is, how to stay out of trouble, basically.
Chair Atkins, one of the big concerns is that a number of the stablecoin issuers are not going to have the sufficient number of hard currency reserves on hand to really back those notes in a way that is as advertised. How are you prepared to really counter that? Is that something that's in your list of concerns that the SEC is going to be monitoring?
Well, one thing that I think the new to-be-signed bill into law makes clear is that these are not securities, and it's the banking regulators who are going to be looking after them. And I think that's appropriate because of the role that stable-coins play, and I think will play in the future. Because part of the real promise, I think, of distributed ledger technology is immediate payment as part of the process of transactions. So settlement coming down to, in effect, almost T+0, and to do it on the trade date. And that will make things much more efficient in the marketplace, save money, reduce risk in our financial system. So stablecoins are in the realm of the bank regulators, and they will look after to make sure that there is adequate and, as advertised, adequate backing to the stablecoins.
Chair Atkins, just sort of switching gears a little bit, there's been a lot of discussion around Congress and the president passing legislation that would open the door for people to take their money from the 401ks and put it into private assets, in particular private equity. How do you plan to oversee and make sure that that's done in a way that isn't potentially punitive for people who are retiring at ages where they need a lot more money for a lot longer?
Well, on that issue, we've heard a lot of input from both the investors who want access to the private markets and to those sorts of products, and obviously from the people who are producing the products who are about to meet that demand. So, but we have to do it carefully, I think, because, of course, the private markets are a lot different than the public markets. Their liquidity is not the same. There are all sorts of things for people who are not aware of the rules of the road where they could get hurt. And so we will work very closely with our counterparts at the Department of Labor who have oversight over RISA accounts to make sure that, that we have appropriate guidelines around these various products. And they're really for, of course, long-term investment, especially private equity and things like that. So we have to do this in a smart way so that individual investors are not inadvertently into something that they didn't realize what they were getting into.
Well, speaking of 401k retirement plans, would you allow crypto into retirement plans? Because the Financial Times is reporting that we could see an executive order from the administration as soon as today allowing alternative investments into retirement plans.
Well, again, I think that, disclosure is key and that people need to know what they're getting into. So things like that are not for everybody. And so especially in retirement plans. So I look forward to whatever may come out from the president as far as direction goes. But we need to address it because there is a demand out there for these sorts of products, and the government should not stand as a blocking agent for those sorts of things, but we need to enable it in the proper way with proper guidelines and proper disclosures.
Chair Atkins, you run an independent agency. So does Jay Powell. I would love to know, are you under any pressure from this White House? And what would be your advice to Jay Powell? Because it seems like you have a better relationship with President Trump.
Well, I think, so I've been at the SEC now, this is the third time. I was there in the early 90s under Richard Breeden and Arthur Levitt, and then again from 02 to 08, and now here in 2025. So frankly, I don't see really any difference in operation from back then to now. I know there's been a lot of coverage of that, but you know, we are working hand in glove with our counterparts in the administration and at the Office of Management and Budget and OIRA as far as talking to them about rules and other things that we are going to be publishing. So, you know, keeping them up to date, taking their comments, which are all very good. So I don't see any real difference, frankly, in the ambit of maneuver that we have at the agency. So I look forward to achieving a lot with in the time that we have, and because there is so much to do. This is what I like to call deferred maintenance that we have to address, and so we are moving, I think, at a very quick pace, and so the rest of this year, I think, will be churning things out and moving in a different direction.
Hopefully this is a start of an ongoing conversation. Appreciate your time, Chair Atkins. Thank you, sir. The SEC Chair, Paul Atkins there, down in Washington, D.C. Brilliant question at the end there, addressed by the SEC Chair.
Well, he says that he has this relationship that he's had even back in the day when he used to run the SEC, the same as in the White House, doesn't feel like he's under any sort of pressure. Obviously, the SEC is an independent agency, just like the Fed is, but Jay Powell is getting bamboozled every single day. 2 truths just today alone. You haven't seen that kind of treatment of Paul Atkins.
The pressure keeps coming. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. American Express second quarter earnings beat estimates, buoyed by its premium clients. The company's CEO said it saw record card member spending and rising demand for its premium products. Amex affirmed its full-year revenue growth forecast of 8 to 10%. And elsewhere, Wells Fargo suspended travel to China after one of its top trade financing bankers was blocked from leaving the country. Sources telling us here at Bloomberg, an Atlanta-based managing director who was born in Shanghai was banned from leaving the country. Wells Fargo said they're working on bringing their employee back to the United States. And WNBA All-Star Weekend kicks off tonight in Indianapolis without its star. Indiana Fever's Caitlin Clark has announced she will not be participating in any of the events after suffering a right groin injury on Tuesday. Clark has already missed 11 games this season due to injury. And that should be my brief. John.
Spent the year beating her up. Lizzie, thank you. It's brutal watching WNBA. Seen some of those hits?
Yeah, they're pretty wild. And she was painted as sort of this bad character for getting angry about some of the stuff. I have a real soft spot for her. People find her controversial. She has single-handedly brought this entire sport up.
Couldn't agree more. Got to protect your stars.
100%.
Haven't protected that star. Up next on the program, the beginning of a new bull market.
I'm hoping we get a pullback to some degree. This is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, but I really can't see more than a 5 or 10% correction given what I see now in the landscape.
Up next, Sarah Malik of Nuveen, live from New York City. You're watching Bloomberg TV.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
This week, so far, so good. Data's been okay. Downside surprise on CPI, on PPI, retail sales decent, jobless claims better, earnings from the big banks on Wall Street pretty firm. Equity market at all-time highs. Is this from fragility building beneath the surface, particularly in the labour market? That's an argument, a debate we'll have on this programme in about 10 minutes' time with Chris Waller, the Governor of the Federal Reserve. Look out for that conversation at the top of the hour. In equities right now, S&P 500 futures positive by not even 0.1%. Under surveillance this morning, the beginning of a new bull market.
I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. This is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe.
Here's the latest this morning. Upbeat earnings and growing confidence in the U.S. economy driving the S&P 500 and the NASDAQ to fresh all-time highs. Sarah Malik of Nuveen writing, expect beat and raises in the second quarter. Sarah joins us now for more. Sarah, welcome back to the program. I want to get to a line from Mike Wilson of Morgan Stanley. He believes that this is what the beginning of a new bull market looks like. Do you agree?
Well, I would say that we're in the middle of a bull market. I think it has been around for quite a while, but it has legs to continue for two reasons, and that's the economy and strong earnings. Now, there's also a bit of volatility we need to think about, and that's because of the drama around the Fed chair position. But going back to earnings, which is what you mentioned, earnings, the bar is low this quarter. We're expecting consensus is expecting 4% revenue growth, 5% earnings growth. If you look at history, revenues tend to grow about 7%, earnings at 10%. That's a setup for companies to beat and raise guidance. And we think that's what you're going to see, and that's what's going to drive the markets higher in the short term.
That's what we got from some banks this week. JP Morgan, a good example of that. JP Morgan came out with a beat and a raise. The bar for them seemed to be higher than for others. So when you say the bar is low, in what sectors, in what kind of companies?
Well, earnings always starts off with banks, and they set the tone. And you're right, banks had a nice rally year to date. They had outperformed versus the S&P 500, so the bar was high for them. We still are seeing strong earnings even today from companies like American Express. But the leader of earnings historically in the U.S. is technology companies. So that's what we need to count on for this cycle. They've led about 2/3 of earnings growth in the past, and they're over 30% of the S&P 500 as a sector. I think technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter. And that's what's going to make or break this earnings cycle.
That's on the one hand. There is this feeling that companies are doing really well and that they are exceeding expectations. I am wondering how the rate picture fits in, how susceptible they are to some sort of increase in the yield on the long end that could potentially disrupt the story.
Well, first of all, the initial drama around obviously interest rates and what's going to happen has a bit to do with the turmoil around the Fed chair position. Second of all is when will the Fed cut interest rates? Our expectation has been that the Fed will cut rates 2 times this year, starting most likely in September. They'll do that because there are some signs that the economy is slowing, but more importantly, there's signs that inflation is becoming more benign. And so I think that's going to be what the market relies on in terms of optimism over Fed rate cuts. But we do have to worry, like we did around Liberation Day, about the longer end of the curve and what's happening there. But as of right now, things have calmed down in that area.
Have you been surprised, Sarah, that we haven't seen more disruption in markets, in particular in equity markets, from the whole discussion around Fed independence?
Well, I think that markets in the end trade on fundamentals and earnings season, and we've had historically beat and raises for each earnings season. Part of that has happened because consensus has declined as we've approached earnings season. If you go back to first quarter earnings, at the beginning of the year, markets expected 12% earnings growth in the first quarter. By the time we got to that earnings season, consensus was at 6%. Now, as I mentioned, it's at 5% for earnings growth. So the setup is there to beat, and that's usually what markets trade on. Now, the other side of that is the valuation argument, and I think that one is real. Markets are trading at a premium, and they need to be able to deliver these earnings driven by technology companies to support the premium valuations of the market.
Sarah, how dependent do you think your call is on lower interest rates? Is this a market that needs rate reductions?
It's a market that would like rate reductions, and the risk around it is that if the Fed waits for the employment market to crack, usually the employment markets crack when a recession starts. So that would put the Fed behind the curve, and I think that's a real fear for the markets is, are we going to be too late with rate cuts when a recession already starts? Now, on the other side of that, I don't think a recession is imminent. We saw that this week with strong retail sales. We're going to hear companies like American Express talking about how consumers are still spending. But we need to be careful of some of these cracks. In inflation data this week, both CPI and PPI showed that consumers are becoming more sensitive to the services and entertainment spending like airfares and hotels, and that goods prices are increasing. So I think those rate cuts would help. We're not dependent on them, but we are concerned that the Fed may wait too long if they're looking for that real crack in the employment market.
You're not alone. Sarah Malik there of Nuveen. Sarah, thank you. This is something we'll hear in 5 minutes' time when we speak to Governor Chris Waller. We no longer have the luxury of waiting.
And he's really finding company on the committee, in particular Mary Daly, who said that she doesn't want to see the labor market soften any further. The idea that Sarah raised, that once you start seeing the cracks, it's too late, because usually that already signals a recession.
We've got a big hour coming up. The third hour of Bloomberg Surveillance just around the corner. Coming up, Fed Governor Chris Waller, Dan Ives of Wedbush, Sarah House of Wells Fargo, and Sonal Desai of Franklin Templeton. From New York City, you're watching Bloomberg TV.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
As long as there's cash in people's pockets in FOMO, markets are going to continue to grind.
The tailwinds for the market is basically the speculative frenzy that is going on right now.
A lot of what the issues are that could result in a repricing, they're all out there. The question is, are the markets reflecting that?
The market is expecting lower rates. This is what the beginning of a new bull market looks like.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Mike Wilson and Morgan Stanley bullish, big time. The start of a new bull market, live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Going into the weekend at all-time highs on the S&P 500. Your scores look like this. Futures positive once again, up 0.1% on the S&P and on the NASDAQ.
Yeah, a company is showing how well they are adapting and adjusting and then some beating. Maybe the bar is low given the fact that you haven't expected this kind of strength, but nonetheless, they're beating across all sorts of metrics and people still don't seem that impressed. I mean, the fact that we're at all-time highs, great, but the earnings so far have been pretty awesome relative to expectations, and a number of those shares are lower.
It's Friday. If it's Thursday, Wednesday, Tuesday, Monday, you know what happens. The president's out there once again calling for, guess what? Lower interest rates. The president already making the case earlier this morning.
Two truths already this morning. The last one saying lower the rate, too late meaning Jay Powell. He continuously is going after the Federal Reserve for lowering interest rates, and we're going to be speaking to someone who actually also agrees with the president, but for economic reasons. And one of the things Governor Waller said yesterday really goes to this idea that everyone's been talking about the uncertainty of tariffs. And he says tariffs are a one-off increase in price levels, which is what gives him credibility in this race to be the next Fed chair, inside the White House, inside the institution of the Fed, most importantly to financial markets.
If you are just joining us, welcome to the program. Futures just about positive on the S&P 500. A big 60 minutes coming up here on Bloomberg TV. We'll be joined by the Fed Governor, Chris Waller, calling for a rate cut this month. We'll catch up with Dan Ives of Wedbush as big tech pushes stocks to record highs, and Sarah House of Wells Fargo on the state of the U.S. consumer. We begin this hour with our top story, making the case for a rate cut. Fed Governor Chris Waller telling an audience here in New York, looking across the soft and hard data, I get a picture of a labor market on the edge. Joining us now here in New York City, the Federal Reserve Governor, Chris Waller. Governor Waller, good morning.
Oh, good morning, Jonathan, Lisa, Anne-Marie. Nice to be here.
It's good to see you, sir. Let's talk about why we're losing the luxury of waiting. Have we lost that already?
No, I think we haven't. Like I said last night, the headline numbers for the labor market, what we're seeing are okay, but it's like when you get underneath and start looking at the data, the private sector is not doing as well as everybody thinks it is. Like most of half of the employment growth we saw last month was in the public sector, and that means the private sector is not doing particularly well. So I was just joking that, you know, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice. So you've got to start prepping in advance before you have that happen.
How do you square that with what we've heard from corporate America so far? What corporate America has told Lisa, sitting down with Scott Kirby of United Airlines, talking about a rebound in the second half. What we've heard from the big banks so far this week. How do you square what you're seeing in the data with what we're hearing from CEOs?
Yeah, I mean, when I talk to CEOs, I get the same thing. We're in just hold pattern in terms of certainly the labor market. They're not hiring, they're not firing, they're just watching. And that's kind of what you see in this underlying private sector data. There's not much happening. So it wouldn't take much to sort of tip it. Now, could I be wrong? Absolutely. I mean, last year we got a couple of weak labor market reports that led us to cut in September, and then everything kind of reversed and went back up. So I'm not saying that couldn't happen again, but it's just we've constantly seen little bits of data continually coming down. The Beige Book yesterday came out. Some other stuff that we get out of the JOLTS, quits rates, hiring rates. These things are not indicating a super healthy private sector labor market.
As you know, you're facing potentially, and I stress potentially, negative supply shocks on both sides of the mandate. I want to sit on the labor market just for one further note. Immigration. How are you thinking about that when you look at a labor market at the moment? When we have people coming on the program, on Bloomberg Surveillance, on Bloomberg TV, every single morning, 6 till 9, coming on here and saying, look at the data, unemployment could stay at these levels even with job gains of 50 to 100,000 because of tighter immigration. How does that factor into your thinking as you look at the U.S. labor market?
Well, yeah, the labor market doesn't necessarily have to be affected by it because if workers flow in and they get jobs at roughly the same rate as the existing workers, the unemployment rate doesn't change even though the labor force is higher. And when they go back out, the same thing happens. If they leave the employment and leave the labor force, you don't see a big change in the inflation rate. Now, it can potentially affect the break-even rate that you would need to have the market going well. And that's what we're still trying to kind of get a sense of, because you basically brought 5 years of immigration forward. And, you know, of that 8 or 9 million, most of them haven't disappeared. So they're still here somewhere. Whether they're going to work, they're not going to work, but they're still here. Where I think the immigration stuff, if immigration was a big factor, you'd be seeing shortages, and you might see some in, you know, some industries. But like I pointed out, that if you look at the new college graduate unemployment rate, it's 7%. It's much higher than it has. These are not jobs that are being opened up because immigrants are not coming in. It should be just the opposite. If immigrants are leaving and these jobs are open, then the unemployment rate should go the other way. So that unemployment rate to me is telling me immigration is not the source of the problem. Firms are just holding off on hiring decisions. Even if their earnings are doing well. That's just what I'm saying they're doing on the labor side.
I wanted to say there's a mutual friend of ours that feels like he's missing out this morning, so he wanted to catch up with you as well.
He's out in Victor, Idaho.
He's having a good time, isn't he? Mike McKee joins us now. Good morning, Mike.
Good morning, John, and good morning, Governor Waller. I would say I'm sorry I'm not there with you, but I bet you're sorry you're not here with me. I know
you got it. I've been there before. It's a nice place.
You've made the case now a couple of times for a July rate cut, but how committed are you? Are you willing to dissent at this meeting if the majority votes the other way?
Well, I never want to commit to an action before the meeting. Otherwise, if everybody committed before, you don't even need to have the meeting to have a discussion. So the goal is to always go to the meeting, sit down, listen to all sides. People will try to convince me of their view. I'll try to convince them of my views. And in the end of the day, you make a decision on what you think is the right outcome and the right data, how the data is coming in. And right now, I laid out my case last night. I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data and how I think about going forward, how you respond to anything that involves tariffs.
There's a lot of politics in this decision coming up, more than usual. And I'm wondering, Governor Bowman has also suggested she would prefer a rate cut in July. If two of you vote for a rate cut, if two of you were to dissent, would you worry about the market reaction to that?
You know, one of the things that has always bothered me since I took this job is the criticism that we are nothing but groupthink. All the meetings are the same. Nobody dissents. Nobody does anything. And I think this is healthy. I think this is a turning point in the way we want to think about policy. Some people don't want to cut. Some do want to cut. But coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home? So this is healthy. I think this is what you want to see in a democracy. You want to see policymakers have serious, open discussion about where policy should go. It doesn't mean anything about politics or anything else. It's make the economic argument and then see if you can convince others to go along with you. And that's all I'm trying to do.
We totally agree with you, for the record. We were sick of the groupthink, and it's good to have dissent.
Yeah.
Mike essentially is asking if you will dissent at the end of this month. Is there value in dissenting on the FOMC?
Well, I mean, it's often the case that you dissent if you make it very clear you think at this moment in time this is an important thing to do. If you were to go in and do kind of a jihadist, I'm going to dissent at every single meeting no matter what happens, then you don't even have to show up. Everybody knows what you're going to do. So it is important to make sure that if you dissent, you do it carefully and you have the right reasons, and it's not going to turn into a serial dissenting potential case. I mean, that's how I take my job seriously and responsibly. So I only would think about doing this. I dissented on the balance sheet slowdown earlier this year because I felt like that was not needed. And that's kind of the situation we're in now.
Chris, if you do cut, the markets will go one way. If you don't, they'll go another, perhaps. How critical is it to get to a rate cut fairly quickly? You've mentioned the danger to the labor market, but if you do wait till September, is that going to be too late?
Well, that's kind of the debate. What does it mean to wait 6 weeks? Is it that critical? And the answer is probably not. It could be, but it's also the reverse. Why wait till September if it's just 6 weeks? That's exactly the thing. It doesn't kind of matter. Just start thinking about, do I want to wait and risk something happening? This is what we saw last summer, by the way. We left July, we left rates, and then boom, we got a very weak, bad labor market report. The unemployment rate jumped 0.2. Payrolls went way down from where they were, and people were screaming at us last August, you guys should have cut in July. So 1 month it always is 1 month. Just remember that, it's just 1 month. But we live in a world in which we have to respond to real-time data to kind of sense of where the economy is going. And I've always said, if you worry about long and variable lags, which everybody always talks about, the whole point of that is to get ahead of it, not wait for it to happen, and then take a policy action that takes quarters or months down the road to actually have any impact.
The new worry is tariffs. We've just had a 6-minute conversation with you about monetary policy. You've built a case for lower interest rates, and no one's talked about trade or inflation. 2 assumptions in your speech yesterday, and I think they're important assumptions. A large share of tariff increases won't be passed through to consumers. Any increase would fade over the next year or so. What data underpins that conclusion?
Well, one, it's just economic theory. So you put on a tariff, as long as it's a one-time tariff and that's it, that's a one-time price effect. I mean, this is economic theory. You could not get in any serious economic model persistent inflation from that. You would have to cook up some other amplification mechanisms, and that's what people talk about. Wages will start going up and everything will get out of control. You're not seeing that at all. This is just not. Those kind of amplification mechanisms or wage price spirals aren't happening. Tariffs are a tax, and in public finance, you learn that you may levy a tax on a firm, but who bears the incidence or the burden of that tax? It can be a group of people or one person, not necessarily the firm. So this is what I've heard from a lot of firms. If there's a 10% tax, they'll force their suppliers to eat some of that cost. Workers may eat some of that cost in terms of less hiring and things like that. The firm will take it out of their profit margins. And then lastly, some of it will get passed on. And as I mentioned last night, I've heard this for months now. Like the rule is 10%, it's roughly, rule of thumb is a third, a third, a third. Suppliers will eat a third, firms will eat a third, consumers going to eat a third of that tariff. So if you eat a third of it and it's 10%, like I've been arguing, this is like 3/10 of a, 3/10 on the inflation rate for a few months, and that's it. And it'll persist if you do 12-month over 12-month. That base effect will not go away for a while, and then it'll just drop off a cliff. So that's why I've been arguing you want to look at like 3-month and 6 months to see if these tariff effects pop up and then go away. And so that's more critical than looking at 12-month.
Yes, but the way the president is putting these tariffs on might not match up with theory, Chris. The Smoot-Hawley tax was passed and came into effect on a certain date. The president is not yet put on most of these tariffs. They're in theory still coming, and we still haven't seen the Section 232 tariffs for the most part, the national defense tariffs that he wants to put on semiconductors and pharmaceuticals, et cetera. So if the process is stretched out, consumers could be hit by an ongoing series of tariff increases, and given what they've just been through, isn't there a danger that inflation psychology starts to seep in?
Well, that's exactly the point. All my examples, Ben, is if you put the 10% uniform tariff on and keep it roughly in that range, then what I've described is what will happen. If there's constantly a sequence of higher and higher and higher tariffs, then you are going to get this rolling potential impact on prices. That's true. If it's still just a question of delaying it, that doesn't change my argument. Whether you see the spike in July or it happens in June or August or September, when it happens is irrelevant for the economics. That's a non-starter of an argument. Firms could also just spread it out in smaller increments over several months. The total effect still ends up being the same. They just get there in a later fashion, and it'll be smaller amounts. So the bigger thing is if we just continually get another wave of tariffs, another wave of tariffs, another waves of tariffs, that's when things become more problematic, thinking about what's going to happen with inflation.
You don't think the Federal Reserve should wait? I just want to talk about the experience of last year. I think Lisa's done a fantastic job of covering this over the last 6, 7, 8 months. The move we saw last year, 100 basis point reduction in interest rates on Fed funds, and then we saw a corresponding move of 100 basis points higher at the long end of the yield curve. Yields down did not happen. It was yields up and mortgage costs up as well. How do you think one informed the other? And how might that shape your approach to cutting interest rates this time around?
Well, I think last September there was a lot of, remember, the long-term rates were going down through August and early September. This was not any contradiction of what we were doing. It's just after the September meeting, the data just came back in the opposite way. Growth was up, productivity was up, employment suddenly took back off. And then you have real growth expectations being much higher. We were seeing productivity growth and GDP growth of close to 3%. So in that case, long rates go up anyway. So it's not necessarily there was some counter reaction to what we were doing. I never saw inflation expectations adjust that caused all this.
You don't think it was the market questioning your commitment to the inflation mandate?
Right. If it would have been, you'd have seen it in inflation expectations in the market, not the Michigan thing. But we didn't see it. I mean, inflation expectations stayed fairly anchored all through this rise. So I think the increase in the long rate was just all the data was coming in for a better, stronger economy than we thought it was going to be in September. That's fine with me. You know, sometimes you're going to do these things taking a shot that I want to make sure we don't have a hard landing. And as I said, with any kind of an insurance cut, sometimes you don't need the insurance. It didn't work out. But that doesn't mean you go back and say, oh, that was a stupid decision to make.
Market-based expectations of inflation. Let's sit on this. There are clear and obvious threats to the central bank's independence right now. Every single day on this program, we're quoting the president, calling the chairman too late, and going after lower interest rates. And I think a way that you and I can have this conversation without addressing those calls directly is to think about what's happening with inflation expectations. Do these threats threaten to de-anchor market-based inflation expectations? And is that something you and the committee might become increasingly sensitive to in the months to come?
Well, like I said, I look at the, after the tariffs came on, everybody was worried about de-anchoring expectations, particularly after some of these Michigan surveys came out. But when I always look at the market-based expectation, because people have money in the game. Firms are making decisions on what their chief economists are saying. And if those things are wrong, they're going to lose a lot of money. So I've always paid more attention. I haven't seen much in the way of market expectations being unanchored in any ways you want to measure them, any forward. Now, in the near term, of course, they might go up because you would see inflation in the short term. But in the longer term ones, I'm not seeing it. So either the market is just dismissing all of this as chatter and noise, or at some point if something happens such that it becomes much more serious, then you might see a discrete jump. And then, you know, that's going to be a problem for everybody.
One of the questions that we get all the time, Chris, from people on Wall Street is, or one of the posits they make is that all this criticism of the Fed is hurting Fed credibility, and that the next chairman's going to have a tough job because there are going to be expectations for the next chairman set by the White House rather than by the economy. Do you feel that inside the building?
No, to be absolutely honest, we just do our job every day. I go in, I just focus on my work on monetary policy, payments, and oversight of the reserve banks. That's what I do. I let this stuff go and then just try to focus on my job. And I think that's how all of us are proceeding with this. I mean, at the end of the day, the president, whoever they choose, you're going to have somebody that has credibility with the markets, or you will see, as Jonathan was just talking about, you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. This is well known. We've seen this everywhere around the world when this happens. And I know Scott Bessent knows this. So this is not something that is lost on anybody.
You've been nominated by this president for the seat on the board.
Yes.
You were previously director of research for Jim Bullard way back then. Is it a position you would like? Is it something you would like to do in the future?
Look, in 2019, the president contacted me and said, would you serve? And I said, yes. If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
We'll see if he does.
If he says, Chris, I want you to do the job, I'll say yes. But he's not talking to me, so that's it. It's a hypothetical that
might change, sir. It's good to see you. We appreciate your time.
All right, thanks.
You've been very generous with it. Thank you very much. The Federal Reserve Governor there, Christopher Waller. Mike McKee, thanks as well to you, sir, as always. Up next on the program, we'll get you some morning calls, plus we'll catch up with Dan Ives of Wedbush, and we'll break down this conversation we've just had around this table, the case for lower interest rates.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The headline numbers for the labor market, what we're seeing are okay, but it's like when you get underneath and start looking at the data, the private sector is not doing as well as everybody thinks it is. If you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
Federal Reserve Governor Chris Waller on this program just moments ago, Lisa, making the case for lower interest rates.
Yeah, saying that you have to do it before it's too late, making the case that we've heard a lot. I mean, too late has taken on a new meaning now, of course. There is this question whether he's going to dissent. It sounds like he will dissent, and he really raised the point. This is actually good. You want dissent. We're at a turning point in the economy, and that's typically when you do have countering views.
Really refreshing. He talked about there should be debate amongst policymakers. There should not be this groupthink, which is something most people on Wall Street, this administration, completely agree with. When it comes to whether or not he would be the next Fed chair, he said the president has not reached out to him, but the president did reach out to him to join the board. And if he was asked to be the Fed chair, he would serve.
These 2 points that he made this morning and last night here in New York City on tariffs, and this is the key argument that he's going to have to confront the rest of the FOMC with, that a large share of tariff increases won't be passed through to consumers. And if they are, that increase will fade over time, and it's something we should look through. Point one, on inflation. Point two, and I think this is going to be maybe a little bit easier to get across to the rest of the committee. We can't keep going around saying the economy's solid and we have the luxury of waiting, because you've got an individual there that's saying, we don't. And I think he's got some friends, got some company on that point on the committee.
It isn't just Mickey Bowman, it's also Mary Daly. And she said it really would not be a good thing to see the labor market deteriorate more greatly than it has already. You're also seeing Neil Dutta, you're seeing others talking about how the private payrolls just really hasn't picked up. And one thing that Governor Waller mentioned was the Beige Book. And I know that we joke about the Beige Book being really boring, but it actually is really important because what it highlights is that almost every single district shows a weakening in the labor conditions and a weakening in the belief of labor conditions going forward. And that, I think, is getting their attention.
He talked about tariffs as a tax, but he talked about how it is really divided amongst the supply chain. So that tax, when it hits a consumer, is only about a third. He said constant sequencing of tariffs, continuously ratcheting it up, not 10–15%. That could potentially be a problem. But how difficult is it going to be when you have a Fed governor that has a tremendous amount of credibility coming on the program saying that tariffs are only a one-off increase in price levels, and then the Fed chair might come out and say, well, we can't move because we don't know the tariff rates. Well, here's an individual saying we should be moving and the tariff rates don't matter.
It's a credible argument for lower interest rates, which might find some company on the committee, and for that reason, he's going to find it easier to engineer the kind of low rates that the administration would quite like. You go with someone from outside of the building, you've got a much, much bigger problem. If this market perceived, and it is an if this market perceives them just to be a political puppet and someone without the credibility.
If they're lowering rates simply because they're doing so in response to the president, that's going to lead to inflation expectations becoming unmoored. And you'd see that in market pricing, not the University of Michigan thing, as Governor Waller said. And that seems to be what his argument was this morning.
Don't we get the University of Michigan thing later this morning?
We get a University of Michigan thing. And actually, it's been doing better, but a lot of people dismiss it.
Sounds like Governor Waller doesn't open that one.
Up next on the program, we'll catch up with Sarah House of Wells Fargo on the state of the consumer. Plus, we'll speak to Yahara with your morning movers and a sign that high-end shoppers are still spending. Live from New York City, this is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
$60 minutes away from the opening bell. Equity futures on the S&P 500 positive by 0.1%. Looking to add some weight to a record-breaking rally stateside. On the Nasdaq 100, we're positive by 0.06. Let's get you some morning movers this morning. Let's cross over to Yahara. Hey, Yahara.
Hi, John. The wealthy are doing just fine. Take a look at American Express shares. They are up 1% after it beat results. It is not a huge surprise given all we've heard from economists about the bifurcation of the U.S. consumer and how the wealthy are driving the spending. And Amex is confirming that with its strong transaction volume being fueled by its most premium products. And that is significant because competition in this space is heating up with JP Morgan and Citi both leaning into that. But Amex says that it's ready with a refresh of its Platinum card coming this fall. And we turn to another company that just reported, and that is Charles Schwab. Shares are up 2.3% after beating on both the top and bottom lines, thanks to a flurry of activity in the second quarter. Though there were some weak spots, Schwab attracted $73.6 billion in total net new assets, which did come in below estimates. And we end with some breaking news. Chevron and Hess have closed their deal. We have Chevron rising 3.7%, Hess rising 7.6%. And this is after just this morning we heard that Hess won its arbitration battle with ExxonMobil, clearing the way for this deal, $53 billion takeover to move forward. John?
Yahara, thank you. Thanks for this morning. Have a good weekend. Let's turn back to the big story of the last 24 hours. One Federal Reserve Governor, Christopher Waller, continuing to build the case for a July rate cut. Mike McKee joins us now for more. Mike McKee, how convincing was the argument, and will he find some friends on the committee at the end of the month?
I definitely think he'll find friends on the committee. The question is, how much do they buy into the need to do it in July? We've heard a lot of people, including Mary Daly yesterday speaking with us, say that they are worried about the labor market and they are worried that they could be too late, but that it doesn't seem to have the urgency of a July rate cut. So Waller and perhaps Governor Bowman are going to make the case for it. We don't know how many people are going to buy that case and would vote for it. So we'll not only be watching the news of the meeting, but we'll be watching the minutes to see who spoke up and what they were saying.
Mike, also the statement. Talk to us about the statement and the kind of concessions that maybe the rest of the committee might make to some of the dubs that are emerging on the FOMC. Some of the language there at the moment that might have to change.
Well, the Fed has gotten away from very long statements, so they might try to finesse this by just noting that the labor market has shown signs of cooling. The real question is, how much of a commitment do they make to a September cut? In the past, we have seen negotiations behind the scenes that lead to the Fed not doing something what a prominent member wants them to do, but suggesting that will be on the table in the future. Do they put a rate cut in September more firmly on the future to satisfy Waller and Bowman and to try to get them to vote unanimously in July, or do they let that go by? That's going to be something that Wall Street is watching very closely on July 30th.
Mike McKee, you enjoy wherever you are and wherever you're going next. It's good to see you. Mike McKee there. Following the Federal Reserve and the arguments for lower rates at the Fed later this month.
You know, just, I have to say, the argument for more dissent is one that resonates with me.
Oh, without a doubt.
Given the fact that it shouldn't be groupthink, number one. Number two, this is a complicated, difficult economic moment. It is one where people can have different opinions and different interpretations, and you see that across Wall Street. It might, in that statement, be a really good thing to show an active debate and how different members are thinking about it, because it gives a sense of what the scenario analysis is at the Central Bank of the United States.
And what did he call you, Mitch? What was it?
The you, Mitch thing.
That you, Mitch thing?
Yeah, not interested.
That's survey.
That you, Mitch thing comes out a little bit later this morning at 10 a.m. Eastern Time. Sarah House of Wells Fargo has this to say on the consumer. Headwinds for the consumer persist. Slower job growth and higher inflation are a recipe for weaker real income growth. Joining us now is Sarah House. Sarah, welcome to the program. Let's get into this consumer and this labor market. What we just heard from Governor Chris Waller is that this labor market is on the edge. Do you agree? Is it on the edge?
I agree. I think it's certainly more fragile than you would expect it from if you're just looking at the top line payroll numbers and the unemployment rate. When we look underneath the surface, as Governor Waller highlighted, slower growth in private payrolls, and also just looking at the breadth of industries adding jobs has been one thing that's really stood out to me. If you look at that diffusion index, it's below 50. We've only seen that 3 times in the past 15 years outside of a recession, and one of those times was just 2 months ago. So I think there are certainly signs that the labor market is more fragile than it looks. We see this with demand continuing to weaken as well, businesses not using employees as intensely, for example, looking at the average work week. So I think that does challenge the consumer as we move through also a potentially higher inflation period over the next few months.
One thing that John asked Governor Waller that I think is one of the key questions as we talk about the potential fragilities in the labor market is corporate America seems to be doing just fine, and the earnings are actually outperforming expectations, and you're seeing record highs. How do you square that?
Yeah, so I think part of it comes down to, we're looking at some of the biggest, most well-funded public companies, but of course a lot of job creation is by more of your mid-sized firms, of course your small businesses as well. And there I think we're seeing more struggles. So you can see this with, for example, the NFIB hiring plans and the overall index, and also just a lot of the middle market companies that, we at Wells Fargo talk to a lot, they're seeing some pressure as well. So I think it's just like we're seeing in the consumer, sometimes it's a little bit of a tale of two sizes here.
Which also raises the question of where we're going to see the investment boom that everyone keeps talking about. The beginning of a new bull market, as we heard Mike Wilson say of Morgan Stanley yesterday when he was speaking with John and Anne Marie. Just wondering at what point that creates jobs, at what point that creates inflation, at what point that creates growth that people are discounting when they talk about this fragility, these cracks.
Yeah, so I think in some ways, we look at the productivity potential that we're seeing already. We've seen pretty strong productivity growth this cycle. Still a lot of upside when we think about some of the Gen AI enhancements, but of course that could challenge what we're seeing in terms of overall employment growth, but it's also coming at a time of slower growth in the labor supply. So it could actually potentially be a nice offset to a lot of businesses' needs, and then to the extent that this is productivity enhancing, that's actually going to be beneficial for the inflation outlook.
What's the smaller growth, though, in the labor supply? Governor Waller was just talking about the unemployment rate for college grads at 7%. That feels uncomfortably high.
Yeah, I agree. So again, this is, we're looking at slower growth in the labor supply, but that's coming largely from immigration. We've seen a very noticeable drop-off in foreign-born workers in the labor force, but they're filling a lot of jobs that your college grads are not looking for. And so I think that does speak to more underlying weakness and payroll growth slowing, not just because of the supply side, but also because we're continuing to see demand weaken.
So do you think that, Sarah, it is all sufficient to say that any kind of inflationary hit from the tariffs will be temporary?
So I think that's a reasonable base case. So that's what we're looking at here at Wells Fargo. So looking for inflation to move up to a little over 3% by the end of the year, but then move back down as we move through 2026, with really the lift coming entirely from the goods sector. We're not looking for that to spill over into services, but I think understandably a lot of other Fed members remain cautious given the bout of inflation that we just went through, and I think concerns that given how high inflation has been, we're more than 4 years above target, that even just one more supply shock, even if it should be temporary, does that begin to unanchor inflation expectations? So understandably, they're a little skittish, maybe a little bit scarred from the episode that they just went through, but perhaps another few months of data showing that it's not bleeding into services, I think could be helpful and help resume rate cuts as we move into the later months of the year.
Sarah House of Wells Fargo. Sarah, thank you. Appreciate your time, as always. It's why some members are holding back still. Is 2 months of data enough to get to September and say, we're ready to go?
Yeah, how much are they scarred from their previous experience where they didn't catch up to inflation quickly enough and they said the T word? Yeah, they don't want to go back to the T word. It's a little bit worrisome to them. At this point, though, an increasing number of economists, and we keep talking about Mary Daly's interview with Mike McKee, but she also talked about this, that she also is seeing that it's more likely that it is going to be a one-time price shock, especially when met with the weakness that we keep talking about with potential cracks in the labor market.
Now, this conversation will continue at least for the next 2 weeks and maybe the next several months. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump has been diagnosed with a chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says that he remains in excellent health, though, with no signs of DVT, heart failure or systemic illness. Doctors attribute recent hand bruising to aspirin use and frequent handshakes, calling it benign. Elsewhere, shares of Sarepta Therapeutics are plummeting after the company said another patient has died from acute liver failure after receiving one of its gene therapies. That news follows the recent deaths of 2 teenage boys who participated in the early-stage trial for the treatment. The company says it's in discussions with the FDA about resolving safety concerns. And a change in the late-night lineup. The Late Show with Stephen Colbert will air its last episode in May of next year. CBS says it was a purely financial decision. The moves come days after Colbert condemned Paramount's settlement of President Donald Trump's lawsuit over a 60-minute story. Colbert called it, quote, a big fat bribe. And that's your Bloomberg Brief. John.
Lizzie, thank you. Have a good weekend. Up next on the programme, setting you up for the week ahead. Plus, we'll catch up with Sunil Desai of Franklin Templeton on the tension building at the Federal Reserve. From New York City, you're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Two days of gains on the S&P 500, going into the weekend looking for record highs after record highs. This morning, all-time highs, up 0.1% on the S&P 500. And so far this week, the equity market bulls getting a lot of what they want. Decent earnings from the banks, decent data so far in the economy in the United States, and even someone who was bearish sounding very bullish. Even Mike Wilson of Morgan Stanley likes this market.
People like the idea of this investment cycle, and I really can't emphasize it enough. When I talk to people, there is an existential fear that they cannot invest enough in technology and they are going to lose their entire business if they are on the back foot. And that is the reason why it's not just the tech companies. There's a feeling that corporate America is going to withstand. Also, the consumer's holding in. I mean, people are still traveling. People are still going out to eat. I don't know, it's really expensive, except for you. But I, would live in a box, so there you go.
You spoke to Scott Kirby of United. I keep going back to this. What we're hearing from the airlines is so different to what we're seeing in the data, even on the airlines and airfares.
He said that it was like a switch that went on after the one big beautiful bill was passed. Also, some of the disruptions in the Middle East definitely relieved some of the pressure when you saw sort of an end to that. There's just a question here. Who's right? Is there weakness or isn't there? Are Americans just sort of conditioned to spend money and so they want to keep doing it? Is it sort of a secular trend toward travel and away from physical goods, or are things not that bad? And actually, there aren't the cracks emerging that some people are worried about.
Can I go with the second one? Number two, conditioned to spend.
I mean, yeah, and also, you got to get the Instagram. It's all about the gram.
They say never bet against the American consumer.
It's true.
They just keep on spending. Check out the bond market. Bonds a bid, yields are lower. We're down 3 basis points at the front end of the curve. On a 2-year, 387. On a 10-year, down 3 to 442. A bond market rally. After this, we caught up with the Fed Governor, Christopher Waller, who's calling for a rate cut this month.
One of the things that has always bothered me since I took this job is the criticism that we are nothing but groupthink. All the meetings are the same. Nobody dissents. Nobody does anything. And I think this is healthy. I think this is a turning point in the way we want to think about policy. Some people don't want to cut. Some do want to cut. But coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home? So this is healthy. I think this is what you want to see in a democracy. You want to see policymakers have serious, open discussion about where policy should go. It doesn't mean anything about politics or anything else. It's make the economic argument and then see if you can convince others to go along with you.
You never know what someone's thinking, but just listening back over that, my interpretation of it was a man who was very sophisticatedly navigating a very important issue, communicating that it's not one-man rule on the FOMC at a time when a lot of pressure is building on one man.
Yes, and so on one hand, you could interpret this as giving him a pass in terms of Jay Powell making all the decisions, or you could say, well, there are other voices that can be heard at a time where people are increasingly saying his voice carries quite a bit of clout given his potential role at the Fed.
Another stealth argument he made towards the end was talking about inflation and credibility. Without credibility of the central bank being independent, inflation expectations would spike. And he said, I know that, and Scott Bessent knows that. So basically talking about the fact that whoever is going to be the Fed chair next, everyone in the White House knows that person needs to have credibility. because inflation expectations will then spike, which is exactly what this administration does not want to see.
The opening bound's about 42 minutes away as we work our way towards the weekend. Just a sneak peek of next week for you. On Tuesday, you will hear from the Fed Chair, Jay Powell, speaking at the FOMC's regulatory conference. On Wednesday, more results from Tesla and Alphabet. On Thursday, a rate decision from the ECB, and we'll get more earnings from Intel and American Airlines, plus another round of jobless claims. Let's stick with the week ahead and Fed Chair Jay Powell speaking on Tuesday as President Trump ramps up the pressure for a rate cut. Sonal Desire, Franklin Templeton writing, the FOMC is already envisioning several 50 basis points of rate cuts this year, followed by more next. I happen to disagree with the policy, but I also think this confirms that the Fed already has a dovish bias. Sonal joins us now for more. Sonal, I just want to get into your thoughts on where you stand on this rate cut debate at the moment. Why don't you think a rate cut, currently at least, is warranted?
Okay, before I get to that statement misstated what I was saying. The FOMC foresees 50 basis points of rate cuts this year and several rate cuts next year. And I think that is probably not warranted. And really, because the economy is kind of doing fine. We've talked about this several times in the past. I happen to think that the neutral Fed funds rate is between 4 and 4.25. We've talked about this before. 2.25 of inflation, 1.75 or so of productivity gains. Unless it looks like recession is imminent, it's not clear to me why the Fed should be cutting rates all the way down to close to 3% in this environment. We have become used to extremely low rates. And prior to the global financial crisis, we had decades of rates being more normalized. And that's why I don't think it's needed.
So now, that said, a lot of people do expect the Fed to cut to that level that you're talking about, and you're not seeing an unmoored level of inflation expectations baked into the market, as Governor Chris Waller was just saying. So do you think that the market right now is underpricing the potential for future inflation?
I think it is probably. And the point is the future inflation that I see is probably not associated, let me be clear, with tariffs. For a number of reasons, it's not just that they're one-off. Frankly, tariffs don't impact enough of the CPI basket to have a meaningful impact on overall inflation. The real reason is fiscal policy remains very loose, monetary policy is not particularly tight, and we aren't seeing unemployment do terrible things. Wages aren't doing terrible things. This is an economy which remains in relatively good health right now. And that's why I think we aren't seeing the pressures. What brings inflation down? Let me turn it on its head and say from its current levels, which by the way are 50% higher than where the Fed needs inflation to be, what brings inflation down? Well, I don't see very many factors.
One thing that people argue is you are seeing, I don't know if it's cracks in the labor market, but a sign that private employment really is coming down. And you saw that really in the last non-farm payrolls report, which is what Governor Waller was talking about. But you're hearing companies say this as well, that they don't have the same kind of pricing power that they did in the direct aftermath of the pandemic. So at what point will that pushback that you're seeing from the consumer act as a check and something that really is consistent with what we're hearing from corporate executives?
Once we see some more, once we can hang a bit more meat to that particular story, I'd say I would agree. So far, it's a data point. It's a few data points. And actually, we've seen some fairly decent corporate earnings as well. We got yesterday's retail sales, for example. I really don't know that we're at the cusp of something dramatic happening to this economy. And getting clarity on the fiscal front, whether you like the bill or hate the bill, we do have clarity from the bill. That actually is a corporate tailwind, not a headwind. So I'm not yet prepared to say that we're getting to a point of significant weakening of this economy.
So does that mean, Sonal, that you're all in on a high yield and you're shorting the 30-year?
No, I'm aggressively neutral on rates in general, and I am looking at, if I think about all the different factors which come into play, I think fair value for US 10 years is actually probably around 4.75 to 5. Do we get there? It's not completely clear. Weirdly enough, actually, after being concerned about fiscal for so long, I think something that people might be underpricing is that if tariffs go through anywhere close to the level we've seen so far this year, we actually have an additional source of revenue which has not been factored into anybody's calculations, And it's quite substantial, actually, you know, the type of revenue which is coming in. So there are lots of unknowns here. I think that the spreads we're seeing on high yield are extremely tight. That's very clear. I think you need to be very careful. So it's not that I'm all in. I'm just looking at this and waiting for some volatility to continue to pick up interesting credits in interesting places. I don't think you can buy any indices, which you would do if you were all in and spreads were enormously attractive.
So now, you also think the markets are just overhyped when it comes to the controversy between Trump and Powell. Are you willing to close that door then about the White House and Trump potentially firing him? You just don't think it's going to happen at all?
It's not a question of happening or not happening. I don't think it matters, is my point. You would get volatility if he fired Powell for cause, if some of the current controversy results in something meaningful, which I'm doubtful about, but supposing it does, and supposing Powell is fired. I would just note, what exactly is it that we're all terrified about? An enormously dovish Fed chair? Can I ask everyone on the program today, who was our last hawkish Fed chair? Let me tell you, it was Paul Volcker. You have to go back 50 years, yeah? So let's not act as if getting a dovish Fed chair is something none of us have ever encountered. I give you Janet Yellen. I give you Jay Powell, who actually did preside together with the supremely dovish Fed over one of the biggest policy errors that we've seen in a very long time. That policy error was not to be overly hawkish, it was to be overly dovish. So I think when I say it's being overhyped, it is this notion that somehow we're going to get someone truly beyond the pale who is going to come and knock monetary policy completely off course. It's 12 members who get to dissent or not to dissent. I think that the institution has a certain amount of credibility, and no incoming Fed chair, who, by the way, survives this administration and whose term will run into the subsequent administration, would like to have his legacy fall under that footnote that Arthur Burns has in the annals of the Fed.
You ever seen that scene of a bunch of football fans watching the game and they score, and then all the beers get thrown into the air?
Yeah.
And now people have put different video in that screen, and then they throw all the beers into the air. That was Sonal design, the big screen. And it starts going on that rant about the Federal Reserve, all the beers getting thrown into the air, everyone's going crazy.
Yeah, that's very much. That was a fantastic, fantastic explanation and, frankly, history lesson.
Sonal, thank you. Sonal design there, Franklin Templeton. It's got a point, and a point a lot of people, I think, will share.
Yeah, the idea of no one wants to be Arthur Burns. No one really has the stomach to be Paul Volcker either, and that's certainly what we've seen over the past, what did she say, 40 years?
And Paul Donovan recently made the point this week with Danny Berger of UBS that actually that Arthur Burns type Nixon relationship, where on the surface you think this person is independent, but actually what they're talking about, you see later years in the minutes, is pretty much what Nixon was saying. He said that is the worst type of Fed chair we can get.
Where are these weeks going? They're just flying by, aren't they?
Well, I mean, how you think about what's happened in the past month. I mean, I can't remember half of the things that were headlines that dominated our life.
August is going to be fun. 2 more weeks of July, of course, but a couple of trade deadlines in the mix. Should we go? I think we should go. Coming up on Monday, Laurie Calvasina of RBC, Bob Michael of JP Morgan, Tony DeSpirito of BlackRock, Chris Harvey of Wells Fargo. From everyone here at Bloomberg Surveillance, thank you very much for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
End of a long week of economic data is trying to break back into the green this morning, up about 1/10 of 1%. We're looking pretty good 30 minutes into the start of trading. I'm Shonali Bass.
And I'm Danny Berger. Matt Miller and Katie Greifeld are off. Bloomberg Open Interest starts right now.
And coming up, the case for a cut. Fed Governor Chris Waller says private sector hiring is driving his call for a rate cut. And streaming success. Netflix blew past estimates last quarter, but investors still aren't impressed. And a big victory in big oil. Chevron wins its arbitration fight with Exxon, clearing the way for it to buy Hess, Danny.
And we start right there, Shonali. A clear market reaction this morning. Both Chevron and Hess shares on the rise following that. 3.6%, 7.6% respectively. The $53 billion deal was announced more than 20 months ago. Chevron CEO Mike Wirth says this merger of two great American companies brings together the best in the industry. And Shonali, we will be speaking with the CEO later. Really looking forward to that conversation.
And from big oil to big tech, we're looking at Netflix today. It is down about 2.4% pre-market. Results beat expectations in every major metric, and it raised its forecast. But that wasn't enough, given that the stock has soared almost 50% from its April low. Netflix executives are looking to the future. The company says that they look to ramp up spending on gaming while providing creators with new tools to enhance films.
We remain convinced that AI represents an incredible opportunity to help creators make films and series better, not just cheaper. There are these AI-powered creator tools. So this is real people doing real work with better tools. Our creators are already seeing the benefits in production through pre-visualization and shot planning work, and certainly visual effects.
For more on Netflix, we are joined by Bloomberg Technology co-host Ed Ludlow. Ed, a beat across every metric.
Right.
Shares down 2.3% though.
Yeah, it's a simple story of a beat that is not as grand as the great expectations of Wall Street. A lot of the sell side are particularly focused on the ad-supported tier, right? The revenue from that ad tier is going to double in this calendar year. But it's also a stock that's up, what, 43% so far year to date. It has a $500 billion market cap, eclipsing all of those sort of legacy stalwarts of the media space, Disney being the most obvious example. So Netflix has been saying for a really long time, Wall Street, please judge us on these sort of historic financial metrics. And on all of those metrics, it did a really great job. The content slate looks good, but it's just a standard. I'm really sorry, Danny. I feel like you're like rolling your eyes over there in New York going, come on, spill the tea here. But there isn't any tea to spill. It's just simple expectations against delivery.
Okay, I get a kick here, Ed, out of Morgan Stanley's reaction from earnings, because I think it says something about the rest of big tech earnings. They say that Netflix's early but growing use of Gen AI tools to power content and product innovation would reinforce their bullish view. Does that mean that Wall Street is going to get excited about the investment in AI for the rest of earnings season, or are valuations just too high to support that view, even if people are bullish?
I think so. Really interesting to kind of demarcate the infrastructure play from software companies. Netflix is basically a software company, right, that still needs to evidence some top-line growth that directly results from investments in AI. The use of AI in Netflix's case is really interesting because the sell side this morning is also saying, okay, actually, we look at the content slate for the second half of this year, it looks great. Squid Game 3, I've just watched the finale 2 nights ago, fantastic. You have Happy Gilmore 2. Those pieces of content are known to be in the works and will be coming. But what happens thereafter? You have to feed the beast kind of thing is how I'd summarize the analyst notes this morning. And there's not yet evidence that AI technology is feeding the pipeline. But if they say that it will, then I guess the street takes them at face value.
Ed, we thank you so very much. We're looking forward to the rest of earnings season with you. Of course, that is Ed Ludlow of Bloomberg Technology. Looking forward to your show as well. Chevron now also, as Jenny had been talking about, won its arbitration battle with ExxonMobil, clearing the way for its $53 billion deal to buy Hess. The decision ends a period of limbo, 20 months of limbo, that hurt Chevron stock and prompted questions over the quality of the company's due diligence when it agreed to buy Hess 2 years ago. Joining us now with more details, Simon Casey, Bloomberg's managing editor for energy and commodities. Deal's done, right? I mean, what does this mean in terms of the ability to squeeze out that dollar to bring back what was lost over the last 20 months?
Well, I mean, must be sighs of relief all round at Chevron this morning. As you say, this has been going on for a while. This has been, as you said, an overhang on Chevron stock. The stock has underperformed. It's just sheer uncertainty over the past 20 months, the inability for Chevron to do very much except hang on, wait for this arbitration deal. So now, excuse me, you have analyst notes coming out this morning that the streets are saying Chevron get on with integrating these assets, boosting its earnings, focusing on Guyana, which is a very, very promising oil play. Exxon's been there for some time. Interestingly, Chevron and Exxon are going to be working side by side on this joint venture off the coast of Guyana. So how does that go on? There's a lot of love lost there. Some bitterness, I would imagine. Something to ask Mike Wirth later on today. This has been a real problem for Chevron the past 20 months.
Well, it's also a Chevron that's been trying to engineer restructuring, that's also been letting go of employees, trying to cut costs. What does it mean to be integrating Hess at a time when they're trying to do this and make sure that things stay in line, again, especially when it comes to cost pressures?
Look, I mean, I think they're raring to go. The deal closed today. They'll get on. They'll do that. Yeah, the cost cuts that you mentioned, the cost savings over the last several months, I mean, that's part of an ongoing process. We've seen that at Exxon as well across the industry. The post-pandemic oil industry in the US has been laser focused on costs. The integration process now will be reasonably straightforward. Hess's assets, half their revenue comes from Guyana, the rest is from largely from the Bakken shale field here in the US. Chevron will integrate those assets pretty quickly. It already has a very big shale footprint here in the US. It's a very experienced operator.
Yeah, we'll see how two enemies in the legal proceedings get along to be two co-workers in a JV in Guyana. Simon, thank you so much for joining us this morning. That is Simon Casey of our Bloomberg Oil and Gas team. And tune into our interview. Mike Wirth, Chevron CEO, will join Shonali and I in the next hour. But first, back to one of our top stories. Federal Reserve Governor Christopher Waller says he is starting to see cracks in the U.S. economy. He spoke to Michael McKee, Bloomberg's international economics and policy correspondent, in the last hour.
The private sector is not doing as well as everybody thinks it is. Like most of half of the employment growth we saw last month was in the public sector, and that means the private sector is not doing particularly well. So I was just joking that, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
The Fed's Waller speaking to Michael McKee, and I'm pleased to say that Mike joins us now. Mike, this is off the back of a Waller who last night also said he was ready for a 25 basis point cut. What was your takeaway?
Well, I think he is firmly committed to a 25% cut now. He wants to get ahead of any potential problems for the economy, and he sees more problems than perhaps some of the others do. He suggested that we could see the labor market freeze up rather rapidly, and it's better the Fed get ahead of that. Now, we all have to put this in the context of him being mentioned as a potential successor to Fed Chairman Jay Powell. I asked him if he would dissent, which would be maybe seen as a sign to Trump that he is on board if the rest of the committee is not. But he parried that and said he's made his views very clear, and he's not going to pre-commit to one thing or another.
He also spoke to you a little bit about the potential for the Fed chair position. He said he hasn't really spoken to the president about it. Of course, he's been very much in the news around this position. How do you see the race playing out and where he falls into the bigger picture?
Well, it's interesting that Chris Waller is saying he has not heard from the White House because, as you mentioned, he is on everybody's short list for Fed chair. And we have heard from Scott Bessent, the Treasury Secretary, that they have begun the process. Now, what does that mean? We don't know. How far have they gotten? Have they done interviews? We know that the president has spoken with Kevin Warsh often, and we know the president has spoken with Kevin Hassett and Scott Bessent on a regular basis because they are in the administration. So Waller's kind of the odd man out, which he acknowledged today. He said, I'm the outsider, but he did say if he was asked to become Fed chair, he would accept the position.
Mike, we appreciate you so very much. That is Bloomberg's Michael McKee off of a very busy week of Fed talk, both in terms of who might take a future position as well as the economic data that could or could not suggest a rate cut early this year. Now, some more movers on our radar. We're watching American Express outperforming expectations in the second quarter as affluent clients continue to spend. It's not enough to please the market pre-market. Amex still down about 0.4%. But of course, we know that a lot of people are watching this K-shaped recovery. However, Danny Schwab, I think Schwab and Interactive Brokers are quite interesting. Robinhood reports next week. Both of those stocks up as Schwab beating earnings estimates. Client assets hit a new record.
Yeah, and you have seen retail investors flock to stocks. They keep buying the dip. And it is that volatility, to your point, Shanali, of the Schwab and IBKR being connected. It's also that volatility that allowed Interactive Brokers also to beat net estimates, too.
Absolutely. And then, Denny, it's really interesting. You see that the retail trade is something investors are watching more and more of. You're seeing a lot of others also flock to the crypto world to see where those retail investors are going, and that has been getting a big boost in the market.
Well, Scott Rubner, who was previously at Goldman Sachs, now over at Citadel, wrote this really interesting note saying that the breadth of demand coming from retail looks like 2021. It looks like the pandemic. So are we back in that environment, especially as crypto picks up again, too?
And Citadel Securities, of all places, will know because they handle so much of that retail volume, Danny.
Very true. All right, coming up, we're going to talk more about Netflix analyst John Blackledge of TD Cowen. Next, as it kicks off the big tech earnings season, Netflix down 2.6%. This is Bloomberg Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
And now to high interest, a look at what's making headlines around the world. 3M beat profit estimates and raised its forecast as it makes strides in its turnaround plan under CEO William Brown, who joined the company last year. 3M has put measures in place to mitigate tariffs, including shifting production. And Union Pacific is exploring an acquisition of Norfolk Southern in what would be the largest railroad deal ever. The combined company would have a market value of nearly $200 billion. Analysts are positive about a possible deal, but warn that any transaction would face significant hurdles. Norfolk Southern still up almost 3.6% pre-market nonetheless. And Meta has hired a pair of key artificial intelligence researchers who worked at Apple, and this is shortly after poaching from their former boss from the iPhone maker. The hires are part of a scramble for AI talent across the technology industry, with Meta being especially aggressive in its recruiting, Danny.
I was going to say, this feels like what, like a daily occurrence now that Meta poaches some person for X company. So I'm sure we'll hear more of that.
Stories we've seen before.
It's exactly spending so much money. And look, it is going to be Meta we're hearing from next week or later when it comes to their earnings. We already heard from one tech giant. It is Netflix. It beat expectations in every major metric, raised its forecasts. Shares, though, down 2%. 2.6%, I should say, in the pre-market trade. Joining us now, I'm pleased to say, is John Blackledge, TD Cowen Senior Equity Research Analyst. He has a buy rating on Netflix with a $1,450 price target. Great to see you this morning, John. So after a nearly 43% run-up in shares so far this year, was the bar just too high for Netflix?
Yeah, and it's almost doubled over the last year. And as you guys said, you know, we got a great second quarter, revenue accelerated. They beat on op income. The 3Q guide was ahead of consensus. They raised fiscal 25 revenue, operating income, and free cash flow guide. And we raised our numbers slightly, and our price target went to $14.50. But yeah, and shares were up 2% yesterday. I think they probably, and I think investors got what they were looking for. They were definitely looking for a raise to fiscal 25 guide, but I think it would have had it been Herculean for it to be up significantly off the print, just given the run as you just mentioned.
But being up is one thing, being down is another. It's still down about 2.7%. I mean, to the extent that this company could have given investors a little more to hold on to, what would that have been?
Yeah, I mean, well, they raised revenue guide $1 billion at the midpoint. They raised the margin guide to 30%. I mean, I think some people were kind of picking at engagement. They're publishing this engagement report. It was up 1% year over year. The market share has been kind of flat in the U.S. And the company's like, basically like, hey, we've increased our spend on content 50% since 2020. We're focused on scripted and unscripted, episodic and feature film content, and obviously growing out, kind of their live event business. And they think that their engagement will go up. And I heard you guys talking about it before. They obviously have a massive second half slate. So they think engagement will go up in the back half and in coming years based on their, various investments in content.
Well, you just hinted at this, John. Netflix said yesterday that its addition of U.S. viewers, of U.S. customers, it hasn't grown. It's about the same it has been over the past couple years. Is this just an oversaturated, stagnant market, or is some of what you're talking about, a big slate coming up, enough to reinvigorate the American market?
Well, they actually said that they don't give member metric anymore, right? They stopped giving that this year. But they did say that their member net adds grew more than their internal expectations in 2Q, and it was late in the quarter. And the interesting thing about it is, what did they launch kind of late in the quarter? They launched Squid Game Season 3, and they also launched other good content in June. And so I think that had an impact on the member growth in 2Q. And they told us, management told us in our callback that members grew across all 4 markets. Most of the growth was outside of the U.S. because the U.S. is the most penetrated from a broadband household penetration perspective. But I think what's interesting about the strong member growth in 2Q as it relates to the back half of the year is they do have Wednesday returning in the third quarter. They do have finale of Stranger Things in the fourth quarter. And I think those things will help drive members, both retention and member growth in the back half of the year. And that will be helpful for them and momentum, going into 2026.
I'm wondering, John, if there's anything to extrapolate by how investors have been treating Netflix's earnings. For example, if you pull up the Magnificent Seven, which Netflix is not one of, right? You do see only significant price appreciation in about half of that index. And does this mean that even if a Netflix can show pretty solid results and see a little bit of a dip post-market, does that mean the rest of the Mag 7 are far more vulnerable?
I don't think so, and I don't cover all the Mag 7, but I do cover Amazon, Meta, and Alphabet. I think it's specific to the companies. Just for instance, we have Meta, Amazon, Alphabet beating sell-side consensus revenue and operating income. But specifically for an Amazon, just very quickly, we're looking for AWS revenue growth to accelerate. That's a big thing for Amazon and accelerate in the back half of the year. For Google, Alphabet, looking for Google search growth to be strong, and also the cloud business to be strong. So there's different things for each company. Meta, the ad business should be good, but as you guys mentioned, their release of Llama 4 was disappointing, and now CEO Zuckerberg's in this AI talent grab. They did that big investment in Scale AI, so it'd be very interesting how they talk about their AI ambitions. As all 3 companies actually are, as you guys know, are investing significantly, historic spend in AI infrastructure.
Yes, it is capital expenditures that are quite literally lifting up the entire market with the sheer number of dollars being spent. So, John, we'll get those Meta results not next week, but the week after. At what point do we start to think again about this idea of the year of efficiency? It feels like so long ago for Meta, but at what point do investors stop rewarding the AI push and the spend going on to it and start thinking again about this idea of efficiency?
Yeah, I mean, they're growing headcount. Their cost growth is accelerating a bit this year, and obviously, a lot of people are talking about these huge pay packages for the recent AI talent grab that the company is doing. But I think investors expect them to beat with their core ad business. That growth is strong. AI is helping drive, kind of content recommendations, ad targeting recommendations, and CEO Zuckerberg is a great communicator and inspires confidence in investors. And they get the company and the shares get some benefit from his communication relative to maybe some of the other players in the space.
John, we thank you for joining us this morning. That is John Blackledge of TD Cowen, setting up to be a very interesting earnings season after Netflix's report. But we're going to talk about another darling in the space of technology. Traders keep piling into NVIDIA, but the rally is showing signs of overheating. We're going to take a look at the stock next. This is Bloomberg Open Interest.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I want to get a check on futures ahead of the opening bell because we're looking at green on the screen. The S&P 500 more than 0.1% higher heading into that opening bell. The NASDAQ 100 pretty much flat. It's trying to break into the green as well. Let's see if that could hold. Of course, we have those Netflix earnings this morning that are sending that stock lower at the very least. But of course, earnings season is just really kicking off. Russell 2000 futures, though, are flying a little bit higher, about 0.5%. Keeping an eye on NVIDIA this morning, super interesting, up about 0.25%. It's interesting. A lot of analysts now a little worried that this is entering overbought territory. The stock is now worth, according to its market value, about $4.2 trillion. BTIG says the sentiment is getting borderline giddy. So, Danny, a lot of interest in this. Of course, this is what's leading the Magnificent Seven a little bit higher.
But maybe it's worth it, especially if you have a Jensen Huang who is now being able to shape White House policy. That's being allowed yet again to sell H-20 chips into China. You could look at it not exactly the same, but kind of like Elon Musk in the beginning of Trump's presidency. Maybe he has the president's ear, and therefore some of that valuation, extra valuation and premium might be worth it.
This is a strange earnings season because you have the political rhetoric also really seeping into the market. That's kind of overlaying how people feel about the numbers themselves. We heard from TSMC about some guidance. We heard from ASML. But we're ending the week pretty strong with all of that noise. And, Danny, we are less than 4 minutes away from the opening bell here. We are looking at an S&P 500 that's looking to break into the green and the week strong. We were at 6,300 earlier in the week, a new record high. Might have forgotten that in the middle of all the earnings and data. Stick with us. We're going to begin the trading day with Lori Heinel of State Street Investment Management. This is Bloomberg Open Interest.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
And we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Shonali Basak. We are trying to keep in the green this week. We have the S&P 500 futures still riding higher about 0.1% as we head into that market open. NASDAQ 100 also holding on, accelerating those gains heading into the open about 0.2% higher. And there you have it, the bells. Let's take a look and see who is standing at the NASDAQ. We have FinWise Bank, and they are about to join they are joining the Russell 2000. They are celebrating that milestone, and of course that is an index that investors are watching very closely. And of course on this side we have New York City Emergency Management, Danny, ringing the opening bells at the New York Stock Exchange as investors try to end the week in the green.
Well, here's one stock that is decisively ending the week in the green, Shonali, and it is Chevron. It has won its arbitration battle with ExxonMobil and has closed its deal finally. $53 billion deal to buy Hess. It took 20 months. That's how long ago this takeover was announced, up 2.5%, 2.57% to be specific. They're going to have to work with Exxon now in Guyana. Really interesting how this moves forward. And Shonali, I'm pleased to say that the Chevron CEO, Mike Wirth, will be joining us in about half an hour's time.
Very much looking forward to that conversation. We're also keeping an eye here on Netflix. Results did beat expectations in every major metric. It raised its forecast. That was not enough, given that the stock has soared almost 50% from an April low. You're seeing Netflix shares down about 2.7% at the open. And speaking of valuations, Bank of America strategist Michael Hartnett is warning that a bubble is brewing in U.S. stocks. In his latest note, he writes that the clearest sign would be if the market ignored an increase in inflation expectations and bond yields hitting new highs. That all is as we await the latest UMISH sentiment data in less than an hour. Joining us now, Lori Heinel, Global Chief Investment Officer at State Street Investment Management. What do you feel about where we are in valuations for the U.S. stock market, particularly the S&P 500, relative to where you see fixed income trading right now and any upside risk to the bond market?
Well, right now, we think that valuations, while they're extended, they're somewhat warranted, given what we're seeing in terms of earnings growth. And we don't forecast yields to go much higher from where they are right now. Actually, if anything, we see short rates coming down, which will give room for a bit of a rally in bonds towards the back end of the year. So right now, we're in a bit of that sweet spot where valuations, while a little stretched on a relative basis compared to other parts of the world, look pretty attractive.
How much confidence do you have so far in this earnings season, what we've heard, Lori, from the airlines saying that more customers are going to be buying tickets to the banks with a really strong showing? Is this full steam ahead a very resilient U.S.?
Well, I'd hardly call it full steam ahead, but certainly a lot of the risks have really passed. I mean, that crisis moment in trade has passed. That's given a little buoyancy to consumer confidence. Labor markets are still pretty strong. Earnings growth is coming in pretty good. And it seems as though between the balance of how tariffs are evolving and how companies and consumers are navigating that, we're kind of getting behind what we saw in the March-April period. So we actually upgraded our forecast for the U.S., and we actually think we're accelerating into 2026.
How do you feel about earnings season so far and what it could mean for any upside potential for the broader index? Do you feel that it's what's been working well that will keep working well, or do you see any undervalued opportunities to push these indexes higher?
Well, there are a couple of things. First and foremost, it is still going to be very idiosyncratic. So we're starting to see some of the areas like you described, whether it's IT or some of the consumer discretionary or some of the other areas doing pretty well in here. And importantly, some of the top line forecasts being upgraded, which is even a better sign in many respects. That doesn't mean we're out of the woods completely. Certainly, we still have a lot of specificity that has to come out of the tariff negotiations. And then finally, the other positive here is that we finally did get some fiscal certainty, if you will, with the one big beautiful bill passing. So there again, the momentum seems to be to favor U.S. stocks right now.
And you also still like short duration, Laura. You say they retain their appeal. How do you understand what is priced in this bond market? From understanding where the Fed goes to the intrigue over what happens to Powell's future and who the next Fed chair might be, what exactly is in the price?
Well, a lot of it still is fundamentals, right? So we believe that the U.S. economy is looking pretty good. We're downgrading our risks of a recession. But we also think that there is going to be a need for some policy stimulus towards the back end of the year to perpetuate that. So we are still forecasting some moves by the Fed later this year. And so that to us believes that it leads us to take more of a short duration position, but also be constructive in terms of not having a lot of backup in yields from here.
Now, as we talk about the potential for where interest rates are going through the remainder of this year and certainly into next year, I do want to point out just a little bit from our interview with the Fed's Chris Waller as well. Let's take a quick listen.
Whoever they choose, you're going to have somebody that has credibility with the markets, or you will see, as Jonathan was just talking about, you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. This is well known. We've seen this everywhere around the world when this happens. And I know Scott Bessent knows this. So this is not something that is lost on anybody.
Now, I want to point out here that you're looking at a 10-year yield that since the end of the prior month, we're 20 basis points or so higher. And you do have Christopher Waller recognizing that without any certainty around the Federal Reserve's future composition, for example, you could have that upward pressure and inflation risk under the surface. And of course, Christopher Waller is one of the people that has been long rumored to be in the running here now for a future Fed position as chair. Now, how much risk is there from now until May of next year when the Fed chair does step down in terms of who the president chooses, what the strategy is in between, and all of his allies pushing for change in the Federal Reserve's course?
Well, we try to focus on the fundamentals, right? What's the growth of the economy? What are the inflation risks? And we actually think that inflation will remain relatively under control. We try not to worry about the politicization, if you will. If you think about the role that the Fed has here, it is a very judgment-based role. I mean, they have to look at, where inflation is. They have to look at where, employment is. And if anything, they've sort of faded towards focusing on that employment picture as one of the big markers for how they're going to pursue policy going forward. So we still think that the Fed is likely to cut before the year is over. In fact, we've got penciled in as many as 3 cuts. So we think that will be constructive for elongating this recovery.
Lori, can you continue to ignore the politics, especially if we get one of the Kevins in? I believe it was Kevin Warsh who said there needs to be a regime shift at the Fed. If it is one of them at the chairmanship, does that need to change for you?
Well, a lot of what gets said as you're talking through what might happen does not necessarily manifest in what actually happens when, various parties get seated. So we're going to wait and see how, one, the economy unfolds, how employment picture and inflation dynamics unfold, and then we'll watch and see, as some of these other things play through.
I want to talk also about a part of the market here that's been a little underloved. And if you are still seeing the market pricing in at least one rate cut this year, if not 2, then the Russell 2000 you would expect to be performing just a little bit better. This did get a bid in the center part of the year so far, if you will, but it's still only up less than 2%, about 1.6% on the year. Do you believe that rate cuts can provide the boost to this index that investors have been waiting for?
Well, more importantly, again, the economic backdrop improving is the #1 thing that will boost that market. And we've actually recently upgraded our allocation to small cap stocks on the back of that improving economic trajectory. Rate cuts would be an additional buzz, if you will, but it's not necessary. We don't think that rates are necessarily restrictive right now relative to the underlying economic strength. So while we do forecast cuts, we'd like to see cuts. We don't think that's necessary to let small caps unleash a little bit of power here.
Laura, I mentioned this to Shonali earlier in the program. Scott Rubner, who's now with Citadel Securities, pointed out that retail share of trading volume has gotten back above 20%. That was the kind of levels you saw immediately after the pandemic and in the 2021 meme kind of craze. It's these sorts of things that people point to, saying things maybe look a little bubbly, maybe a little bit of frothy. Does that concern you at all? At what point do you say, I know you said at the start you're not worried about valuations. What do you look for maybe to start getting concerned again?
Well, a couple of things that we would look for to start getting concerned again is that suddenly the employment picture deteriorates massively. And we have seen some recent high-profile examples of companies that are announcing layoffs and things like that. So the employment picture is one that we are watching probably the most closely because that will feed into consumer sentiment and into consumer health. The other thing that we are going to keep watching, though, is that inflation picture, because again, if you start to see inflation get out of control, whether it's because there's robust underlying growth or because something else happens, that would be something else that would be destabilizing and would probably put upward pressure on rates. So we still focus on the fundamentals.
Lori, we thank you so much for joining us. Happy Friday to you. It's the end of a long week, and again, next week is another busy one as we continue into earnings season. That is Lori Heinel of State Street Investment Management. Let's get a check on the stock market right now because we are looking at some green on the screen to end the week in a solid territory, almost 0.2% higher. And when we take a look at the movers here, it's very interesting to see your actual biggest decliner on a points basis is Netflix. So they've given investors largely what they want, but they are still down. Now it looks like about 4.6% into the market open. So pretty fascinating there. This is a market trading on valuation. On the flip side, you have Tesla as the largest points mover on the upside, followed by Amazon and Nvidia. So big tech performing in a very mixed way today. I would also point out American Express is down 2.6% after the market open. Remember, they also impressed on a lot of levels, but not quite enough. I want to flip up the board here, also look at sectors and see what we're taking a look at. Yields are lower on the day, yet you do have that providing a boost. Financials up a little more on the day. Consumer discretionary, we were talking about Tesla up on the day, but utilities, here you have it, your biggest gainer. It's almost 1% higher to help that index. But you could see broadly, Danny, we're looking at broad-based gains in the S&P 500 to end the week. So a very healthy trade, even if you do have a mixed set of outcomes from this earnings season in terms of an investor reaction.
Very true. Mag 7 as a whole, though, is still gaining today. Shonali, should that stick, it will be its 9th consecutive day of gains, the longest winning streak since November of 2023. But as you pointed out, Netflix, it isn't there in the Mag 7, maybe for the best today. Netflix fortifying its image as a streaming leader as it reports a strong quarter. Coming up, we're going to break down the details for you. You're watching Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
You are watching Bloomberg Open Interest, another record for you. How about that as a way to end your week? Not huge gains here, up about 1/10 for both the S&P and NASDAQ. Russell, that outperforms up about 0.5%. Ninth consecutive day of gains for the Mag 7, the longest winning streak since November of 2023. But let's look at some of the top calls this morning, some of the analyst action that is in focus. First up, Chipotle, that gets an upgrade to a buy at BMO Capital. The analyst says it's well positioned for growth in the second half of the year, those shares up 0.5%. Next up, Abbott Laboratories, also getting an upgrade for them. It's from Jefferies. The analyst saying the recent pullback is too punitive, and the analyst likes the company's fundamentals, up less than 3%. Finally, Wall Street weighs in on Netflix after it beat expectations, raised its full-year forecast, though falling 4%, pretty chunky this morning. Piper Sandler, Morgan Stanley, and Wells Fargo are among the banks raising their price target. Morgan Stanley says the company's use of AI reinforces its bullish view. And for more on Netflix, pleased to say that we are now joined by Geetha Raghunathan, media analyst for Bloomberg Intelligence. Geetha, great to see you this morning. For you, which side do you lean on? The sell side there saying, hey, it was a great quarter, or what we're seeing over here, shares falling 4% this morning?
Yeah, thanks so much, Danny. So it was definitely a solid print. I mean, everything that we had hoped for, I think Netflix delivered. I think what we're really seeing this morning in terms of the muted reaction in shares is, expectations were very, very elevated coming into the quarter. And while the company did raise guidance, both in terms of revenue and in terms of its operating margin metrics, some may argue that the source of that raise was a somewhat of a low quality source, which was more tending towards FX, currency headwinds rather than, fundamentals. But still, fundamentals extremely strong, Danny.
So what does this mean in terms of the right valuation for Netflix? To the extent that you see investors kind of getting jittery about how much it has run up, what would it be doing that would justify that valuation to be much higher in the next year?
I mean, it's doing everything right, Sonali, as of right now. Yes, some investors may argue that at a nearly 50 times forward PE multiple, this is, a very rich valuation. But I think there is, if you kind of just look at the trajectory of the fundamentals, and if you look at all of the catalysts that are upcoming, so we had pretty strong performance in the first half, but really what we should be focusing on for Netflix is the second half, and it's going to be an absolutely monster second half because they have some of their biggest titles. It's standout content for them, some of the biggest titles that they've ever had in their history. So you have a great combination of returning hits, whether it's, Stranger Things or Wednesday, you have the NFL, you have other live events like boxing matches, you have movies, so everything and more that you could hope for. So that obviously is going to drive a lot of subscriber momentum. And then the big catalyst that should play out through 2025 and definitely in a big way in 2026 is the ramp up of the advertising business. And that definitely will help. So really the metric that we're looking for Netflix in terms of operating metrics is, revenue growth, right? And we saw an acceleration of that revenue growth, and whether they're going to be able to deliver, those 13 to 15% revenue gains. And I think they absolutely will. And then, of course, the operating margin increase. They took it up to about 30%. I think they can go very, very much higher. I think it's a pretty conservative outlook, just kind of looking at, what they've achieved so far. So it looks like they're keeping some dry powder almost for the fourth quarter, just kind of based on their results for the first half as well as for the third quarter guidance. But again, it's a little bit of wait and watch, but I think valuation definitely will be supported just by the strength of their fundamentals. And then you look at free cash flow. Next year, we're looking at something like this year, we're looking at about $8.5–9 billion in free cash flow. Next year, $13 billion, and they're deploying a lot of that towards buybacks. So I think, again, that really provides some valuation support there, Sonali, to answer your question.
Also, what you're underscoring, Geetha, is Netflix just standing on a level of its own. The other streamers unable to catch up, except, Geetha, YouTube. YouTube really starting to encroach on its territory, especially when it comes to things like children's programming. How do you see the competitive landscape evolving between these two?
Yeah, you're absolutely right. I think you're right that Netflix has won the content streaming wars. But, with YouTube, yes, there is an engagement issue here because Netflix kind of comes in terms of share of viewing at about 8 to 9%. YouTube actually leads it with about 13%. But, this question did come up yesterday during the call as well. And I think the way that management answered it was, they're both focused on different parts of the market, right? So Netflix really more focusing on premium content, on scripted content, on movies. YouTube really going more after user-generated content. I think with the use of AI, we are going to see, AI for content creation kind of level the playing field a little bit more. But the way that, the Netflix CEO, Ted Sarandos, kind of framed his response was, both Netflix and YouTube together only really account for 20% of all viewing. So really what Netflix is focusing on right now is going after the remaining 80%. And I think they have a huge opportunity there.
Geetha Raghunathan of Bloomberg Intelligence, we thank you for following all things Netflix for us. A lot of eyes on that trade this morning. But coming up, we're talking about another part of the investment universe that has been attracting a lot of interest this week. It's been Crypto Week in Congress, and crypto tops $4 trillion after Congress finally passed sweeping regulation for the sector. More on that next in your ETF Friday update. This is Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
This is Bloomberg Open Interest. Let's get a quick check on stocks here. We're looking at an S&P 500 looking to end the week in green territory. It's up about 0.1%. The NASDAQ 100 also up around the same amount, though you do have volatility nice and low. The dollar nice and low, too, is set up for a proper trade today. Danny, you are also looking at some individual movers that are kind of interesting. You're looking at Apple trying to turn around losses on the day and head back into green territory, though Meta still lower on the day. I know that's not dragging down the Mag 7 totally today, nor is Netflix because it's not included, but you are seeing Netflix down today too. We're talking about Tesla today as well, up around 2.6%. This has been throughout the morning generally your biggest point contributor to that NASDAQ 100, but those gains are broad-based. We're keeping an eye on crypto, stablecoin related stocks as well. Coinbase flying up more than 6%, Circle up more than 2.5%. Of course, it is crypto week in Washington and legislation just flying through Congress.
On that point, Shanali, now crypto assets as a whole, they've surged past $4 trillion for the first time. It is what you mentioned. It is the House passing the stablecoin legislation yesterday. Bitcoin, though, it is falling. That's down about 0.5% as those other stocks gain. For more, let's bring in Athanasios Saravegas, ETF analyst at Bloomberg Intelligence. Athanasios, great to see you this morning. Just how big of a boon is this to the industry?
Oh, hey, Danny, good morning. Not as if crypto ETFs needed any more tailwinds because they've already done really well. This is a massive boom, and it's because you just mentioned Bitcoin is down, but things like Ethereum are up, some of the other altcoins. So this is definitely a boost, probably more so even for the altcoins, just because, they're now going to be sort of legitimized. This is only just going to open up the product pipeline for more ETFs. It was, if anyone has been following, it was obviously a long road to get Bitcoin approved, Ethereum. That's where it stopped. This is now going to just open up the door for all these other filings. So, it's not really hard to see that this is obviously going to be a really, really big boost to ETFs, product development flows. We're already seeing Ethereum had record flows this week leading up to this passage. So it's definitely caught the eye of all these ETF investors.
How do the new rules around crypto change the thinking around Ethereum? Because your colleague, James Seyfarth, and I've got to say, I get off the show and I go listen to him on Twitter sometimes to hear about how these rules are changing. A lot of audio on that platform with him these days. How are the rules changing enough to justify interest around the staking ETFs that are being filed?
Yeah, obviously they're not as comfortable. They weren't as comfortable with it before this passing, but it seems like this is going to now, there's been some filings, some other issuers have filed for staking, which always kind of baffled me because staking exists in other regions like in Europe. So this is definitely going to open up the door for more staking. A couple of the issuers have already sort of, jumped that gun with some of the new filings, but I get big boosts for Ethereum and again, some of the other altcoins as well.
Athanasios, we thank you so much.